Hello champions, so if you're writing your CMA Inter exams in June 26 or in December 26, then this video is for you. Now as you know already, for CMA Inter Direct Tax, I've launched this exclusive workout batch which is not a copy paste of CA Inter. It is new recordings, freshly made in April 2026. It is solving questions that are applicable for your tax exam with respect to DT. It covers questions from your CMA study material, your workbook questions, your previous year question papers and your model question papers. So it is not recycled from CA Inter. It is made exclusively on the basis of your syllabus, on the basis of the level of questions which are asked in your examinations. So from that workout batch, I've taken the PGBP recordings and I'm putting them out here on YouTube, so that you all can benefit, because this one chapter has very good weightage in your examination. It has decent weightage of around 10 to 12 marks. You will not only have one dedicated question on just PGBP, question 3B. In addition to that, you will also be having some adjustments from PGBP in your total income question, some adjustments in your MCQs. So everything put together, around 10 to 12 marks is what we expect out of this chapter. And it's also a very lengthy chapter, and we need some solid practice when it comes to this chapter. And that is what is going to get super sorted for you through this video. So in the workout batch, I did the PGBP chapter across some 7 or 8 sessions. I'll add all the 7 or 8 sessions in this one video. I'll consolidate them all together, okay? And once you're done with this video, you will be done with your study material questions, workbook questions, your previous year examination questions, and model question paper questions of the PGBP chapter. Alright guys, so once you're done with this entire video, whatever practice you need with respect to the PGBP chapter, you will be done. Okay, so the sessions start right after this. Hello champions, so with this we are starting the third head of income. We're starting off with PGBP. We're done with the basics, we're done with residential status, we're done with agricultural income, and we've completed the first 2 heads of income very nicely, salaries and IFHP. Now we start off with PGBP. So when we look at the PGBP chapter, we are targeting 7 marks of question 3B. Right guys, and initially when we work out questions now in this chapter, the first few questions are going to be questions targeting specific concepts, like maybe some questions targeting just section 35, then some questions targeting just appreciation. So initially we will be doing these kind of questions, and then slowly gradually we will move into the full-fledged questions. Okay, we have a lot of questions covering every type that is even possible. So come on, let's begin. Let's start one by one. Let's start off with question number 1. Okay, so the question says, Mr. Barun provided the following information for the assessment at 26-27. They've given us 5 sets of information. Compute the admissible deduction under section 35. So we don't have to compute PGBP and all. We just have to compute section 35 deduction, your scientific research deduction, in the hands of Mr. Barun if he has opted for the old tax regime and he has not opted for the old tax regime. So under both the tax regimes, one by one, we have to compute his section 35 deduction. Okay, so come on, let's begin. Let's make a table. So we'll have 3 columns in a table: particulars, old regime, and new regime. Okay, so come on, let's see the transactions one by one. Look at the first transaction. Purchased machine of 2,50,000 for in-house scientific research. See, in-house scientific research will be allowed under section 35 under both the regimes, old regime and new regime. Only one condition is there, and that is the in-house scientific research should be related to my assessee's business. That's all. Only one condition is there. I'll assume it is relating to assessee's business. So therefore, I will allow it under both the regimes. What is the amount? 2,50,000. I'll allow it under section 35 under both the regimes. Okay. Then comes the second transaction. Purchase land of 5 lakh rupees for in-house scientific research. See, again it is in-house scientific research. In-house scientific research is actually allowed under both the regimes, but there is a problem. Under section 35, there is one exclusion. Land is excluded. Land is ineligible for deduction under section 35. So therefore, there will be no deduction with respect to land. Okay. Then look at the third subdivision. Constructed building of 7,50,000 for in-house scientific research. So again we have in-house scientific research. I'll assume the scientific research is relating to the assessee's business. So in-house scientific research will be allowed under both the regimes. The amount is 7,50,000. I'll allow it under both the regimes. Okay, then building is allowed guys, only land is ineligible. Okay, then comes point number 4, contributed to IIT Delhi for scientific research 64,000. So here we are making a contribution to outsider. Contribution to outsider for scientific research, statistical research, research in social science, this will be allowed. Whether it is relating to assessee's business, whether it is not relating to assessee's business, doesn't matter. It will be allowed. But the catch is, it is allowed only in the old regime. It is not allowed in the new regime. Okay, so what is the amount? See, the amount is 64,000. It will be allowed only and only in the old regime. Okay, I have a small question for you. What if assessee contributed the 64,000 to IIT Delhi, and what if IIT Delhi used the money to buy land then? Doesn't matter, guys. You will still get a deduction under section 35. You know, land is ineligible, we say, right? Only in in-house scientific research, not in contribution to outsider. When you contribute money to outsider, what is the outsider doing with the money? I don't care. Even if the outsider is using the money to buy land, I don't care. Only thing that matters is we made a contribution to outsider for scientific research. That's all. Enjoy the deduction. Even if the outsider is now using the money to buy land, that will not change your answer in any manner. Okay. Then look at the last subdivision. Contributed to Indian Statistical Institute for statistical research, 45,000. Scientific research, statistical research, social science, everything is covered under section 35. So even statistical research will be covered under section 35. Contributed to Indian Statistical Institute, so it's a contribution to outsider. Contribution to outsider will be allowed under the old regime only. Under the new regime, it will not be allowed. That's all, guys. So add up, what's your total section 35 deduction now? Under the old regime, I am getting 11,09,000. Under the new regime, I am getting 10 lakh rupees. Check whether your number and my number matches. Yes, this will be the total deduction under section 35 in this question. Okay, so what were our learnings? Tell me. Learning number 1. When it comes to in-house scientific research, is it allowed under the old regime? Yes. Is it allowed under the new regime? Yes. Should it be related to assessee's business? Yes. What if it is not related to assessee's business? Then in that case, section 35 will not be allowed. Okay. Then what about contribution to outsiders? Is it allowed under the old regime? Yes. Is it allowed under the new regime? No. Then should it be related to assessee's business? Yes. What if it is not related to assessee's business? It's okay. Then also it is allowed. So contribution to outsider, whether related to assessee's business or not, doesn't matter. Both will be allowed. But in-house scientific research has to be related to assessee's business. Okay. And land is ineligible where? Land is ineligible only in in-house scientific research. Land ineligible point will not come into the picture in contribution to outsiders. Got it? This was your question number 1. Full focus on section 35 only, scientific research. Now come on, let's move on to question number 2. Question number 2 is your workbook question, okay? So in question number 2, there are totally 10 transactions, 10 expenses basically. For each of the expense, we have to say whether the expense will be allowed or whether it will not be allowed, okay? Let's begin one by one. The first one, interest on funds borrowed for paying income tax. I'll explain this to you, okay? Let's say assessee has borrowed one loan. Now because he's borrowed a loan, he has to pay interest on this loan, guys. If this loan is being used for the purpose of business or profession, only then this interest will become an expense relating to business or profession, and this interest will be allowed under PGBP. So what's a precondition for interest to be allowed? The precondition is that the loan has to be used for business or profession. But in this question, the loan is being used to pay income tax. Is income tax business or profession? No. Income tax is going to become a personal tax. So if I'm borrowing a loan to pay income tax, I'm borrowing a loan for personal purpose. The loan is not for the purpose of business or profession. So if the loan is not for the purpose of business or profession, interest on that loan will not be allowed under PGBP. So this interest will be not allowed in PGBP computation. Okay. Then come to the second subdivision. Legal charges were paid for registration of trademark. This is going to be allowed under PGBP. Registration of trademark, to register the trademark, whatever legal charges you have incurred will become a business expense and we will allow it in PGBP. Then legal expenses including lawyers' fees for raising loan from financial institution. To raise a loan from financial institution, whatever legal expenses you are incurring, whatever lawyers' charges you are incurring, even that will be allowed. Even this will be a part of your business or profession. Then lump sum paid to an employee in lieu of regular pension. See, the employer is paying pension to the employee. Now, this pension can either be periodical pension or this pension can be lump sum pension. If I think from employer's point of view, whether the pension is periodical pension, whether the pension is lump sum pension doesn't matter. From employer's point of view, it is an expense relating to his business or profession. Therefore, for the employer, it should be allowed in the PGBP computation. So even this will be allowed. They are trying to confuse you by saying it is lump sum. It doesn't matter. Whether it is lump sum pension, whether it is periodical pension, it doesn't matter. Pension is a business expense for the employer. Therefore, it will be allowed for the employer in PGBP computation. Okay. Then comes point number 5. Ex gratia paid to dependents of an employee who died in accident while coming to the factory. Employee died. So because the employee died, the assessee, the employer, is making payment to the dependents of the deceased employee. This is going to be connected to his business or profession only. So basically, see guys, anything which the employer gives or pays to the employee or to his family, like in this case to the dependents, all this will be connected to business or profession and it will be allowed. Okay. Then comes your 6th situation. 70,000 was considered as bad debts. Debtors were declared insolvent, having no asset. So 70,000 bad debts. The amount was, however, not written off as irrecoverable in the accounts of the assessee. See, at this stage, I'll tell you something very important, alright? Pay attention. When it comes to bad debts, see, bad debts will be allowed in the computation of PGBP only if some conditions are fulfilled. Condition number 1, this bad debt should be relating to something which was earlier taxed as income. Like for example, let's say I made a credit sale. So when I make a credit sale, the sale forms part of my income, right? It's a part of your trading in P&L account. So it will form part of your income. Now that debtor who's supposed to make payment to me relating to the sale, he is refusing to make payment to me. So therefore the debtor has gone bad. The debt has gone bad. The debt is relating to a transaction which was earlier taxed as income for me. So the very first condition is that the debt should be earlier considered as income for the assessee. And the second condition is that this debt has to be written off as bad in the books of account of the assessee. But here if you see, it's very clearly mentioned that 70,000 was considered as bad debts, but it was not written off as irrecoverable in the books of accounts. So in the books of accounts, if you don't write it off as bad, then we cannot consider it as bad debts for the purpose of income tax as well. So because it is not written off as irrecoverable in the books, we will not consider it as bad debt and therefore this will not be allowed in your computation of PGBP. You got the point, guys? So the debt is relating to assessee's business. It was earlier considered as income, but it should also be written off as bad in the books of accounts. Here it is not written off as irrecoverable in the books of accounts. So because of this reason, the bad debt will not be allowed under PGBP. Okay. Then come to the 7th transaction. A compensation of 10,000 paid to the party for non-delivery of goods as per the terms of the contract. So here we are paying 10,000 rupees to a party for non-delivery of goods as per terms of the contract. Basically, we did not fulfill the contract properly. So because we did not fulfill the contract properly, we had to pay some compensation. There is a kind of a breach of contract over here. So I'll tell you something, remember till the very end. When I breach a law, okay, like for example, let's say I did not fulfill the Income Tax Act or I did not fulfill the Companies Act. I breached a law. If I breach a law and if I have to pay any fine or penalty, that fine or penalty will not be allowed in my PGBP computation. But here I breached a contract. I did not breach a law. So if I breach a contract, a business contract, for that breach, whatever compensation, whatever damages I have to pay, it will be allowed in the PGBP computation. Only when you breach a law, only then you will say the damages and penalty will not be allowed. Okay, this was your point number 7. Then comes point number 8, 25,000 paid to a creditor in cash in a day. See, you are making payment to a creditor. Why are you making payment to the creditor? Because you would have, of course, purchased goods from the creditor. That is why you are making payment to him. Now, purchase is going to be a business expense. If you are making payment for a business expense, if the payment is more than 10,000 rupees, if you are making the payment of more than 10,000 rupees, payment relating to a business expense, more than 10,000 rupees in a day to a person against one invoice, then make the payment in specified mode only. Which section am I talking about? 40A subsection 3, guys. 40A subsection 3 says if you are incurring a business expense and if you are making payment of that business expense, if it is more than 10,000 rupees in one single day to one single person against one single invoice, then payment has to be made in specified mode only. But my assessee has made the payment over here in what mode? More than 10,000 guys, 25,000, he's made payment in cash. Is cash a specified mode? No, cash is not a specified mode. So therefore this 25,000 will be not allowed. It is more than 10,000. We should have made the payment in specified mode only, like account payee check, account payee bank draft, ECS, or any other electronic payment. Here we made the payment in cash, which is not a specified mode. Therefore, it will not be allowed. Okay. Then come to the ninth point. Interest on capital 27,000 paid to the proprietor of a sole proprietorship business. This is very, very important. It will keep coming again and again in our course of the PGBP chapter. See, I am paying rent to myself. I am paying salary to myself. I am paying interest to myself. All of these are notional expenses. Notional expenses means what? They are imaginary expenses. They are not real expenses. So all these expenses are not allowed in PGBP computation. Okay, this is exactly what has happened in this question, guys. This is sole proprietorship business. Sole proprietorship business means what? One single owner. Me and the business, same only, guys. Same PAN only will be applicable for both of us. So the sole proprietorship business is paying interest on capital to the proprietor. It is as if the proprietor is paying himself interest. So it becomes a notional expense. You are paying interest to your own self. This is going to be disallowed. It will be not allowed in your PGBP computation. And then comes the last point. Penalty of 15,000 paid to customs authority for violation of customs law. Just now only I taught you about this. I told you when you violate a law and because of that violation, if you have to pay any penalty, this penalty will be not allowed in your PGBP computation. Got it, guys? This was the question number 2. Major focus was on expenses, whether the expense will be allowed or not allowed. Alright. Now come on, let's move on to question number 8. It's a very important question. It's an interesting question. It's going to be a combination of 2 chapters, combination of agricultural income and PGBP. Okay, let's begin. The question says Mr. X, he's in the business of growing and manufacturing tea. Come on guys, growing and manufacturing tea in India. Does composite income come to your mind, which we had discussed even in agricultural income chapter? If assessee is in the business of growing and manufacturing tea in India, then the 60-40 ratio will come to your mind, right? The bigger number will be what? Agricultural income or non-agricultural income? The bigger number will be agricultural income and the smaller number will be business income. Able to recall? So assessee is in the business of growing and manufacturing tea. He purchased 15% machinery on 10th April 24, which means he purchased a machinery in 24-25. Last year he purchased the machinery for 10 lakh rupees. He computed depreciation as given below. He needs your comment on his working. So they've shown you what calculation assessee has done. You have to say whether the calculation is correct or not. Okay. So opening WDV on 1st April 24 is 0. Then in 24-25 only now we purchased this asset for 10 lakh rupees. So add asset purchased during the year 10 lakh rupees. So the total is now 10 lakh rupees. Then depreciation for 24-25, 10 lakh rupees into 15% into 40% they have done. Why 40%? Because only 40% business income, no, 60% is agricultural portion. So that is why they have computed depreciation only on the 40%. This is wrong. This is nothing but targeting explanation 7 to section 43 subsection 6. This very clearly says that even if assessee is into this composite business kind of a thing, still depreciation will be computed for the entire amount. That is 10 lakh into 15% will become depreciation. Later when you are computing income, that time you split agricultural and non-agricultural, you split. But when you are computing depreciation, depreciation has to be computed on the entire amount. So 10 lakh into 15% would have been depreciation. You should not multiply by 40% over here. It is wrong. Then they've given opening WDV for 1st April 25. Then depreciation for 25-26. Again they made the mistake. Into 40% they did. And then they gave you opening WDV for the next year. So they're asking us first of all to give comments whether this calculation is correct or not. And then compute his business income for the year, assuming his income before depreciation and without reducing element of agricultural income is 8 lakh rupees. So two things we have to do. We have to first check whether his depreciation is correct or not, then recompute if it is not correct, and then we will compute his business income. They've given us his income before considering depreciation and agricultural elements. It is 8 lakh rupees. Okay, let's begin. Let's do the depreciation discussion first. Let's do the block computation first. So what block are we talking about? Plant and machinery, 15% block. So what is your opening WDV on 1st April 2024? 0. Then add actual cost of assets acquired. So we have acquired one asset in 24-25. We have acquired this machinery. For how much did we acquire the machinery? We acquired the machinery for 10 lakh rupees. When did we acquire it? On 10th April 24. So in 24-25, definitely we've put it to use for at least 180 days. So we will get full year's depreciation. Okay. Then we will subtract monies receivable for assets sold. Did we sell any assets during the year? We did not sell any assets during the year. So what's your closing WDV on 31st March 2025? 10 lakh rupees. Okay, now on this you will compute depreciation. So depreciation is 15%. Question itself has said. So 10 lakh into 15%. So 1,50,000 will be your depreciation for 24-25. Are you understanding? This is a mistake that they had done. They did 10 lakh into 15% into 40%. Why did they do 40%? Because the balance 60% is agricultural income portion, guys. So that is why they did into 40%. That is wrong. When we are computing depreciation, we are supposed to compute the entire depreciation as it is. So 10 lakh into 15%, 1,50,000. So what is now your opening WDV on 1st April 2025? It's going to be 8,50,000. Okay, then same thing. Add actual cost of assets acquired. Have we acquired any assets during the year in 25-26? We have not purchased any asset. Then less money is receivable for assets sold. Have we sold any asset in 25-26? We have not sold any asset. So what is your closing WDV on 31st March 2026? 8,50,000. As it is, guys. Then on this we will calculate depreciation. Depreciation is going to be 8,50,000 into 15%, which will work out to 1,27,500. So your net number, that is your opening WDV for 1st April 2026, will be 7,22,500. So what is the depreciation for the current year now? The depreciation for 25-26, depreciation for the current year is going to be 127,500. Okay, this is the first part of my answer. What you're learning? Your learning is, even though we have composite income, still when we are computing depreciation, we will compute the entire depreciation. Okay, now come on, let's do the PGBP computation. So if I look at the PGBP computation, the question clearly says the business income before depreciation and before reducing agricultural income, his income is 8 lakh rupees. So his income is 8 lakh rupees. From this, I will subtract the depreciation. What's your current year depreciation? 1,27,500. So now what is the net income of your assessee? Net income is going to be 8 lakh minus 127,500, 6,72,500. Okay. Now this income you will split into agricultural income and business income. Right, guys? Now you're understanding. You always find the net income first. You take all the incomes, you subtract all the expenses, you find the net income first. That net income is what you will split into agricultural income and business income. Agricultural income will be 60%, business income will be 40%. So 672,500 into 60%, 4,03,500 will be your agricultural income, and 672,500 into 40%, that is 2,69,000. This will become your business income. The agricultural income portion is going to be fully exempt under section 10(1). The business income portion is going to be taxable. Alright, so learning number 1, when you're computing depreciation, even in composite income cases, you will compute the entire depreciation. Learning number 2, find the net income, subtract all expenses, find the net income. The net income is what you split into agricultural income and business income. Got it? This was question number 8, a combination of agricultural income and PGBP chapter. Now come on, let's start with question number 10. This is like a full-fledged depreciation based question. Your normal depreciation, additional depreciation, a lot of things will get covered for you over here. Let's read the question. The question says an industrial undertaking which commenced manufacturing activity. Assessee is a manufacturer. Therefore, additional depreciation will come to your mind. So assessee is a manufacturer. He commenced the manufacturing activity with effect from 1st September 25. So current year only we started our business. He has acquired the following assets during 25-26. So all these assets are new assets acquired in the current year only, which means opening WDV will naturally be 0 only because all the assets are acquired in the current year. So we have factory building. Factory building will be 10% block, guys. Then we have plant and machinery. We have machinery A, B, C, D, E, F, motor car. So all of these machineries will come under the 15% plant and machinery bucket. Then we have air conditioner installed in office. Even this is going to come under 15% plant and machinery category. Air conditioner is also plant and machinery, guys. General plant and machinery 15%. So totally 2 blocks we will be having. We will be having a factory building block 10% depreciation rate, and we will be having plant and machinery block 15% depreciation rate. Okay. So compute depreciation allowable for assessment at 26-27 and WDV as on 1st April 26. So the factory building part we'll handle it later. First, let's focus on just the plant and machinery block. So we're talking about block 1. Block 1 is plant and machinery, depreciation rate 15% plant and machinery. Okay, so let's keep this in your mind and let's begin. What's the opening WDV? Opening WDV will be 0 only. Why? Because we are starting business in the current year only. We are purchasing assets in the current year only. We don't have any opening WDV of the last year. Okay, then actual cost of assets acquired, here we'll put them one by one. Factory building will not enter this block because this is plant and machinery block. So we have machinery A. Machinery A will enter into the block. We purchased it for how much? We purchased it for 2 lakh rupees. Now please check. Will I get additional depreciation for machinery A? Yes, guys, it is plant and machinery. It is new plant and machinery. Assessee is a manufacturer. And let's say we're doing the computation as per the old regime over here. So we will get additional depreciation. How much additional depreciation? See, the asset was acquired on 5th May 25, put to use on 1st September 25. So definitely put to use for at least 180 days. So full 20% additional depreciation I will get. Understanding? So this asset was put to use for at least 180 days and I will get additional depreciation, 20% additional depreciation I will get. Like this we will check for each asset. Okay. Then come to machinery B. So this was acquired on 7th June 25, put to use on 1st September 25. We bother about put to use, right? We bother about the date on which the asset was put to use. If it is put to use on 1st September 25, definitely it is put to use for at least 180 days. And even over here it is plant and machinery, new plant and machinery. Assessee is a manufacturer. Assessee is following the old regime. So here also I will get additional depreciation, full 20%. The value of the asset was 5 lakh rupees. Okay, this was machinery B. Then comes machinery C. Machinery C was acquired on 30th August 25, put to use on 1st September 25. So 1st September 25, even this is going to be at least 180 days. Okay, even here I'll get additional depreciation, guys. Full 20% I'll get. The amount is how much? The amount is 10 lakh rupees. Okay, this is also done. Then we have machinery D. Machinery D, this was acquired when? On 1st September 25. This one was put to use on 31st October 25. Which means this one was put to use for less than 180 days, guys. 31st October 25 will definitely be less than 180 days. And so therefore, we will get half year's depreciation only. Additional depreciation also half only, you will get 10%. But don't worry, assessee, balance 10% additional depreciation you can enjoy in the next year. So what's the value of machinery D? 4 lakh rupees. Okay, be careful, this was less than 180 days. Then we have machinery E. Now this one was purchased on 1st Jan 26 and it was put to use on 28 February 26. So therefore even this is definitely put to use for less than 180 days. Here also you will get half year's depreciation. Even additional depreciation half only, you will get 10%. The cost of the asset is 3 lakh rupees. Okay. Then comes machinery F. Second hand machinery this is. Machinery F, I purchased it on 11th Jan 26. I put it to use on 13th Jan 26. Again, this asset is put to use for less than 180 days. Now here tell me, will you get additional depreciation? No, right? See, for plant and machinery, you can enjoy additional depreciation, but it should be new plant and machinery. This is second hand plant and machinery. For second hand plant and machinery, there will be no additional depreciation. The amount is 2 lakh rupees. Okay, then we have motor car. See, first of all, will motor car come inside this block? Yes, it is plant and machinery. It is general 15% plant and machinery. So even motor car will come under this block. It was purchased on 1st February 26, put to use on 1st February 26. So even this was put to use for less than 180 days. So therefore you will get only half year's depreciation. But tell me, will I get additional depreciation over here? See, listen to me. If it is second-hand plant and machinery, or if it is ship, or if it is aircraft, or if it is road transport vehicle, or if it is an asset which is being used in the office or in the guest house, or if it is an asset which is already fully debited to P&L, in these cases and all, we don't allow additional depreciation. Here it is motor car. It's a road transport vehicle. For road transport vehicle, there is no additional depreciation. Road transport vehicle, ship, aircraft, no additional depreciation. So 5 lakh rupees, this is the cost of the asset. Okay, this is also done. So machinery F and then car. Then what about AC? Even AC will come under plant and machinery. General plant and machinery 15% only. So even that will fall under this block. AC acquired on 1st February 26, put to use on 2nd February 26. So even this is put to use for less than 180 days. Here the question is saying it is installed in the office. Will you get additional depreciation, guys? See, you will get additional depreciation only if the asset is installed in the factory premises. If the asset is installed in the office or in the guest house, then there will be no additional depreciation. This AC is installed in office, therefore no additional depreciation. Same AC, had it been installed in the factory, I would have enjoyed additional depreciation. But here, because it is installed in the office, there will be no additional depreciation. What is the cost of the asset? 1 lakh rupees. Okay, this is your AC point here. So with this, all the plant and machineries we are done. Okay, now let's continue. Do we have any monies receivable for assets sold? We read the whole question. We did not sell away any asset. So first add up and tell me what's a closing WDV at the end of the year. I'm getting 32 lakhs. Please check whether your number and my number matches. Now see, always remember, once we're done with the closing WDV, remember this format, okay? It will make things a little easier for you. This WDV we always split into 3 parts. WDV which is put to use for 0 days, WDV which is put to use for less than 180 days, and balance WDV. I'll give you one small tip over here. The 0 days, put to use for 0 days and put to use for less than 180 days, both of these numbers you will get from this add actual cost of assets acquired step. Both of these numbers you will get from the addition step, okay, the new assets step. So tell me, in this entire list of new assets, do we have any asset which was put to use for 0 days? No, guys. Some assets were put to use for at least 180 days. Some assets were put to use for less than 180 days. Do we have any asset which is not even put to use? No. So WDV put to use for 0 days is 0. Then what's a WDV which is put to use for less than 180 days? What did I tell you? No confusion. Both of these numbers you will get from this new assets step. So in this step, tell me, do you have any asset which was put to use for less than 180 days? Yes. Less than 180, less than 180, less than 180, less than 180, less than 180. So we have 5 assets which are put to use for less than 180 days. Come on, add them up. These 5 assets. 4 lakh plus 3 lakh plus 2 lakh plus 5 lakhs plus 1 lakh. So assets put to use for less than 180 days is totally 15 lakh rupees. Now on this 15 lakhs you have to find normal depreciation and additional depreciation first. So what will your normal depreciation be? 15 lakhs into 15%. Now this category is put to use for less than 180 days. No. So here you will get only half year's depreciation. So 15 lakh into 15% divided by 2. This is going to be 1,12,500. Okay. Then on this 15 lakhs, on this part, tell me the additional depreciation. See, be careful. Will I get additional depreciation for every asset? No. We have put additional depreciation for only 2 assets over here. So 4 lakh and 3 lakh. Only on this 7 lakh only we will get additional depreciation. Rate also we have already decided 10% additional depreciation. So 7 lakh into 10%. You understood how we got 10%. Additional depreciation is generally 20%, but these assets were put to use for less than 180 days. Therefore, only half I am getting, which is 10%. But don't worry, SSC, balance 10% you can enjoy in the next year. This is going to be 70,000. Getting the point? See, till closing WDV, I am confident that you are confident. After that, what did I do? The closing WDV number, I will split into 3 parts. WDV which is put to use for 0 days, WDV which is put to use for less than 180 days, and balance WDV. The 0 days and less than 180 days, both of these numbers I will get from where? From this new asset step. So here 0 days was nothing, less than 180 days I had 5 assets. So on those 5 assets I found normal depreciation. Out of those 5 assets, only for 2 assets additional depreciation was eligible. So we claimed additional depreciation for those 2 assets. Okay. Now tell me, what is a balance WDV? Balance WDV means what? What's your total WDV? 32 lakhs. 32 lakhs minus 0 minus 15 lakhs. So what's your balance WDV? Understanding, this 32 lakhs is what you're splitting into 3 parts. 0 days, less than 180 days, and balance. So what's the balance now? 32 lakhs minus 0 minus 15 lakhs. The balance is going to be 17 lakh rupees. Now on this balance WDV, you will have to find depreciation. Again, same thing, we will have normal depreciation also. We will have additional depreciation also. What's the normal depreciation? Calculate 17 lakhs into 15%. Here I'll get depreciation for the entire year. On full 15% I will enjoy the depreciation. So 17 lakh into 15%, 2,55,000 is your depreciation, normal depreciation. And what will your additional depreciation be? See, basically you're left with these assets, right? So here additional depreciation 20% you're having for 3 assets. So 2 lakh, 5 lakh and 10 lakh, total 17 lakhs. On 17 lakh, 20% you have to claim. Understood what I did? See, when I'm coming to balance WDV 17 lakhs. On that I claim normal depreciation. Now out of these assets, for these 2 assets I have already claimed additional depreciation. These 3 assets I am still left with additional depreciation. This I will claim now. So total is 17 lakhs. On the 17 lakhs, 20% depreciation. So 17 lakhs into 20%, that's going to be 3,45,000. So 4 numbers we have for depreciation. If you add up these 4 numbers, what's your total depreciation for this plant and machinery block? Your total depreciation is 7,77,500. So now give me what's the opening WDV for the next year. Opening WDV for the next year will be 32 lakhs minus 7,77,500, which is 24,22,500. So when it comes to this 15% plant and machinery block, now what is your total depreciation? Your total depreciation is 7,77,500. Understood? This is like your full-fledged depreciation question. You understood, right? Whenever we purchase a new asset, we always check for 2 things. Did I put the asset to use for at least 180 days or not? Will I get additional depreciation or not? Then the closing WDV number, I will split into 3 parts. 0 days, less than 180 days, and balance WDV. 0 days and less than 180 days, both these numbers I will take from my new asset step. Okay, whatever asset is put to use for 0 days, on that asset there will be no depreciation. Whatever asset is put to use for less than 180 days, on that I will get only half year's depreciation. Balance WDV I will get full year's depreciation. So with this I'll find the total depreciation, which over here is 7,77,500. So your closing WDV minus your depreciation, I will now get my opening WDV. Alright, so with this we're done with our plant and machinery block. Now let's redo the same thing for the factory building block. One more asset we are left with, right? Factory building, 10% building block. Let's start with this now. So I'll call this as my block 2, building block, 10% depreciation. Opening WDV even over here will be 0 only. Then actual cost of assets acquired, one new asset we are acquiring, which is factory building. We are acquiring it for how much? For 50 lakhs. I told you, whenever you purchase a new asset, you always check for 2 things. Was it put to use for at least 180 days? It was put to use on 1st September 25 itself. So definitely it is put to use for at least 180 days. And will you get additional depreciation, guys? Additional depreciation is only for plant and machinery. This is building. So building will not have any additional depreciation. Okay. Then money is receivable for assets sold. We did not sell any asset during the year. So therefore this 50 lakhs as it is will become your closing WDV. Now this closing WDV you will split into 3 parts. 0 days, less than 180 days, and balance WDV. Same dialogue, guys. 0 days and less than 180 days. Both of these you will get from where? From your new asset step. In new asset step, do you have any asset which is put to use for 0 days? No. Do you have any asset which is put to use for less than 180 days? No. So what's your balance WDV now? Your entire WDV will come under balance WDV only. Nothing is 0 days, nothing is less than 180 days. So entire amount will come under balance WDV. Now on this, tell me what will be your normal depreciation. Your normal depreciation will be 50 lakh into 10%. Full year's depreciation I will get, guys. Only if the asset is put to use for less than 180 days, then only I will get half year's depreciation. Here I will get full year's depreciation, which will be 5 lakh rupees. And what about additional depreciation? No additional depreciation, we already concluded, because additional depreciation is only for plant and machinery. This is building, so there will be no additional depreciation. So what is your total depreciation now? Your total depreciation is only one number, which is 5 lakh rupees. So what is your opening WDV for the next year now? Your opening WDV for the next year will be 45 lakh rupees. Okay, so for this building block, my total depreciation is 5 lakh rupees. They're asking us compute the depreciation allowable. So if I have to give my summary now, what's the total depreciation? For the plant and machinery 15% block, there the total depreciation was 7,77,500. 7,77,500. And for this building block, this 10% building block, your total depreciation is 5 lakh rupees. So the total depreciation for the assessee will be 12,77,500. This is what will be allowed in PGBP computation. This is your final summary. Alright, this was question number 10, proper depreciation question. Now come on guys, come to question number 11. This is where we will be taking up the SLM basis of depreciation. Okay. See, if assessee is in the business of generating power, or if assessee is in the business of generating and distributing power, then such assessees can claim depreciation on SLM basis. Okay. Now in SLM depreciation, we have this concept of terminal depreciation. We have this concept of balancing charge. Everything will get taken care of through this question number 11. Let's properly read the question and we'll work it out. Important Limited is a power generating unit. So this company is in the business of generating power. Therefore, yes, SLM basis will be possible for this entity. So on 1st April 23, 1st April 23 means in previous year 23-24, so 2 years back, it purchased a plant for 50 lakh rupees, eligible for depreciation at 15% on SLM basis. Okay, 15% depreciation rate, SLM basis, 50 lakh rupees asset was purchased. Compute balancing charge or terminal depreciation assuming plant is sold on 21st April 25. So in current year 25-26, we're selling the asset for 4 different values. So we will have 4 different situations over here. Each situation we have to compute balancing charge or terminal depreciation as the case may be. Okay. Let's begin. Look at the very first situation. In the first situation, I'm selling the asset for 7,50,000. Okay, I'll tell you how to compute. We'll go step by step. My first part of my answer will be to find the WDV of the asset. See, we purchased the asset for how much? On 1st April 2023, we purchased the asset for 50 lakh rupees. So this is the actual cost of the asset. Now from this, I will subtract depreciation. On SLM basis, we will subtract depreciation, guys. But for how many years? See, we'll subtract depreciation for 23-24 and for 24-25. That's all. We will subtract depreciation only for 2 years. Why not 25-26? See, in 25-26, I am selling away the asset. The year in which you sell the asset, in that year, you will not claim depreciation. Okay. So I will get depreciation for 2 years over here. So 50 lakh rupees is the cost of the asset. The depreciation rate is 15% and I need depreciation for 2 years. So therefore, what will be the total depreciation under SLM basis for this asset? The total depreciation will be 15 lakh rupees. Okay, so what is going to be the opening WDV of this asset on 1st April 2025? Current year 25-26. In 25-26 only I've sold the asset, right? In 25-26, what will be the opening WDV? 35 lakhs. Now, doesn't matter at what price you sold the asset. This part will remain the same. Here there is no change, right guys? So we purchased the asset for 50 lakh rupees. For 2 years we claim depreciation on SLM basis. So current year we sold the asset. Current year before we sell the asset, opening WDV is 35 lakhs. Now we will take the 4 situations one by one. Okay. Look at the very first situation first. In the first situation, I'm selling away the asset for 7,50,000. The WDV is 35 lakhs. I'm selling it for 7,50,000. Definitely I've sold it for a loss. So come on, think from accounting point of view. WDV of the asset is 35 lakhs and your selling price is 7 lakh 50. So when your selling price is less than WDV, you definitely sold at a loss, right? So what is the loss? What is the difference? 35 lakh minus 7 lakh 50, the difference will be 27 lakh 50,000. Accounting point of view, if you see this 27 lakh 50, you will call it as terminal depreciation. Okay, so whenever the selling price is less than the WDV, in those cases, the difference between these two numbers becomes your terminal depreciation. Alright guys, this is your first situation, situation A. Then comes the second situation. This time we sold the asset for 30 lakh rupees. So come on, again let's calculate. The WDV is how much? 35 lakh rupees. This time the selling price happens to be 30 lakh rupees. This time also the selling price is less than WDV. So whenever the selling price is less than WDV, in those cases the difference between these two numbers, what is the difference over here? 5 lakh rupees is a difference, right? This 5 lakh rupees difference, same thing, you will call it as terminal depreciation. And by the way, what will you do with this terminal depreciation? This terminal depreciation will be allowed in PGBP computation. What do you do with depreciation? You debit it in your P&L account, right? You allow it in your PGBP, right? Same thing you will do even over here. Okay, so first situation, you have terminal depreciation of 2,75,000. Second situation, you have terminal depreciation of 5 lakh rupees. Now comes your third situation. In the third situation also, WDV stays the same. WDV is 35 lakh rupees, but this time we sold the asset for 45 lakh rupees, which means we sold the asset for above WDV. This time our selling price is 45 lakh rupees. Okay, now see what is the difference. The difference is going to be 10 lakh rupees. Are you getting the situation? This time your selling price is more than your WDV number. Now listen to me very carefully. Whatever is a difference, you will split this difference into two parts. One part will be capital gains, other part will be balancing charge. Are you listening? See, why am I doing like this? In the first two situations, my selling price was less than WDV. So in these two situations, whatever was this difference, we simply called this difference as terminal depreciation and we kept moving on. But in my third situation, my selling price is more than WDV. So when selling price is more than WDV, you will find the difference. The difference will go into two places. It will go into capital gains and it will go into balancing charge. Balancing charge will be taxed for you under the PGBP head. Basically, balancing charge will be treated like business income. Okay. Now, first you will always do capital gains, then only you will come to balancing charge. Remember the sequence. Okay. Now tell me, what is the real cost of the asset? The real cost, long back when you purchased the asset, you purchased it for 50 lakh rupees. Tell me, is the selling price even more than the cost? No. Selling price is 45 lakh rupees, cost is 50 lakh rupees. Is the selling price even more than the cost? No. See, if the selling price is more than the cost, that difference becomes your capital gains. So capital gains is nothing but the selling price minus the cost price. That becomes your capital gains. But your selling price is 45 lakhs and actual cost is 50 lakhs. So is your selling price more than the cost? No. So therefore you will not have capital gains. So now whatever is this 10 lakh rupees, this entire 10 lakh rupees will become balancing charge. And what will you do with this balancing charge? It will be taxed for you under the PGBP head. So in my fourth situation, I will have balancing charge. How much balancing charge will I have? 10 lakh rupees. This balancing charge will be taxed under the PGBP head. We will treat it as if it is business income. You understood? So if selling price is more than WDV, we will first see is selling price even more than the cost price. If it is even more than the cost price, then the difference between selling price and cost price becomes capital gains. But here it is not more than the cost price. So therefore the entire gain will become balancing charge. Okay. Now come to the fourth situation, the last situation. This time WDV is same 35 lakhs, but this time selling price is 55 lakhs. So again, what is the situation? The selling price is again more than your WDV number. So therefore, same like what we did in the third situation, we will find the difference and that difference we will split into two parts. So what's the difference over here? The difference is 20 lakh rupees. This difference we will split into two parts. One part of it will be capital gains and the second part will be balancing charge. Whatever is your balancing charge, this will be taxed for you under the head PGBP as if it is your business income. Okay. First, out of the two, which of the two will you do first? Capital gains first, then balancing charge. But when will you have capital capital gains. Only if your selling price is even more than your cost price, only then that difference becomes your capital gains. Tell me, selling price is how much? 55 lakhs. Cost price is how much? 50 lakhs. Is selling price more than the cost price? Yes. So the difference between selling price and cost price, that is 55 lakh minus 50 lakhs, this difference of 5 lakhs will become your capital gains. So what is your balance income now? 20 lakh minus 5 lakhs, the balance of 15 lakhs. This becomes your balancing charge, which will be taxed under the PGBP head. They are asking us for terminal depreciation and balancing charge only. So in my fourth situation, if you see, again selling price is more than the WDV number. So this time my balancing charge is how much? 15 lakh rupees. Got it? This was question number 11. So simple, if selling price is less than WDV, in that case whatever is the difference is terminal depreciation, story over. But if selling price is more than WDV, then whatever is the difference will go into two places. Number one, capital gains, and number two, balancing charge. But you will have capital gains only if selling price is more than the cost price. Easy, guys. Now come on, let's move on to question number 12. Question number 12 says, Dr. R purchased a house property on 1st December 2023 for 10 lakh rupees. So long back in 23-24, he purchased a house property for 10 lakh rupees. Till 1st December 25, the same was self-occupied as residence. On this date, the building was brought into use for the purpose of his medical profession. What would be the depreciation allowable for assessment at 26-27? What is the situation? On 1st December 2023, we purchased one asset. In previous year, 23-24, we purchased an asset. Which asset? It is building. It's a house property. We were using this asset for our personal purposes. We were self-occupying the property for residence. So therefore, on this asset, there will of course be no depreciation, guys, because I'm using the asset for my personal purposes. Only when I use the asset for my business or for my profession, only then you will give me depreciation. But here the asset is being used for residence. It is being used for personal purposes. Therefore, there was no depreciation. Okay. Then later, on 1st December 2025, that is in previous year 25-26, in this year, that same building, we started using it for our medical profession. We started using this building for our business or profession in 25-26. So because now we are using it for our business or profession, now you have to give me depreciation, guys. Now see, earlier when I had an asset, I was using the asset for my personal purposes. There was no depreciation. That same asset, when I bring it into my business or profession, now I will get depreciation. In this scenario, how will your answer be? It all depends upon what is the asset. If the asset happens to be a building, then in that case the deemed depreciation concept will come into the picture. Don't worry, I will show you all that in this question. If the asset happens to be any other asset, then in that case the deemed depreciation concept will not come into the picture. What is this deemed depreciation concept? What is this other asset? We will see everything. This building part we will see in question number 12, and then we will see this other asset part in question number 14. So no tension, both the aspects will get covered for you. But situation you understood, right? The situation is, earlier when I had the asset, I was using the asset for my personal purposes. So earlier you were not giving me depreciation. Now that same asset I am bringing for my business or profession, therefore now you will give me depreciation. So in this case you have to see what the asset is. Over here in this question, it is building. So if it is building, I will apply deemed depreciation concept. What does it mean? What deemed? The word deemed means what? Imaginary. See, in reality, 23, 24, 24, 25, in reality, did you enjoy depreciation? No, in reality, you did not enjoy depreciation because the asset was being used for personal purposes. You did not enjoy depreciation. But I want you to imagine. I want you to assume. I want you to make a deemed depreciation provision. I want you to imagine what if from the beginning depreciation was claimed. What if from the beginning it was used for business or profession? Then how would the situation be? We have to imagine. Okay, so in that case, see, we purchased the asset when? On 1st December 2023, we purchased the asset. We purchased the asset for how much? For 10 lakh rupees. So in reality, 23, 24 and all, I do not enjoy depreciation because I was using the asset for my personal purposes. So in reality, I did not enjoy depreciation. But we are imagining, we are deeming, we are assuming what if my assessee had used the asset for a business or profession. Then how much depreciation assessee would have enjoyed. So in 23, 24, how much depreciation would the assessee have enjoyed had he enjoyed depreciation? 10 lakh rupees into building, depreciation rate is 10%. Then we had purchased the asset on 1st December 23. If I say put to use on 1st December 23, definitely put to use for less than 180 days, guys. So only half year's depreciation for 23-24. How much will this be? 10 lakh into 10% divided by 2. This is going to be 50,000 rupees. Once again, I'm asking you, in reality, in 23-24, did we enjoy this much depreciation? No, we were using the asset for personal purposes, guys. In reality, no depreciation. I am just imagining that what if from the beginning it was used for business or profession. That is why all these are deemed depreciation numbers. Okay, so tell me, on 1st April 2024, what's the opening WDV? 9,50,000, guys. Now, what's the depreciation for previous year? 24-25. The depreciation will be 9,50,000 into 10%. Again, same question I'm asking you. In 24-25, really you claimed this much depreciation? No, we were using the asset for personal purposes. In reality, we did not claim depreciation. We're just imagining deemed depreciation. So had we claimed depreciation, how much we would have claimed? 95,000 we would have claimed in 24-25. So my WDV on 1st April 2025 will be how much? 9,50,000 minus 95,000. It will be 8,55,000. Okay. Then previous year 25-26, what will be the depreciation? This is the current year. Current year is when we start using the asset for business or profession. So 23-24, 24-25, both of these depreciations are deemed depreciations, which means imaginary depreciation. But 25-26, really we are using the asset for business or profession. So 25-26 depreciation will be real depreciation. This is how much will actually be allowed for you. So 8,55,000 into 10%, that is 85,500. This will be a real depreciation for 25-26. So what is your opening WDV for 1st April 2026? It will be 7,69,500. So in question number 12, they are asking you what would be the depreciation allowable for 26-27. What's your answer now? What's the depreciation allowable for 26-27 assessment year? 85,500 rupees. Got it? So this is going to be a real depreciation for 25-26. Understood? So asset was building. So because it was building, we applied the deemed depreciation concept. 23-24 and 24-25, imaginary depreciation only we gave. 25-26, it is real depreciation of 85,500 rupees. Okay. This was question number 12. Now same story, same situation as it is. Only thing that will change is in question number 14, instead of building, it will be car. That's all. Otherwise, everything else will stay the same. Read the question with me. A car was purchased by S on 10th August 2021, which is previous year 21-22. So long back he purchased a car for 3,25,000 rupees. He purchased this car for personal purpose. So because he was using the car for personal purpose, you will not enjoy any depreciation, guys. Now that same car is brought into the business of the assessee on 1st December 2025 when its market value is 1,50,000. So market value 1,50,000. Okay. Compute the actual cost of the car and the amount of depreciation for assessment at 26-27, assuming rate of depreciation to be 15%. So first get the story right. On 10th August 2021, we purchased the car. We purchased the car for how much? For 3,25,000 rupees. We purchased the car, but we were using this car for personal purposes. Therefore, we were not enjoying any depreciation. But however, in my current year, on 1st December 2025, I brought the same car into my business or profession. So therefore, now in previous year 25-26, in my current year, I will get depreciation. But here tell me, will you apply the deemed depreciation concept? No, I told you very clearly the deemed depreciation concept will come into the picture only if the asset is building. Here asset is car. For any other asset, deemed depreciation concept will not come into the picture. So what will be the actual cost that will enter into the block? Long back when I purchased the car, I purchased it for how much? 3,25,000, right? That itself will enter into the block. Okay, no doubt it is historical cost. No doubt this 3,25,000 is something we incurred long back in 21-22, and right now in 25-26 value will be much lesser, no doubt. But still doesn't matter. Long back when I purchased the car, for how much I purchased the car, that only will enter into the block. Understanding what is the market value of the asset doesn't matter. All that doesn't matter. Long back when I purchased the asset, for how much I purchased the asset, that only will enter into the block. Now on this number, we will calculate depreciation for current year. Current year you will get depreciation because current year you're using the car for business or profession. So current year you will get depreciation. This is the number that will enter into the block. So 3,25,000 into 15%, which is 48,750. This will be the depreciation for the current year. Now some of you will think that, ma'am, in current year the asset is put to use only on 1st December 25, so give only half year's depreciation. No guys, see, we think about at least 180 days only if the asset is put to use in the same year in which the asset is acquired. In the same year in which asset is acquired, in that year itself if I put the asset to use, then only you check whether asset is put to use for 180 days or not. Here if you see, asset is acquired long back in 21-22. It is put to use for business purposes only in 25-26. So they are two different years. When they are two different years, when the year of acquisition and the year of put to use are two different years, then you don't care about 180 days. You get it? Only if assessee had put the asset to use in the same year in which assessee had acquired the asset, then only you will check, was it put to use for 180 days or not, or put to use for less than 180 days, give half year's depreciation only. All the dialogue will come into the picture only if the asset is put to use in the same year in which assessee had acquired the asset. Here acquisition happened in 21-22, but assessee has put the asset to use only in 25-26. Two different years are involved over here. Therefore, we will not even think about the 180 days criteria. Okay, this was your question number 14. Now come to question number 15. Question number 15 is again a depreciation related question, but here there's one small point which will get tested for you about mode of payment. Read the question with me first, you'll understand. The question says compute depreciation under section 32 for assessment at 26-27 from the following information. WDV of plant and machinery on 1st April 25 is 10 lakh rupees. So this becomes my opening WDV guys. Then plant D was acquired on 10th July 25 for 5 lakh rupees. So new asset was purchased on 10th July 25 for 5 lakh rupees, plant D. Then 1 lakh, now for this 5 lakh rupees, how did we make the payment? 1 lakh rupees was paid in cash to the vendor and the balance amount was paid through account pay check. Plant was put to use on the same day. So we purchased a plant for 5 lakh rupees. Out of that 5 lakh rupees, 1 lakh we paid in cash and the balance 4 lakhs we paid by account pay check. Then the question says, assessee is engaged in the business of manufacturing of industrial paints and has opted for the old tax regime. They're asking us to compute depreciation. Let's start the usual computation process first. What is the information given to us? What is the opening WDV in the beginning of the year? It is 10 lakh rupees. Then did we purchase any new asset during the year? Yes guys, we purchased plant D. We purchased it for how much? For 5 lakh rupees. Now wait, whenever we purchase a new asset, remember what I've told you. Whenever a new asset enters into the block, how many things do you think about? Two things you think about. Number one, was it put to use for at least 180 days? See, this asset was purchased on 10th July 25 and put to use on the same day. Definitely this is put to use for at least 180 days. Now, will I get additional depreciation? Assessee is a manufacturer. We're talking about plant and machinery. Old tax regime, not the new tax regime. Conditions are fulfilled. I will get additional depreciation. How much? Full 20% I will get guys. Now tell me how much amount will enter into the block. See how much did we pay for the asset? 5 lakh rupees is the cost. But in that 5 lakh rupees, 1 lakh we have paid in cash. Always remember, whenever you are making the payment for the asset, if you are making the payment for the asset more than 10,000 rupees, this payment has to be in specified mode only. But assessee has made the payment of 1 lakh rupees, which is more than 10,000 rupees in cash. In simple words, more than 10,000 rupees, assessee has made the payment in non-specified mode. Therefore, this 1 lakh will not enter into the block. The balance 4 lakh rupees assessee has paid through account pay check, which is a specified mode. So that balance 4 lakh will enter into the block, but the 1 lakh will not enter into the block. The whole reason why I'm doing this question is just to point this thing to you, that whenever you purchase an asset, now when you make payment for the asset, if you're making payment more than 10,000, you have to make the payment in specified mode only. Okay. Here for 4 lakh rupees, for the balance only, we have made the payment in specified mode. That only will enter into the block. 1 lakh rupees which we paid in cash will not enter into the block. Then money is receivable for asset sold. We read the whole question. Did we sell any asset? We did not sell any asset. So what's our closing WDV at the end of the year? 14 lakh rupees. This closing WDV we will split into 3 parts. First of all, WDV which is put to use for 0 days. Now I told you WDV 0 days and WDV less than 180 days. Remember, both of this I will get from this new asset step. In this new asset step, do we have anything which is put to use for 0 days? Do we have anything which is put to use for less than 180 days? No. We have only one asset that also is put to use for at least 180 days. So 0 days is nothing. Less than 180 days is also nothing. So my entire WDV will become balance WDV, guys. My WDV is 14 lakhs, fully will come under balance WDV. Now on this, calculate normal depreciation. So normal depreciation will be 14 lakh into 15%. That will be how much? That will be 2,10,000 rupees. And what about the additional depreciation? Be careful. Additional depreciation, we have already done the thinking. I will get 20% additional depreciation on this 4 lakh rupees. What silly mistake is possible? Many students will start calculating additional depreciation on this 14 lakhs. Blunder that will be wrong. We have made things easy for ourselves. Where have we written additional depreciation? We've written here no. So on what amount you will give additional depreciation? On 4 lakhs, 20%. Okay. So my additional depreciation will be 4 lakh into 20%, which is 80,000 rupees. So therefore, now what will be your total depreciation? Total depreciation will be 2,10,000 plus 80,000 rupees, which is 2,80,000 rupees. So opening WDV for the next year will be 11,20,000 rupees. Got it? So this is what they were asking, depreciation under section 32. So my final answer, depreciation under section 32 is going to be 2,80,000 rupees, which includes both normal depreciation and additional depreciation. Sorry. It should be 2,90,000. 2,10,000 plus 80, it should be 2,90,000. Got it, guys? So I'll write it again. 2,90,000. Okay, this was your question number 15. So that's it, guys. With this, I think we're good to close this session. In the next session, we will start with question number 18. Question number 18 will be all about scientific research asset, sale of scientific research asset. Then question number 19, 20, 21. 3 questions we will see relating to telecom license. Then question number 22 will be relating to section 35D, preliminary expenses. So all of these questions we will see in our next session. Thank you, guys. Bye-bye. Hello champions, so we're starting off our second session on our PGBP chapter. We're going to start off with question number 18 directly. But before we start the question, 1 minute, there are 2 concepts I want to discuss with you about, and then we will start the question. Okay, concept number 1. See, I purchased one scientific research asset for in-house scientific research, of course. So because I spent money on in-house scientific research, when I purchase the asset, you will give me deduction under section 35, guys. Now later, what happens when I sell away the same scientific research asset? That is my first concept. That is nothing but sale of scientific research asset. When I purchase the asset, I enjoy deduction under section 35. Now I am selling away that asset. So when you sell away the asset, you will check. There are 2 possibilities. Possibility number 1, you directly sold the asset. Directly you sold the asset means you are not putting the asset into some other use. You used it for scientific research, the work got over and you directly sold the asset. The second situation is that you put the asset into some other use and then only you sold the asset. Okay, so when you directly sell the asset, what happens is, life is simple over here. There will be tax implications under 2 heads of income. You will have tax implications under the PGBP head of income and under the capital gains head of income. Under PGBP, whatever is the selling price at which you're selling away the asset now, or section 35 deduction. Long back when you purchased the asset, you would have enjoyed deduction under section 35. So the selling price or section 35 deduction, whichever is lesser, will be taxable for you under the PGBP head. Okay, then you will have normal usual capital gains calculation. Only thing is, see, generally in capital gains calculation we can have a loss, but in this situation, in your capital gains calculation, by chance you have a loss, you will ignore the loss. Okay, so if you have a scientific research asset and if you sell away the scientific research asset, then what happens? In that case, we decided that first we will check that did we directly sell away the asset or did we put the asset into some other use. If you directly sell away the asset, then there will be tax implications for you under 2 heads of income, under PGBP head of income and capital gains head of income. Okay, now what if I put the asset into some other use? If I put the asset into some other use, then in that case, the asset will first of all enter into the block. See, as soon as I put the asset into some other use, immediately it will enter into the depreciation block. It will enter into your WDV block But the catch is that it will enter into the block at zero value. Okay, now it is a part of the block. So now whenever you sell away the asset, whatever happens whenever you sell a usual depreciable asset, whenever an asset is in the block and when you sell away the asset, whatever happens, usual tax implications will come into the picture. Getting my point? So if I put the asset into some other use, it will enter into the block at zero value, and then later when you sell away the asset, at that point, whenever you sell away a depreciable asset, whatever you do, the usual block tax implications will come into the picture, which I will explain to you in just a little while, in just 2 minutes. Getting the point? The point is clear. So your starting point will be to check whether we directly sold the asset or did we put the asset into some other use. Directly sale of the asset is more important. I hope you've understood this part. Other use is simple. When you put it into other use, it will enter into the block at zero value. Now it is a part of the block. So now after this, later whenever you sell away the asset, then what will happen? An asset is in the block. When an asset is in the block, whatever happens when you sell away the asset, same implications will come into the picture even over here. Now what are those implications? That's your second concept. The second concept is you have a depreciable asset. This depreciable asset is a part of your block, and this depreciable asset, which is a part of your block, you have sold this depreciable asset. That is what has happened even over here, right? Your asset is now a part of the block and now you're selling away the asset. So whenever an asset is in your block and you sell the asset, what happens? You will straight away follow this flow chart, guys. You will check whether the block is empty or whether the block is not empty. Now what does this mean? See, block is empty means I'm having two assets in the block, let's say A and B, and we sold away both the assets. Now block is empty. Block is not empty means we had two assets in the block A and B. We sold one asset, we are still having some assets. So block is not empty. Now if the block is empty, apply logic. Block itself is empty. Will you still calculate depreciation? Come on, there is no asset in the block. So there is no question of depreciation, guys. So if my block is empty, then in that case, there will be no depreciation. Straight away, you will have capital gains calculation only, which can be STCG or it can be STCL. Yes, guys, always short term only. Depreciable asset, it will always be short term only. Okay. But what if the block is not empty? See, if the block is not empty, which means I'm still having one plant in my block. I'm still having one asset in my block. If block is not empty, because we still have assets, of course, we will first try for depreciation. But by chance depreciation is not possible, then you will come to capital gains calculation, and in this capital gains calculation, you can have STCG only. You can't have an STCL. Is this crystal clear for everybody? Yes. So whenever an asset is in the block and you sell the asset, the first thing you check is my block empty or is my block not empty? If the block is empty, then there is no question of depreciation. Straight away capital gains. But if the block is not empty, first you will try for depreciation. If depreciation is not possible, then only you will come to capital gains. Okay. Now come back to this discussion. What happens if you use the asset for some other purpose? Then it will enter into the block at zero value. Now later when you sell the asset, what will happen? The asset is in the block. So later when you sell the asset, you will check whether the block is empty, whether the block is not empty. This whole song you will sing. Got it, guys? That's all. Keep this little thing in your mind, and now come to question number 18. The question says Avishkar Enterprises purchased a machinery for 5 lakh rupees on 18th August 2024 for scientific research. So earlier, last year, in 24-25, they purchased one machinery for 5 lakh rupees for scientific research. So in 24-25, assessee would have enjoyed 5 lakh rupees. Section 35 deduction assessee would have enjoyed. Then what happened? On 17th July 25, the research work was over. On 31st March 26, this machinery was sold. So we are having sale of scientific research asset. What is the asset over here? The asset is machinery. When we purchase a machinery, we enjoyed 5 lakh rupees, section 35 deduction. Now that same asset we are selling. When are we selling? On 31st March 26, we are selling the asset. We are selling the asset for how much? We have two cases. In the first case, we are selling for 1 lakh rupees. In the second case, we are selling for 7 lakh rupees. We have two cases. Let's handle them one by one. Look at the first case first. In the first case, I am selling away the new asset for 1 lakh rupees. Inside this, we have two possibilities. The first possibility, after using the same for business purpose other than scientific research, WDV of the respective block is 4,80,000, depreciation rate is 15%. So in case 1, in my first part, I am using the asset for some other purpose, then only I am selling. But in the second part, without using the same for any other purpose, I am directly selling. So totally 4 answers I will have, guys. In case 1, I am having 2 situations. In case 2, I am having 2 situations. Total 4 answers we will be having. Okay. First, our focus is on case 1. Selling price is 1 lakh rupees. In case 1, let's focus on the first part first. After using the asset for some other purpose. So when you use the asset for some other purpose, what will happen? The asset will enter into the block. But it will enter into the block at 0 value. And then we will treat it just like any other depreciable asset. Okay. So come on, let's do the block computation. What's the opening WDV of the block? See, it's given to us. The opening WDV of the block is 4,80,000. Then have we acquired any new asset during the year? Will any asset enter into the block? Yes, the scientific research, plant and machinery will enter into the block. Why? Because I'm starting to use the asset for some other purpose. That is what we learned. When you use the asset for some other purpose, it will enter the block at 0 value. So now I'm starting to use this plant and machinery for business purpose. So it will enter into the block, but it will enter into the block at 0 value. Now I will treat it like any other depreciable asset. Okay. Now tell me, money is receivable for assets sold. Have we sold any asset in this block? Yes, see, we are already having WDV, which means we're already having some plant and machineries. Then even this scientific research plant and machinery, even this one is entering into the block at 0 value. So we are having multiple machineries in the block now. The scientific research plant and machinery, we have sold. Depreciable asset, we have sold. So when we sell away a depreciable asset, we will apply my flow chart. Is my block empty or is my block not empty? Block is not empty, guys. We are having multiple plant and machineries. Only one scientific research plant and machinery only we are selling. So if my block is not empty, we will first try for depreciation. Only if depreciation is not possible, then only I will have capital gains. So come on. Let's try for depreciation. What's the money is receivable for asset sold? What's your selling price number over here? You're selling the asset for 1 lakh rupees. So your closing WDV will be 3,80,000. We always split our closing WDV into 3 parts: 0 days, less than 180 days, and balance. And I tell you, every time 0 days and less than 180 days, both the numbers you will take from your new asset step. In my new asset step, I don't have anything for 0 days or less than 180 days. So my entire amount will come under the balance, which is 3,80,000. Now tell me, what will be your depreciation? 3,80,000 into 15% depreciation, which is going to be 57,000. So are you noticing depreciation is possible? Because depreciation is possible, no question of capital gains. So what's your opening WDV? Your opening WDV will be 3,23,000. Got it, guys? With this, we're done with the first part of the first case. You're getting the whole situation right. We are selling away the scientific research asset after putting it into some other use. So when we put it into some other use, at that point, it will enter into the block, but it will enter into the block at 0 value. Now we will treat it just like any other depreciable asset. So when you sell away this asset, when you sell away this plant and machinery, my block is not empty. So because block is not empty, I first tried for depreciation, and depreciation is possible over here. Therefore, no question of capital gains. Okay, this was my first tax implication. Then comes my second situation, without using it for some other purpose. What if I directly sell away the asset without putting it into any other use? Then there will be 2 tax implications we learned: PGBP and capital gains. Remember, when you directly sell away the asset without putting it into any other use, there will be 2 tax implications. First tax implication is PGBP. In PGBP, what is the selling price? For how much are you selling away the asset? 1 lakh rupees. Or long back when you purchased the asset, at that time, how much section 35 deduction you enjoyed? 5 lakh rupees. So 1 lakh or 5 lakh, whichever is lesser, will become taxable for you under PGBP. 1 lakh rupees is lesser. So 1 lakh rupees will be taxable for us under the head PGBP. Okay, then after this, we'll also have capital gains. What's our full value consideration? We're selling away the asset for 1 lakh rupees. What's our cost of acquisition? 5 lakh rupees. So what's your net number? You're getting a negative number. You're getting a loss of 4 lakh rupees. Remember, we learned generally in capital gains, we can have a loss. But when you directly sell the asset, Here when you're doing capital gains calculation, in capital gains if you have a loss, you will simply ignore the loss. So that is what we will do over here. We directly sold the asset. So in capital gains calculation we have a loss, we will simply ignore the loss. So there will be only one implication now. We are having 1 lakh rupees which will be taxable for us under PGBP head. Got it? So if I have to give a summary now of my first case, so in my first case there were two situations. In the first situation I was using the asset for some other purpose. So in this case we first let the asset enter into the block at zero value. Then we had depreciation also. So our total depreciation was 57,000 rupees. In our first situation, remember that was a tax implication. We did full block computation, 57,000 rupees was a depreciation. Then coming to the second part, in the second situation, when we directly sold the asset, here we had PGBP and we had capital gains. When we directly sold the asset, PGBP was how much? PGBP was 1 lakh rupees, and capital gains, we are actually having a negative number, but we will ignore the negative number, therefore no capital gains. Got it? So this is your first case. Both the parts in your first case we have completed. Now same way we are going to do the second case. In second case everything remains the same. Only one thing changes, and that is selling price. Earlier selling price was 1 lakh rupees, right? Now the selling price will be 7 lakh rupees. This is the only thing that changes. Everything else stays the same. Okay. So even over here you have two situations. What if I'm using the asset for some other purpose and then selling? And what if I'm directly selling? Same two purposes. Okay. Let's handle the first one. What if I'm using the asset for some other purpose? Then it will enter into the block at zero value, and I will treat it just like any other depreciable asset. So come on, tell me, what's the opening WDV of the block? Same 4 lakh 80,000. Then the scientific research plant and machinery, you're using it for some other purpose, so it will enter into the block, but it will enter into the block at zero value. Now I will treat it just like any other depreciable asset. So in this block we're having multiple plant and machineries already. How do you know that, ma'am? Obviously because we're having opening WDV, so which means we're having multiple assets in this block already. Now we are also having the scientific research plant and machinery. This scientific research plant and machinery I am selling off. My block is not empty. I will first try for depreciation. Let's continue now. Let's try for depreciation. So what's our selling price? We're selling away the asset for how much? 7 lakh rupees. Money is receivable for assets sold 7 lakh rupees. Here I'll get a negative number 2 lakh 20. You tell me, can WDV be negative? WDV can't be negative, therefore I will restrict it to 0. Therefore I will restrict the selling price to 4 lakh rupees. So WDV is 0. Now you tell me, WDV is 0. Is depreciation possible? Depreciation is not possible. So when depreciation is not possible, what did we learn? Remember, come on, let's go back to our flow chart. If my block is not empty, I will first try for depreciation. If depreciation is not possible, then I will have capital gains. So come on, we've concluded now depreciation is not possible. So therefore we will do capital gains computation now. How to do? Normal capital gains calculation. Full value consideration is how much? For how much are you selling away the asset? 7 lakh rupees minus cost of acquisition. See, this is a depreciable asset, right? Your cost of acquisition will always be opening WDV plus additions. Whenever you're doing capital gains computation with respect to depreciable asset, your cost of acquisition will be opening WDV plus additions. Okay, what's your opening WDV over here? 4 lakh 80,000. You don't have any additions, so opening WDV plus additions is going to be 4 lakh 80,000 rupees. So what is your assessees? STCG. STCG will be 2 lakh 20,000 rupees. Okay, so this is the first part of your second case. What if you put the asset to some other use? So when I put the asset to some other use, it first entered into the block at 0 value. I tried for depreciation, but depreciation was not possible over here because WDV itself became 0. So because depreciation was not possible, I came to capital gains and I'm having STCG of 2 lakh 20,000 now. Okay, this is the first part of my second case. Now comes the second part of the second case where I am selling the asset without using it for any other purpose, which means I am directly selling the asset. So same thing, when I directly sell the asset, there will be two tax implications, PGBP and capital gains. Capital gains only thing is you can't have a loss. Okay, so tell me PGBP now. What's the selling price? This time for how much are we selling the asset? We are selling it off for 7 lakh rupees. Then long back when you purchased the asset, how much section 35 deduction you enjoyed? 5 lakh rupees. Out of these two numbers, I will pick whichever is lesser. Which is lesser? 5 lakh rupees. This 5 lakh rupees will be taxed for you as PGBP. Okay, this will be your first tax implication, that selling price or section 35 deduction, whichever is lesser, will be taxed. Then normal capital gains calculation. What's your full value consideration? You're selling away this asset for how much? For 7 lakh rupees. And what's your cost of acquisition? Here don't say opening WDV plus additions, because we do opening WDV plus additions and all only when you're doing capital gains computation relating to a depreciable block. Then only when you come to capital gains, cost of acquisition will be opening WDV plus additions. But in this situation, I'm directly selling the asset. There is no question of block computation and all. So what's your actual cost of acquisition? When you purchase this asset long back, you purchase it for how much? 5 lakh rupees. That's your cost of acquisition. So 2 lakh rupees, this will become your STCG. It's a positive number, so we will consider. Had it been a negative number, had it been a loss, we would have ignored. Okay, so if I have to summarize my second case now, we are going to have two answers. In the first answer, we put the asset into some other use and then we sold it. When we put it into some other use, it entered the block at zero value. Then we tried for depreciation, it was not possible. So we came to capital gains. In capital gains, we had STCG of 2,20,000. Okay. Then in our second situation, when we directly sold the asset, here we had PGBP also, STCG also. Our PGBP is how much? 5 lakh rupees and our STCG is 2 lakh rupees. That's it, guys. Okay, so what are your learnings? Learning number 1, when it's a depreciable asset and you do capital gains computation, your cost of acquisition will be opening WDV plus additions. But in my second situation, it was not a case of depreciable asset. It was not a block and all. I directly sold the asset. So normal typical capital gains calculation, here my cost of acquisition will be real cost of acquisition only. Got it, guys? This was question number 18. All the 4 subdivisions we have completed. It is like a classic question on sale of scientific research asset. Every angle of sale of scientific research asset gets covered through this question. Okay, now come on guys, come to question number 19. Question number 19, 20, 21. These 3 questions are our next target. All these 3 questions are relating to telecom license. Okay. Every nook and corner of the telecom license concept will get covered for you through these questions, including sale of telecom license. Okay, let's read the question and then we will work it out. So the question says, Telefast Limited, a company providing telecom services, obtained a telecom license on 20th April 25 for a period of 10 years, which ends on 31st March 2035. This is important. Date of expiry of the license is 31st March 2035. The license fee is 18 lakh rupees. Got the situation? This assessee has purchased a license, a telecom license. He has purchased it for 18 lakh rupees. The license ends on 31st March 2035 and the period of the license is 10 years. Find out the amount of deduction under 35 ABB of the Income Tax Act if 3 situations. Entire amount is paid on 6th May 25, entire amount is paid on 1st April 26 and the entire amount is paid in equal installments. We'll go one by one. We'll focus on the first situation first. See, when it comes to telecom license, whatever amount we pay for the telecom license, that amount will be amortized across the period of the license. But like for example, here the license fee is 18 lakhs. The period of license is 10 years. You can't directly divide it by 10 years. You can't directly amortize across 10 years. Yes, no doubt, the license fee is amortized across the life of the license, but only after the payment has been made. So if you look at the first situation over here, when does the license expire? What is the license expiry date? The license expires on the 31st of March 2035, which is going to be previous year 34-35. In 34-35, the license expires. What's the license fee? The license fee is 18 lakhs. This license fee will be amortized across what period? You can't blindly say 10 years. Yes, no doubt it will be amortized across the life of the license, but only after we make the payment. So when did the payment happen? See, the payment was made on 6th May 25. 6th May 25 means previous year 25-26. So previous year 25-26 to previous year, when is the expiry happening? 34-35. How long is this period? Are you understanding? we will see when did the payment happen and when will the license expire. For this period, we will amortize the license fee. Okay, so it will be amortized across the life of the license, but only after the payment is made. So from the year of payment till the year of expiry. Now, how many years is this? See now, 34, 35 minus 25, 26. This is going to be 9 years. But however, I want to include both the years. Both the years I will get the deduction. Therefore, I will add a plus. I'll add a 1. So therefore, this will be amortized across 10 years. So 18 lakh rupees divided by 10, 1,80,000 is what will be allowed for the assessee under section 35ABB across 10 years. Which 10 years? It will be allowed across these 10 years, that is previous year 25, 26 to previous year 34, 35. Is this clear? Yes guys, this is my answer to the first subdivision. So what are your learnings now? Point number 1, whatever we are paying for the license, it will be amortized. Point number 2, it will be amortized across how many years? It will be amortized across the life of the license. But here life of the license is 10 years. So therefore, will it always be 10 years? No. That period of amortization will start only after we make the payment and it will end in the year in which the license will expire. So this over here is 10 years. Okay. Now come to the second subdivision. In the second subdivision, everything remains the same, only the date of payment changes. This time the payment is made on 1st April 26, which is previous year 26-27. Okay, so when will the license expire? License will still expire on the same date, 31st March 2035, which is same thing, previous year 34-35. Then what's the license fee? All that remains the same, 18 lakh rupees. Now this 18 lakhs will be amortized across the life of the license, but starting only in the year of payment. When did the payment happen? This time previous year 26-27. And when will the license expire? In previous year 34-35. So how long is this period? Check now. 34-35 minus 26-27, if you see, you will get 8 years. But I want to include both the years. In both the years, amortization will be allowed. So I will add a 1. So it will be amortized across 9 years. So in this situation, 18 lakhs is the fee divided by 9. So 2 lakhs is what will be allowed each year. So rupees 2 lakhs, this is what will be allowed under section 35ABB across how many years? Across 9 years. Which 9 years? These 9 years, that is previous year 26-27 to previous year 34-35. Now crystal clear guys? The second subdivision would have given you even better clarity, right? Only after you make the payment, only after that only amortization we can begin. Okay, now comes the third situation, the ultimate situation. Here what's happening is the entire amount of 18 lakhs we are paying in equal installments on 30th April 25, on 30th April 26 and 30th April 27. So the fee is 18 lakhs. We are paying it across 3 installments. So each installment we will be making payment of 6 lakhs. So whenever you make the payment of telecom license in installments, make life easier for yourself. Do computation for each installment separately. Okay guys, so we are having 18 lakhs as the cost of the license. This time we are paying it across 3 installments. So we will be paying 6 lakh rupees license fee per installment. So we will handle each installment separately. First installment, second installment, third installment. Come on, let's focus fully on just the first installment first. When will the license expire? All that remains the same guys. The license will expire on 31st of March 2035. That remains the same. Then what's the license fee? I will not talk about 18 lakhs now. I will talk only about 6 lakhs. So each installment separately we will talk about. So license fee 6 lakhs only I will talk about. Now this license fee will be allowed across the life of the license, but only starting from the year of payment. So when was the first installment paid? The first installment was paid on 30th April 25, which is previous year 25-26. Okay, and I will allow this, the amortization will happen till the year of expiry. The year of expiry is previous year 34-35. This is going to be how many years? Same thing, it will be 9 years. Then you will add a 1, so it will end up being 10 years. Getting the point? So this 6 lakhs will be allowed as a deduction across 10 years starting from previous year 25-26. So 6 lakhs divided by 10, 60,000 is how much you will allow per year for these 10 years. Now same way, let's do for the second installment. Second installment also, license expiry date will stay the same only, 31st March 2035, that remains the same. The license fee is how much per installment we are paying, 6 lakh rupees, that stays the same. But this will be amortized across what period? The life of the license, which is 10 years, but starting from the year of payment. Second installment, when did we pay? 30th April 26, which means we made the payment in previous year 26-27, and we will amortize till the year of expiry. What is the year of expiry of the license? Previous year 34-35. Now this is going to be how long? This is actually going to be 8 years long, but you will remember to add a 1 because both the years will be included. So therefore this will be amortized across 9 years. So 6 lakhs divided by 9 per year, 66,667 is going to be amortized. When starting from 26-27, total 9 years. Okay, then comes my last installment. When will the license expire? All that remains the same. The license will expire on 31st March 2035. License fee is 6 lakh rupees. All that remains the same. Now this 6 lakhs will be allowed across how many years? Across the life of the license, but starting from the year of payment. When did we make the payment this time? 30th April 27, which means we made the payment in previous year 27-28, and we will allow the amortization till the expiry of the license, which is same thing, 34-35. Now this is going to be how many years? This will actually be 7 years, but you will remember to add a 1 because both the years we have to include. So therefore this will be allowed across 8 years. So come on, calculate now. 6 lakh rupees divided by 8 per year. How much will you allow per year? 75,000 you will allow. Till here you've understood properly, guys? Yes, now listen carefully to my summary. Till here if you've understood properly, only then proceed forward. So we have totally 3 installments. For each installment separately we calculated. For each installment the amount of amortization is different now. For each installment the period of amortization is different now. So tell me, in 25-26, how much amortization will I get? See, in 25-26, what will be allowed for me under section 35ABB? We'll go again installment by installment. First installment, 60,000 will be amortized from 25-26. So in 25-26, 60,000 will be amortized for the first installment. But 26-27 also 60,000 will be amortized. 27-28 also 60,000 will be amortized. So every year till 34-35, 60,000 will be amortized in the first installment. Okay. Then what about the second installment? Second installment, 66-67 you will amortize, but when? Only from 26-27 onwards. So in 25-26, nothing will be amortized for the second installment. 26-27 onwards only, 66-67 will be allowed under 35ABB. Okay. Then what about the third installment? In the third installment, 75,000 will be allowed per year, but starting from 27-28 only. So 25-26 nothing will be allowed. 26-27 nothing will be allowed. 27-28 onwards, 75,000 will be allowed. Okay, so I can say that previous year 25-26 total deduction for me under section 35ABB, total deduction for me in 25-26 will be how much? Only 60,000 rupees. In 26-27 it will be 60,000 plus 66,667, which will be 1,26,667. Okay, and in 27-28 my total 35ABB deduction will be 2,01,667. Now this 2,01,667, this amount will stay the same for each year till 34-35. So previous year 27-28 to previous year 34-35. So for all these years 2,01,667 will be allowed. You understood, guys? So this is what they were asking us over here. What is the amount of deduction under 35ABB? For each year we have mentioned now how much will be the deduction. In 25-26, I am getting the deduction only for the first installment. In 26-27, I am getting the deduction for the first and the second installment. But 27-28 onwards, I will get deduction for all the 3 installments. Got it, guys? So this was your question number 19, solely focusing on amortization of license. Please remember, the license will be amortized across the life of the license, but starting only after the year of payment. Okay, so now come on, let's come to question number 20 now. Question number 20 and 21, both of these questions will talk about the sale of license. Only thing that is different is in question number 20, the whole license will be sold, but in question number 21, only a part of the license will be sold. That will be the only difference, but both of these questions are about sale of license. Let's read the question. The question says, Twinkle Enterprises has acquired a telecom license. Details of the license are given to you. The license acquisition cost was 1 lakh rupees. The license was purchased on 16th August 24. Payment terms lump sum. Date of first payment 16th August 24. Life of license 10 years. License 100% of the license is sold. Date of sale of the license is 15th March 27 and the sale value is 1,20,000. State the tax consequences in the several previous years up to 26-27 related to such transactions. See, what do we know about telecom license as of now? We know that whenever we buy a telecom license, whatever is the cost, we amortize the cost across the life of the license, but only starting from the year of payment. This is what we're aware of. Okay. Now in this question we have sale of license. 100% of the license is sold. Now listen to me. Don't bother too much about the provision. You see how logically everything will fall in place. Logic is what you will remember for a much longer time. Okay. So instead of mugging up, let's see this entire concept very logically. See, first of all, what is the cost of the license? The cost of the license is 1 lakh rupees. Okay. Then what is the life of the license? Question says this license is for 10 years. Then when did we purchase a license? 16th August 24, and see, we made the payment also on 16th August 24 itself. In the same year itself we made the payment. So therefore what is going to be allowed for you under section 35ABB, guys? We generally allow it across the life of license starting from the year of payment, right? But here we have made the payment in the year of purchase itself. We made the payment. So therefore this 1 lakh rupees I will straight away allow it across 10 years. So that's going to be 10,000 rupees per year. So 10,000 rupees per year will be allowed from which year? From the year of payment. What is a year of payment? From previous year 24-25. Till here perfectly clear. So the cost of the license is 1 lakh rupees. The life of the license is 10 years. We purchased the license on 16th August 24. We made the payment also on 16th August 24 itself. So across these 10 years, the license will be amortized. So 1 lakh rupees divided by 10,000 rupees per year will be amortized starting from the year of payment, that is from 24-25. Till here perfect clarity. Now what happened? The license was sold. The license was sold when? On 15th March 27, which is going to be previous year 26-27. That is when the license is sold. It is sold for 1,20,000 rupees. Now see, in previous year 24-25, under section 35ABB, how much would be allowed for you? 10,000 rupees will be allowed for you. Okay. Then in previous year 25-26, under section 35ABB, how much will be allowed for you? Again 10,000 will be allowed to you. Then previous year 26-27, this is the year in which you sold the license. No, the year in which you sold the license, in that year under 35ABB, nothing will be allowed. This is your learning number 1. So learning number 1 is in the year in which we are selling the license, in that year under 35ABB, nothing will be allowed. This is the first part of my answer. Okay. Then listen, we sold the license. So when we sell the license, there will be 2 tax implications. There will be PGBP tax implications also. There will be capital gains tax implications also. So PGBP, 2 things we will compare. Number 1, how much section 35ABB deduction we have already claimed? We have already claimed deduction of 10,000 plus 10,000. Already we have claimed 20,000 rupees. Okay. We will compare this with the surplus that we have made upon the sale of this license. See, we sold the license for how much? We sold the license for 1,20,000 rupees minus what's the WDV of the license? See, the cost of the license was 1 lakh rupees. Okay. And how much amortization is already done? 20,000 rupees. So what's the WDV of the license now? 80,000 rupees. So 1,20,000 minus 80,000 rupees, which is going to be 40,000 rupees. So out of these 2 numbers, we will pick whichever is the lesser number. Which is the lesser number over here? 20,000. This 20,000 will be taxed for you under the PGBP head. Till here you understood? To compute PGBP, two things I am checking. Number one, section 35 ABB deduction, how much I had enjoyed, 20,000 rupees. And number two, surplus. Surplus is nothing but selling price minus WDV. So my selling price is 1,20,000. I am selling it for so much. How did I find this WDV? The cost of the license is 1 lakh rupees. We have already amortized 20,000 rupees. So the WDV of the license is now 80,000 rupees. So that, so 1,20,000 minus 80. 40,000. Out of these two numbers, whichever is lesser, that is 20,000 will be taxable. Okay. Then comes capital gains computation. Normal usual capital gains computation. What's a full value consideration? We sold the license for 1,20,000 minus what's the cost of the license? The cost of acquisition of the license was 1 lakh rupees. That's all. So 20,000 rupees, this will become your capital gains. Got it, guys? So they asked us the tax consequences in several previous years up to 26-27. So what is the tax implication now? In 24-25, we will be having under 35 ABB 10,000 deduction. In 25-26, our deduction will be 10,000 rupees. In 26-27, if you see, 35 ABB deduction will be nil. But in 26-27, we will have PGBP of 20,000 which will be taxable. We'll have capital gains of 20,000 which will be taxable. Okay. So what you're learning now? See, 35 ABB part, this is clear. The first learning for you, in the year in which you sell the license, in that year, no 35 ABB deduction. Then learning number 2, when you sell the license, you will compute PGBP and capital gains. Two tax implications will come into the picture. PGBP will be nothing but how much ever deduction you had claimed already, or the surplus, whichever is lesser, will be taxable. Surplus will be nothing but selling price minus WDV. Learn it this way, it will be easier for you to recall. Okay. And then capital gains, normal usual computation. Okay. This was question number 20. Now, before we move on to question number 21, one small thing let me tell you. Whatever we did because of the sale of license, this PGBP computation, this capital gains computation, all this will come into the picture only if 100% of the license is sold. Which means if a part of the license is sold, then all these implications will not come into the picture. Okay, keep this in your mind and now come to question number 21. The question says Tweety Enterprises has acquired a telecom license. Details in respect of this license are given to you. Point number 1, acquisition cost 3 lakh rupees. Date of purchase 14th July 2022. Payment terms lump sum. Date of payment is 14th July 2023. Are you understanding? We purchased the license on 14th July 2022, but we're making payment only next year on 14th July 2023. Life of license is 7 years, but we made payment 1 year late, right? So of course we will get deduction across 6 years only. License sold is 40%. Date of sale of license is 12th December 25. Sold for 1,20,000 rupees. State the tax consequences. Here if you see, 100% of the license is not sold. The complete license is not sold. Only 40% of the license is sold. Which means the sale of license tax implications will not come into the picture over here. You will only have 35 ABB deduction only you will have. Okay. So point number 1, what is the cost of the license? We spent 3 lakh rupees to buy the license. Now this license will be allowed. It will be amortized across the life of the license. The life of the license is actually 7 years, but then we start allowing only after we make the payment. We made payment 1 year late. We purchased the license on 14th July 22, but we made the payment only on 14th July 2023. So we made the payment 1 year late. So therefore, if the life of the license is 7 years, this 3 lakh rupees will be allowed for you across how many years? Across 6 years only, because only after we make the payment, then only we allow the only after we make the payment, only after that only we allow deduction under 35 ABB. So therefore, what will be your 35 ABB deduction? 3 lakh divided by 6, 50,000 deduction you will get each year. Okay. So when will you start getting the deduction? Only after you make the payment. Payment is made in 23-24. So previous year 23-24 you will be getting 50,000 deduction. Then previous year 24-25 you will be getting 50,000 deduction. Now comes previous year 25-26. In 25-26 only 40% of the license we sold. And we did not sell the entire license. We sold only 40%. So therefore, whatever we did in the last question because of sale of license, all that will not come into the picture because we did not sell the entire license. But then, however, my 35 ABB deduction will change now. Because earlier I was getting 50,000. I was having the entire license. I was getting so much deduction. But now I am selling 40% of the license. I am left with only the balance 60% of the license. So now my 35 ABB number will change. So what will be my number under 35 ABB 25-26 onwards? I'll tell you. Very logical calculation. What was the cost of the license? The cost of the license was 3 lakh rupees. Okay. Then how much 35ABB deduction have we already enjoyed? 50,000, 50,000. We have already enjoyed 1 lakh rupees. And for how much did we sell away the license? How much sale price we got from the license? We got 1,20,000 rupees from the sale of the license. So how much license are we left with now? We are still left with 3 lakh minus 1 lakh minus 1,20,000. We are left with 80,000 worth of license only. This 80,000 worth of license will be amortized across how many years? See, total amortization was for 6 years. We have already amortized for 2 years. So only the balance 4 years is left. So for the balance 4 years, my 35ABB deduction will be 20,000 rupees. So in 25-26, my 35ABB deduction will be 20,000 rupees. This is going to be your answer. Understanding? I'll repeat this orange part for you once again. My cost of the license is 3 lakh rupees. Until now, I have claimed 1 lakh rupees 35ABB deduction, 50,000, 50,000, total 1 lakh I have claimed. And then see, all this information is about 100% of the license. Then we sold 40% of the license for 1,20,000. So for the balance 60% of the license, how much are we left with now? Only 80,000. This 80,000 will be amortized across the remaining 4 years. How did I get 4 years? Because the total amortization is for 6 years. We have already amortized for 2 years. So the balance 4 years, across the balance 4 years, we will amortize the balance 20,000 per year. Getting it? This was your question number 21. With this, we are done with all our 3 questions on 35ABB. What are your learnings? Point number 1, the amount that we are paying to get the license, that amount will be amortized. It will be amortized across how many years? It will be amortized across the life of the license. But you will start amortizing only upon payment. Only after you make the payment, then only you will start amortizing. This is the first learning that we had. Then the second learning that we had is what happens when you sell away the entire 100% of the license. When you sell away 100% of the license, point number 1, in the previous year in which the sale happened, in that year, section 35ABB deduction you will not get. Then point number 2, in the year in which you sell 100% of the license, there will be tax implications for you under the PGBP head also, under the capital gains head also. In PGBP, if you see, you will simply compare 2 numbers, guys. Number 1, you will see until now how much 35ABB deduction you have enjoyed, and number 2, you will see what is the surplus on the sale. Surplus on the sale will be nothing but the selling price minus WDV. So out of these 2 numbers, whichever is lesser number will be taxed for you under PGBP. Then capital gains will be your usual capital gains computation. Okay. Then we learned what will happen when we sell only a part of the license. When you sell only a part of the license, this PGBP implication, this capital gains implication, all this will not be there. You will continue to get 35ABB deduction. Only thing is that the 35ABB deduction, the amount will change. That's all. But apart from that, this tax implication will not come into the picture. Only the amount will change. Only the deduction amount will change. That is what we did over here. We saw the cost of the license. We subtracted whatever amount we have already amortized. So this becomes the value of the entire license. We sold away 40% of the license. So we subtracted the 40% sale value. The balance becomes our remaining 60% license. This will be amortized across the remaining life of the license. So when we sell away a part of the license, these implications will not come into the picture. Just that 35ABB amount will change. Okay, this was your question number 21. So with this, I think we can close our entire revision with respect to the telecom license. Now come to question number 22. This is where your section 35D preliminary expense will get revised for you. The question says Jardine Limited is an existing Indian company which sets up a new industrial unit. It incurs the following expenditure in connection with the new unit. Preparation of project report 4 lakh rupees. Market survey 5 lakh rupees. Legal and other charges 2 lakh rupees. Total expense which this company has incurred is 11 lakh rupees. So what is your total preliminary expense over here? Total preliminary expense is 11 lakh rupees. Okay. Then the following further data is given. Cost of project and capital employed of the new unit. See, under section 35D, how do you compute the preliminary expense? We see how much expense we have incurred. Okay. And we compare it with the maximum limit. What is a maximum limit? The maximum limit will be the cost of project of the company or the capital employed of the company, whichever is whichever is higher, and then 5% of that higher number. So what's your cost of project over here? Cost of project is 30 lakhs. Capital employed is 40 lakhs. So out of these two numbers, which is higher? 40 lakh rupees. 40 lakhs into 5% will be how much now? That's going to be 2 lakh rupees. Right, guys? So the total preliminary expense, maximum limit is 2 lakhs. So your preliminary expense over here is more than the maximum limit. So therefore, what will be your section 35D deduction now? It will be restricted to the maximum limit of 2 lakh rupees. Now this amount of preliminary expense will be allowed for you across how many years? Across 5 years. So each year 40,000 will be allowed for you. This will be your final answer. So under section 35D, your maximum deduction which you can enjoy is 40,000 rupees per annum for total 5 years. Now see, one small thing I'll tell you, okay. Our maximum limit over here was the cost of project or capital employed, whichever is higher, and 5% of that. This is how you compute if assessee is a company. If assessee is not a company, then for the maximum limit, you will only take cost of project into 5%. You will not take capital employed. Understanding? I'll put the entire provision for you over here so that it's easier for you to revise later. It's very simple, nothing to worry. So under section 35D, your first step will be, you will see what is the actual expense which your assessee has incurred. Okay. Then you will see what is a maximum limit. The maximum limit depends upon who is the assessee. Is the assessee company or is the assessee any other person? If the assessee is a company, then you will see what is the cost of project of that particular entity, and you will compare it with capital employed. Out of these two numbers, you will pick whichever is higher number. 5% of that higher number, this will become your maximum limit. But if assessee is any other assessee, you don't take capital employed, guys. If assessee is any other assessee, you just take the cost of project into 5%, and that will become your maximum limit. Now you understood. This capital employed point will be there only for company. So actual expense or the maximum limit, whichever is lesser, will become your section 35D deduction. That is what we did over here. My actual expense was 11 lakhs. My maximum limit was 2 lakhs. So whichever is lesser, 2 lakhs will become my section 35D deduction. Now that 35D deduction you will allow across 5 years. So 1/5, 1/5, 1/5, 1/5, 1/5. This is how much you will allow across 5 years. Now you got the point. This was your question number 22 on section 35D. So in this session, we first saw sale of scientific research asset. Then we saw telecom license. We saw sale of telecom license. And now we saw preliminary expense. Okay. Now come to question number 25. Now this is where for the first time we will be seeing presumptive taxation section 44AD. I'll just give you a quick reminder of the provision. Okay. In 44AD, first of all, 3 conditions have to be fulfilled. Then only you can apply 44AD. What are the conditions? Condition number 1, the assessee has to be either a resident individual or a resident HUF or a resident partnership firm. No LLP, only partnership firm. Okay. Condition number 2, this assessee must be carrying on a business, but this business should not be agency business. This business should not be plying, hiring, leasing goods carriages. Condition number 3, this assessee must not be enjoying 10AA tax holiday. This assessee must not be enjoying Chapter 6A Part C. Chapter 6A Part B you can enjoy. Chapter 6A Part C only you cannot enjoy. Okay. And condition number 4, the turnover of the assessee should be either within 2 crore or it will be within 3 crore. When will you apply the 2 crore limit? You will apply the 2 crore limit if the cash receipt is more than 5% of the turnover. Then you will apply the 2 crore limit. But however, if the cash receipt is within 5% of the turnover, then in that case you will apply the 3 crore limit. So total how many conditions are you having? Total 4 conditions you are having. If all the 4 conditions are fulfilled, then only 44AD will apply. If 44AD applies, then how will you compute PGBP? No allowances, no disallowances, nothing. No depreciation, 40A1, 40A3, no allowances, no disallowances, nothing. You will straight away see the turnover of your assessee. Okay, this turnover you will split into 2 parts. Out of this turnover, how much we have realized in specified mode within 139.1 date. So whatever turnover we have realized in specified mode within 139.1 date, of this turnover, 6% will be a PGBP. Then we will see what is a balance turnover. Balance turnover when received, whether not received, I don't care. Whatever is a balance turnover, this into 8% will be a PGBP. Okay, that's it guys. Keep this much in your mind, and now come on, let's have a look at the question. The question says X and Company, a firm, is engaged in the business of trading of cloth. Turnover of 25-26 is 1 crore 57 lakh 80,000, out of which 25 lakhs has been received in account pay check. It wants to claim the following deductions. Salary and interest to partners is 60,000. Salary to employees is 4,90,000. Depreciation is 2,70,000. Cost of material used is 1 crore 20 lakh 90,000. Other expenses 13 lakh 45,000. So total expenses it wants to claim is 1 crore 42 lakh 55,000. Net profit of this firm will be nothing but the turnover, which is 1 crore 57 lakh 80 minus these expenses. So 15 lakh 25,000 will become the net profit of this SSE. Till here clear? SSE is a partnership firm. It is in cloth trading business. Its turnover is 1 crore 57 lakh 80,000, and out of that turnover they are saying 25 lakh has been received by account pay check. Then this SSE wants to claim all these expenses. So the net profit of the SSE is 15 lakh 25,000. They are asking us to find the net income of this firm for 26-27 assessment year, assuming that interest income is 90,000 rupees, LTCG is 1,40,000 rupees, and the firm is eligible for 15,000 under section 80G. They're asking us to find the net income. Okay, let's begin guys. So answer to question number 25. I will do this answer for you in two parts. Part A. In part A, I will first try presumptive taxation. See, why am I suddenly trying presumptive taxation? They've given me the turnover. They're telling me out of the turnover how much is received in cash or how much is received in specified mode. They're giving me that information. So clearly they are hinting me to apply presumptive taxation. So in part A, I am going to apply presumptive taxation. But I can't blindly apply presumptive taxation guys. I have to check my conditions. By the way, presumptive taxation means which head of income? Clearly PGBP, head of income. In presumptive taxation, which section? Assessee is carrying on business. So we will think about 44AD. What are the conditions first of all? Condition number 1, the assessee has to be a resident individual or HUF or partnership firm. The assessee is a partnership firm over here. I'll assume assessee is a resident. So condition 1 fulfilled. Condition number 2, this assessee must be carrying on a business. It should not be agency business. It should also not be plying, hiring, leasing, goods carriage. Yes guys, assessee is carrying on a business, and that too it is cloth business. Even this condition is fulfilled. Condition number 3, assessee must not be claiming 10AA. Assessee must not be claiming chapter 6A part C. See, assessee is definitely not claiming 10AA over here. That is fine. But chapter 6A part C, assessee is claiming 15,000 under 80G. So 80G will be a chapter 6A part B section. See, part C sections are your income linked deductions like your 80QQB, 80RRB, then even 80JJAA is your chapter 6A part C sections. So other than chapter 6A part C, chapter 6A part B you can claim like 80C, 80TTA, 80TTB, 80D, 80DD, 80E series, all that you can claim. Only chapter 6A part C you should not be claiming, and yes, assessee is not claiming. Condition number 4, turnover of the assessee should be sometimes within 2 crore, sometimes within 3 crore depending upon cash receipt. Here the turnover of the assessee is 1 crore 57 lakh 80. I won't even waste my time checking which turnover limit is applicable. I won't even waste my time checking that because my assessee's turnover is only 1 crore 57 lakh 80. Whatever be the turnover limit, my assessee's turnover is within the limit. It is within 2 crore also. It is within 3 crore also. So whatever be the turnover limit, my assessee's turnover is within the limit. So all my conditions are fulfilled. Therefore, I can say that 44AD is applicable. If 44AD is applicable, I don't care about allowances, disallowances and all. I will just take the turnover number, sometimes 6%, sometimes 8%. That itself will become my PGBP. Yes, so what is the PGBP of my assessee under section 44AD now? It will all depend upon the turnover of your assessee. The turnover is how much? 1 crore 57 lakh 80,000. What did I teach you? This turnover you will split into how many parts? You will split this turnover into 2 parts. Out of this turnover you will see how much of the turnover you have realized in specified mode, how much of the turnover you have realized in specified mode within 139.1 date. Tell me guys, the question says 25 lakhs has been received in account pay check. Account pay check is specified mode. So in specified mode, how much turnover have we received? We have received 25 lakhs. So what is my balance turnover now? 1 crore 57 lakh 80,000 minus 25 lakhs. My balance turnover is 1 crore 32 lakh 80,000. This balance turnover, whether we have received, whether we have not received, when we received, in what mode we received, I don't care. Whatever is this turnover, this into 8% will be my PGBP. This 25 lakhs into 6% will be my PGBP. Okay, so 25 lakh into 6% is going to be 1 lakh 50,000. Then 1 crore 32 lakh 80,000 into 8%. This is going to be 10 lakh 62,400. So here if you see, the total PGBP is going to be how much? 10,62,400 plus 1 lakh 50, 12 lakh 12,400. This is going to be the PGBP of your assessee. So if your assessee follows 44 AD, then 12 lakh 14,000 will become the PGBP. No allowances, no disallowances, nothing. They ask the net income of your assessee. So therefore, if I compute the net income, that is the total income, then PGBP of your assessee will be 12 lakh 12,400. Then what are the other incomes? We have two other incomes. No, we have interest income. Interest income will go under IFOS. So IFOS we will be having 90,000 rupees. Then we will have LTCG. LTCG is 1 lakh 40,000 rupees. So your GTI at this stage will be 14 lakh 42,400. Then from this we have chapter 6A. But before we subtract chapter 6A, we will always split our GTI into normal rate income and special rate income. We do have a special rate income guys. LTCG will be special rate income. It is taxed at special rate of tax. So we have special rate income of 1 lakh 40. So what's your normal rate income now? The balance 13 lakh 2,400 will become your normal rate income. Against this you will enjoy chapter 6A. You know right? Chapter 6A I can enjoy only against normal rate income. So how much is my chapter 6A? 15,000 is my chapter 6A, which I will enjoy only against normal rate income. So what's my balance income now? My balance normal rate income will be 12 lakh 87,400 and my special rate income is 1 lakh 40,000. So therefore the net income or the total income of my assessee will be 14 lakh 27,400, which is already in multiples of 10. Therefore no need of any further rounding off also. Okay, and see, assessee has followed 44 AD over here. So if assessee follows 44 AD, assessee will not have to maintain books of accounts. Books of accounts are not required. Assessee does not have to get the books of accounts audited. Then advance tax, assessee will still have to pay advance tax, but the whole advance tax has to be paid in the last installment only. So if assessee follows 44 AD, these are the benefits which assessee will enjoy. Benefits of 44 AD, no need to get the books of no need to maintain the books of accounts first of all, no need to get the books of accounts audited. Then advance tax you still have to pay. 100% advance tax you have to pay, but you have to pay only in the last installment. Okay. This is the first part of my answer, that is, what if my assessee follows presumptive taxation. Now come on, let's redo the entire computation once again, which is going to be my part B. In part B, what if assessee is not following presumptive taxation, then what will happen? See, here what will change? Only your PGBP will change. So in this situation, your PGBP will be what they've computed and they've given us already. PGBP will be 15 lakh 25,000. Then your IFOS will be the same number. IFOS is 90,000 and your LTCG is 1 lakh 40,000. So in this option, the GTI of your assessee will be 17 lakh 55,000. Again, you will split GTI into normal rate income and special rate income. I do have a special rate income. This LTCG of 1 lakh 40 special rate income. Against special rate income, we can't enjoy chapter 6A. So what's your normal rate income? 16 lakh 15,000. So I will subtract my chapter 6A against normal rate income. What's your chapter 6A? 15,000 under 80G. So your net normal rate income will be 16 lakhs. Your special rate income will be 1,40,000. So your total income of the assessee will be 17,40,000. This will become the total income. Understood, guys? So there are two options for the assessee. If the assessee follows presumptive taxation, then the assessee's total income is 14,27,400. In fact, in this option, assessee also gets all these benefits. But if assessee does not follow presumptive taxation, then in that case, there will be consequences. Because understand, guys, that presumptive taxation is mandatory. If presumptive taxation is applicable for you, you have to follow presumptive taxation. We checked, no, all the conditions were fulfilled. Because all the conditions were fulfilled, 44 AD is applicable for my assessee. So assessee has to follow presumptive taxation. But still assessee is not following presumptive taxation in this method. Now suffer the consequences. What will be the consequences? Consequence number 1, you will have to maintain the books of accounts mandatorily. Consequence number 2, you will have to get the books of accounts audited under section 44AB mandatory. Consequence number 3, advance tax you will have to pay in usual 4 installments you will have to pay. So if presumptive taxation is applicable for you, but still if you don't apply, then consequences will come into the picture because presumptive taxation is mandatory. It's not optional, it is mandatory. So what are the consequences that will apply? If you don't follow presumptive taxation, you will have to maintain the books. You will have to get the books of accounts audited. Then advance tax you will have to pay in usual 4 installments. And in fact, there's one more consequence, 44 AD subsection 4, which means next to 5 years, you will become ineligible for 44 AD. Next to 5 years, even if you want to follow 44 AD, you can't follow. Okay, so this was your question number 25. So we gave the assessee 2 options. Of course, the first option is better because in the first option, net income is also lesser. In the first option, you get all these benefits also. So of course, the first option with presumptive taxation is much better than the second option. But we just did the computation under both the methods. So that's it, guys. With this, we will close our session over here. In our next session, we will start with question number 26, which will be 44AE presumptive taxation. Then question number 27, where we will see assessment of firm, section 40B, salary to partners, interest to partners, all that will get covered over here. Then question number 29 will be your first full-fledged PGBP question. We'll do all of this in our next session. Hello guys, so we'll start off with question number 26 now. This is going to be entirely focused on section 44AE, okay? I'll give you a quick reminder of the provision first. So under 44AE, the assessee can be any person. Assessee can also be a company. Assessee can be any person. Just that this assessee must be in the business of plying, hiring or leasing goods carriages, and he should not own more than 10 goods carriages at any point of time in the previous year. 3 simple conditions. Assessee can be any assessee. Assessee must be in the business of plying, hiring, leasing goods carriage, and assessee must not own more than 10 goods carriages at any point of time in the previous year. If all these conditions are fulfilled, then section 44AE will come into the picture. As per section 44AE, how will you calculate PGBP now? It depends. It depends upon how many heavy vehicles the assessee has and how many other vehicles the assessee has. Heavy vehicle means the vehicle can carry more than 12,000 kg, that becomes a heavy vehicle. But if it is within 12,000 kg, then it becomes other vehicle. For heavy vehicles, how will you compute PGBP now? For heavy vehicles, 1,000 rupees per ton, per vehicle, per month or part thereof. For other vehicles, it will be 7,500 rupees per vehicle, per month or part thereof. Okay, whatever you get from this calculation, from this number, you will subtract section 40B, interest to partners, salary to partners, but of course, this will be allowed only if your assessee happens to be a partnership firm or LLP. Only for partnership firm and LLP only, no. Section 40B, interest to partners, salary to partners is allowed. So whatever you compute over here, from this number we will subtract section 40B, interest to partners and salary to partners, and whatever you get now, this is what your final PGBP will be. See, even section 44A is presumptive taxation, but however, if you see, there are totally 3 sections under presumptive taxation, right? 44AD, 44ADA and 44AE. Only in 44 AE only you have this point of subtracting section 40B interest and salary. This point you don't have in the other presumptive taxation sections. Okay, this was just one small reminder I wanted to give you. Now come on, let's read the question and we will apply all this in the question. The question says Mr. Sukhvinder is engaged in the business of plying goods carriages. On 1st April 25, he owns 10 trucks, out of which 6 are heavy goods vehicle of unladen weight each of 20 ton. On 2nd May 25, he sold one of the heavy goods vehicle and purchased a light goods vehicle on 6th May 25. This new vehicle could, however, be put to use only on 15th June 25. Compute the total income of Mr. Sukhvinder for assessment at 26-27, taking note of the following data: freight charges collected, operational expenses, depreciation, other office expenses, net profit. So this is the entire computation for this plying, hiring, leasing business, and other income is 70,000. They're asking us to find the total income of Mr. Sukhvinder. Just like how in the last session we saw a question on 44 AD and we did computation under both the methods. Remember, first we had computed as per presumptive income, then we computed without presumptive income. So same way even over here we will do two calculations, guys. Let's begin. So I'll first do part A. In part A, where I'm going to apply 44 AE. Okay, so let's compute PGBP now. See, we can't straight away start applying 44A. We check our conditions first. What are the conditions? Assessee can be any assessee. Assessee should be in the business of plying, hiring, leasing goods carriages. Yes, assessee is in the business of plying carriages. Then assessee should not own more than 10 goods carriages. Let us check this, guys. The question says in the beginning of the year, he owns 10 trucks, out of which 6 are heavy goods vehicle. So on 1st April 2025, how many heavy vehicles is assessee having and how many other vehicles is he having? He is having 6 heavy vehicles. So obviously 4 other vehicles. Total 10 vehicles he is having, 6 heavy and 4 others. Okay. Then what happened? On 2nd May 25, he sold one of the heavy vehicles. And by the way, these heavy vehicles, the question is saying each of them can carry 20 tons. Okay. Then on 2nd May 2025, he sold one heavy vehicle. So now how many vehicles are we left with? 5 heavy vehicles, 4 other vehicles. We have total 9 vehicles now. Then what happened? He purchased a light goods vehicle on 6th May 25. So on 6th May 25, light vehicle means what? Other vehicle. He purchased one other vehicle. So now we are having 5 heavy vehicles, 5 other vehicles. Total we are having 10 vehicles. This one vehicle which he purchased on 6th May 25, this new one, this one he put to use only on 15th June 25. Always remember at this stage that when did you put the vehicle to use? When did you put the asset to use? That is relevant only in depreciation discussion. Leave it over there. Don't bring it everywhere else. Like for example, section 35, scientific research. I purchased one asset for scientific research. I did not put it to use. Nobody cares. Whether you put the asset to use or not, nobody cares. You purchased it for scientific research. Now enjoy section 35 deduction. Same way over here, I purchased one truck. I did not put it to use. Nobody cares whether you put it to use or not. What do we care? When did you purchase? Getting my point? So what I'm trying to communicate to you is put to use is a concept which is relevant only in depreciation. Leave it over there. Don't bring it everywhere else. Okay. So when was it put to use? We put the vehicle to use only on 15th June. That doesn't matter to me. This becomes irrelevant information. Okay. So totally, if you see, at any point of time, did we cross 10? No, we had 10 vehicles, we had 9 vehicles and we had 10 vehicles. At any point of time, we have not crossed 10. It is within 10 goods carriages throughout the year. Therefore, all my conditions are fulfilled. Therefore, 44AE will apply. Now, in 44AE, how will you compute PGBP? Be careful. Heavy vehicles separately we will calculate. Other vehicles separately we will calculate. I'll bring this to my main computation over here. Now, keep this in your mind and listen to me. First, let's calculate for other vehicles. Then we will calculate for heavy vehicles. Okay, so under PGBP, other vehicles. See, other vehicles, I can say that these 4 vehicles I'm having throughout the year. See, other vehicles, we initially had 4. Later, we purchased one. We purchased one in May. So, these 4 vehicles we are having throughout the year. From the beginning of the year till the end of the year we are having. So, let's finish off these vehicles first. For 4 vehicles, how will you compute? Other vehicles, guys. So for other vehicles, it is 7,500 rupees per vehicle. 7,500 rupees into 4 vehicles into 12 months. Why 12 months? Because these 4 vehicles we have throughout the year from the beginning of the year. How much will this work out to? This is working out to 3,60,000 rupees. Okay. Then we have one more other vehicle which we purchased in the month of May. So that one vehicle, 7,500 rupees per vehicle. This is only one vehicle. This will be for how many months? May onwards. See, even a few days in May, you will count it fully. Even a part of the month, you will count it fully. So May onwards will be 11 months. So 7,500 into 1 into 11 will be 82,500. This will be your number for other vehicles. Now let's calculate for heavy vehicles. Heavy vehicles, if you see, initially we had 6. Then we sold 1. So later we were having 5. So can I say that these 5 vehicles I was having throughout the year, guys? Only this one vehicle we had only for 1 or 2 months maybe. But total 6 vehicles we had in the beginning of the year. Out of the 6, 1 we sold off in between the year. But the remaining 5 we are having from the beginning of the year till the end of the year. Let's finish those 5 first. So these 5 vehicles, by the way, heavy vehicles, how will you compute? 1,000 rupees per ton. How many tons? Question says 20 tons. 1,000 rupees per ton. So into 20 tons per vehicle. How many vehicles over here? 5 vehicles. So 1,000 rupees per ton per vehicle per month. How many months? These vehicles we are having for all 12 months. So 1,000 into 20 into 5 into 12. This is going to be 12 lakh rupees. Okay, then what about this one vehicle? This one vehicle which we sold in between the year, we sold in the month of May. So April and May, we had this vehicle for 2 months. So for 2 months, we will compute 1,000 rupees per ton into 20 tons into one vehicle, but only for 2 months. So 1,000 into 20 into 2, this is going to be 40,000 rupees. That's all. Add up now. What's your total PGBP as per 44AE? Your total PGBP as per 44AE will be 16,82,500. Had your assessee been a partnership firm, then I would have subtracted section 40 clause B. Interest to partners, salary to partners, I would have subtracted. But here they are not asking us for, here our assessee is not a firm, assessee is an individual only. So I will not bother about 40 clause B. So as per 44AE, the PGBP of this assessee will be 16,82,500. Okay, points to be noticed. Point number 1. This one vehicle we sold off on 2nd of May. In May, we had this vehicle for only 2 days. Doesn't matter. Even if you own the vehicle for 1 day in that month you will count fully. It is per month or part thereof, which means even a part of the month you will count fully. Got it, guys? This was the first part of my answer. Now come on. They asked us to compute the total income of your assessee. So this was just the PGBP computation. Now I'll give the side heading total income. So from this trucks business, what is the income of the assessee? 16,82,500. Then we are having other income of 70,000. So the total income of your assessee will be 17,52,500. This is if your assessee follows 44A. Okay, and by the way, just like 44AD here also, if assessee follows 44A, assessee will enjoy some benefits. What benefits? Benefit number 1, assessee need not maintain books of accounts under 44AA. No need to maintain books of accounts, not required. Benefit number 2, no need to get the books of accounts audited under 44AB. Audit not required. But advanced tax you still have to pay in 4 installments. See, advanced tax you can pay only in the last installment. That benefit you have only in 44AD and 44ADA. 44A, only 2 benefits you have. No need to maintain books, no need to get the books of accounts audited. Okay, so this was the first part of my question. Now same question, part B. This, see, in part A we had computed with 44A. In part B now, what if assessee does not follow 44A? Then what will happen? Then in that case, from the trucks business, what is the income? See, they've already given. From the truck business, the income is 7,45,000 and other income of the assessee is 70,000. So in this case, 7,45,000 plus 70,000, 8,15,000. This will become the total income of your assessee. But here there will be consequences. Why consequences? Of course, presumptive taxation is applicable, but you're saying I will not follow presumptive taxation. I already told you presumptive taxation sections are mandatory sections, which means if they're applicable, you have to apply. But if you don't apply, then there will be consequences. Two consequences you will have, guys. Consequence number 1, you will have to maintain books of accounts under 44AA. You will have to maintain the books of accounts. It will become must for you. You have to maintain books of accounts. And consequence number 2, you have to get the books of accounts audited under 44AB. So both of these consequences will apply for you. Okay. So only 2 consequences. Now see which of the 2 assessee will prefer. If assessee follows 44AE, the total income is 17,52,500. But if assessee does not follow 44E, total income is only 8,15,000. So here income is lesser. So of course this is what assessee will prefer, but assessee, you have to be careful. You will have to bear the consequences in this method, but you will have to maintain the books and you will have to get the books of accounts audited. Got it? So this was your question number 26. With question number 25 and 26, 2 presumptive taxation sections are revised for you. 44AD we saw here and 44AE we saw now. Now come to question number 27. In question number 27, your assessment of firm, section 40 clause B, salary to partners, interest to partners, book profit, all that will get covered for you guys. Let's read the question first. The question says, Uttar and Dakshin, partners of PP Traders, furnishes the following information. So PP Traders is a partnership firm. There are 2 partners over here. P&L account they have given to us, gross profit, interest on drawings given to Uttar and interest on drawings given to Dakshin, 2 partners. Then bonus paid to employees, then interest on loan taken from the bank, then other expenses, then salary to partners. We're having 2 partners, we've paid salary to 2 partners. Then interest on capital at 15% we have paid to both the partners. Then depreciation is 40,000 and net profit is 3,35,000. Oh, 3,55,500, sorry. Okay, then they've given us more information. Depreciation for the year is 30,000. So which means whatever depreciation they have given to us as per the P&L account, this is incorrect. The correct depreciation is 30,000. Then during the last year, firm incurred a loss of 18 lakhs. I made a change, okay. I made a change in the question because I want to show you the complication part. So during the last year, firm incurred loss of 18 lakhs. So this current year information is 25-26. Last year means 24-25. So last year assessee is having a business loss of 18 lakhs, which includes unabsorbed depreciation of 2 lakhs. So in 24-25, what is our business loss which is brought forward? 18 lakhs includes depreciation 2 lakhs. So business loss brought forward will be 16 lakhs and unabsorbed depreciation brought forward will be 2 lakhs. Okay. Interest on loan taken from the bank is yet to be paid. Compute the total income of the firm. So they've asked us the total income of the firm. We'll go step by step. When we do firm computation, assessment of the firm, the most important adjustment is section 40 clause B, which is interest to partners and salaries to partners. So I'll show you the whole format, okay. This is the first time we are seeing a question with respect to firm, but we have multiple questions. So again and again you will get a revision. So have a willingness to learn, have an open mind, and let's begin. So we'll work out the answer in parts, okay. Let's start with our very first part, part 1. Part 1 is going to be section 40B. In 40B, we'll do the interest computation also and the salary computation also. Interest to partners and salary to partners. Okay. So, under this, first let's talk about interest. So, when it comes to interest, total how much interest are we paying to the partners? Interest on capital, 15% we are paying to the partners. But how much will be allowed? Only 12% will be allowed. So what is the excess above 12%? 3%, right? That excess 3% will be disallowed. So when it comes to interest, what is the actual interest which the firm has paid to the partners? 15%. And that 15% amounts to how much? 4,500 plus 6,000, which is 10,500. But out of this interest, how much is going to be allowed for the partnership firm? Maximum 12% only will be allowed. How much will the 12% be? Simple cross multiplication, guys. If 15,000 is 10,500, then what is 12%? That is nothing but 10,500 into 12 by 15. How much will that be? that is 8,400. So this only is going to be allowed for the firm. So therefore, what is going to be disallowed for the firm? What is the excess interest above 8,400? The excess interest above 8,400 is 2,100. This will be disallowed for the firm. So when it comes to interest for the firm, we will allow only 8,400. We will disallow 2,100. Okay, this is about interest. Then comes the second part of our discussion with respect to salary. Salary which we have paid to working partners. Now, how much salary has the firm paid to the working partners? See, it's given here. Salary to partners 4,88,000 and 9,76,000. Now, out of this, how much will be allowed for the firm? It depends upon book profit. So, we will first compute the book profit of this firm. Now, how do you compute book profit? Book profit is nothing but normal usual PGBP. Consider all PGBP adjustments, just don't consider salary to partners. In simple words, without debiting salary to partners, find the PGBP, that will become your book profit. Okay, so what's your net profit number given to you already? The net profit given to us is 3,55,500. Come to the credit side first. Gross profit, nothing to do, guys. Then interest on drawings which the firm is collecting from the partners, even this will become taxable income for the firm, nothing to do. Then coming to the debit side, bonus paid to employee, nothing to do. It's an allowable expense, already debited. Interest on loan taken from bank, be careful. The question says interest on loan taken from bank is yet to be paid. So we have incurred this expense but we have not paid. When you don't make the payment, you think about section 43B. See, if I have to pay interest to the bank, or if I have to pay interest to the public financial institution, or if I have to pay interest to NBFC, or if I have to pay interest to SFC or SIIC, all these cases 43B comes into the picture. 43B says make the payment within 139 1 date, only then that expense will be allowed. But here the question says assessee is yet to pay this interest. It is not yet paid. So because it is not yet paid, applying 43B, we will disallow this entire interest. But don't worry assessee, later whenever you make the payment of this interest, in that year it will be allowed again for you. So applying section 43B, I am going to disallow the interest. How much is the interest amount? 45,000. Understanding? Assessee has incurred interest expense. Assessee has to pay interest expense to bank. 43B will come into the picture. 43B says make the payment within 139 1 date, only then the interest will be allowed. Assessee has not made the payment within 139 1 date, therefore this interest will not be allowed. Okay, other expenses will be allowed. Now comes salary to partners. We have already debited salary to partners. What are we computing? Book profit. Book profit means what? PGBP without debiting salary to partners. But we have already debited. It's okay. Reverse it. How will you reverse a debit? By crediting it. Add it back. So I'll add back salary to partners. What is the total salary add up? 4,88,000 plus 9,76,000. 14,64,000. This is also done. Then interest on capital. This we have already computed and we have kept ready. How much are we going to disallow? How much are we going to add back? What is the excess amount? 2,100. Then depreciation, be careful. The depreciation which is given to us in the P&L account is not correct. The correct depreciation is 30,000 they gave us. So whatever is debited to the P&L, I'll reverse it. I'll add back the depreciation as per P&L account. The amount is 40,000. I will add it back and then I will allow depreciation as per section 32. As per section 32, what is the correct amount of depreciation? 30,000. That's it, guys. Give me the net number as of now. As of now, if you see how much is your net number after adding and subtracting all these numbers, your net number is 18,76,600. Okay, but it is not over here. We still have one more adjustment left. Whenever you're computing book profit, in case you have unabsorbed depreciation brought forward, you are supposed to adjust that also, because even unabsorbed depreciation is PGBP adjustment. I'll repeat once again. When you're computing book profit, you're supposed to consider all PGBP adjustments. Even unabsorbed depreciation is a PGBP adjustment, so you're supposed to consider that also. What about business loss brought forward? See, business loss brought forward is a set off and carry forward chapter adjustment. It's not a PGBP adjustment. So when you're computing book profit, you will consider all PGBP adjustments, unabsorbed depreciation brought forward also, you will consider. So unabsorbed depreciation brought forward is how much? 2 lakh rupees. But again there's a problem. This 2 lakh rupees as it is, you can't adjust. You'll have to do one working. You'll have to see how much unabsorbed depreciation you can adjust. I'll show you. Leave 2-3 lines gap and then write down under this point itself. We are basically still under first part. Under first part we are computing how much interest and salary is allowed to the partners. Interest we have already done the discussion. We're doing salary discussion right now. In salary discussion we are doing book profit calculation. So inside this, put one more part over here, one more arrow over here, write down, give the heading unabsorbed depreciation to be adjusted. See, what is the book profit of your assessee as of now? Book profit before adjusting unabsorbed depreciation. That's the only adjustment left, right? Everything else we have completed. So book profit just before adjusting unabsorbed depreciation, how much do we have? 18,76,600. We have to adjust unabsorbed depreciation. Unabsorbed depreciation is 2 lakh rupees for us, but we can't adjust it fully as it is. Why? Because there's a sequence. We are always supposed to adjust business loss brought forward first, then only we are supposed to adjust unabsorbed depreciation, guys. Because business loss brought forward has a life of only 8 years, but unabsorbed depreciation has indefinite life. So we are supposed to adjust business loss brought forward first, then only we are allowed to adjust unabsorbed depreciation brought forward. So that is the side working we are doing over here. We are checking how much unabsorbed depreciation is it possible for us to adjust. See, what's a business loss brought forward? The question had said, let's read this adjustment once again. The question had said firm incurred a loss of 18 lakhs. No, make it 20 lakhs. Firm incurred a loss of 20 lakhs, which includes unabsorbed depreciation of 2 lakhs. So my business loss brought forward from last year is 18 lakhs, right? Total is 20 lakhs, which includes depreciation of 2 lakhs. So the loss will be 18 lakhs and the unabsorbed depreciation brought forward will be 2 lakhs. Okay, so my book profit over here is 18,76,600. From this, I will first adjust my business loss brought forward, which is 18 lakhs. So how much profit am I still left with? 76,600. So now tell me how much unabsorbed depreciation I can adjust. I have unabsorbed depreciation of 2 lakhs, but I can adjust only 76,600. So what's your net number now? Your net number will become 0. So now tell me, even though my unabsorbed depreciation is 2 lakhs, how much unabsorbed depreciation is it allowed for me to adjust? Only 76,600. Now, did you understand the whole logic behind the side working? Through this working, we're just trying to find out that even though my unabsorbed depreciation is 2 lakhs, out of that, how much am I allowed to adjust? Because we can't adjust it directly fully. The reason being, we have to follow a sequence. We have to first adjust business loss brought forward, then only we have to adjust unabsorbed depreciation. So, but then why are we not doing this here itself directly in a book profit calculation? Because in a book profit calculation, business loss brought forward, we should not adjust. Because business loss brought forward is a set off and carry forward chapter adjustment, not a PGBP adjustment. So coming back, book profit is nothing but PGBP. Considering all PGBP adjustments, just don't debit salary to partners. So when you're doing book profit calculation, you will also consider unabsorbed depreciation brought forward. But whatever is the unabsorbed depreciation brought forward, you will not directly subtract. You will first do one side calculation. You will check how much is it allowed for you to subtract. So that much only we will bring over here. So even though my unabsorbed depreciation is 2 lakhs, I will be able to subtract only 76,600 as concluded over here. So now tell me, what is the book profit of your firm? The book profit of your firm is going to be 18 lakh rupees. Okay, so we have the book profit number. Now once we have the book profit number, we can find the maximum allowable working partner salary. So inside the same part, inside the same working note, I am making my next part, which is maximum allowable working partner salary. Maximum how much salary is allowed for the firm, it depends upon the book profit of the firm. What is the book profit of the firm? We just computed. Book profit of the firm is 18 lakh rupees. Now this 18 lakhs I will split into 2 parts, guys. The first 6 lakhs of my book profit and the balance book profit. What will be your balance then? Balance 12 lakhs. On the first 6 lakhs, you will compute 90% or 3 lakhs, whichever is higher. What is 6 lakhs into 90%? 5 lakh 40. So 5 lakh 40 or 3 lakh, which is higher? clearly 5 lakh 40 will be higher. Then on the balance book profit, you will simply take 60%. So 12 lakh into 60% will be 7 lakh 20,000. That's all. So you already have now the maximum allowable working partner salary 7 lakh 20,000 plus 5 lakh 40. 12 lakh 60,000 will be the maximum allowable working partner salary. But what is the actual salary? How much actual salary are we paying to the partners? Come on, write that now. The actual salary that we are paying to the partners is 4 lakh 88,000 plus 9 lakh 76,000. So actually we are paying 14 lakh 64,000, which is more than the maximum limit. Therefore, how much is going to be allowed for the firm under section 40B? We are paying salary which is more than the limit. So 12 lakh 60 only will be allowed for the firm. Perfect clarity? Yes. So first we did our interest calculation. Interest 8,400 was allowed, 2,100 was disallowed. Then we did a book profit computation for the purpose of salary. In computing book profit, we considered all PGBP adjustments including unabsorbed depreciation. But how did we find out how much unabsorbed depreciation is to be adjusted? For that we did one note over here. We first adjusted business loss brought forward and we saw how much unabsorbed depreciation we are allowed to adjust. That much only we adjusted over here. Okay. So once we had the book profit number, we found the maximum allowable working partner salary. Then we realized our actual salary is more than the maximum limit. So we are now restricting it to the limit. Okay. This was the part 1 of our answer. Now come on, let's come to part 2. What are they actually asking us in the question? They are asking us to find the total income of the firm. That's going to be a part 2. The total income of the partnership firm. I'll show you how to do it. See, I want you to first start with the book profit of the firm before unabsorbed depreciation. What was the book profit of your firm before unabsorbed depreciation? This number, guys. Before adjusting unabsorbed depreciation, what is the book profit? 18,76,600. 18,76,600. Okay. From this, adjust the salaries. How much salary are we going to allow? How much salary are we going to allow under section 40B? We already did the calculation. We realized our actual salary is more than the limit. So we're going to restrict it to 12,60,000. So 12,60,000 is what we are going to allow. So now with this, what's your net number? Your net number now is 6,16,600 rupees, guys. Then you will adjust your business loss brought forward. How much is a business loss brought forward? 18 lakhs. But sorry, assessee, we will be able to adjust only 6,16,600. So the final PGBP of the assessee, also the total income of the assessee, is 0. Now what is a business loss which we are going to carry forward to the next year? Our business loss was actually 18 lakh rupees, out of which we were able to adjust 6,16,600. So what is a balanced business loss which you're going to carry forward to the next year? 11,83,400. Now what about the unabsorbed depreciation? How much are we going to carry forward? My unabsorbed depreciation is 2 lakh rupees. We were not able to adjust that 2 lakh rupees anywhere in this calculation. So fully we will carry forward. Now you will say that, ma'am, no, unabsorbed depreciation we adjusted, no. 76,600 we adjusted, no. All that was in book profit calculation. That was not the actual adjustment. We did all this only for the purpose of book profit. So we will take the book profit number before unabsorbed depreciation. Remember the sequence? We will take the book profit number before unabsorbed depreciation. We will adjust the salaries that we are going to allow. Then we will adjust business loss brought forward. Then we will adjust unabsorbed depreciation. That's the sequence. Okay. So salaries we adjusted 12 lakh 60. Business loss is actually 18 lakhs, but we're able to adjust 6,16,600 only. So the balance business loss we will carry forward. Unabsorbed depreciation we were not even able to adjust over here. So this 2 lakhs we will fully carry forward. Getting my point? See, in case you're getting confused, it is because of this point. I did not take the book profit as it is. I took the book profit before unabsorbed depreciation. Understanding? So in this calculation, I have not adjusted unabsorbed depreciation anywhere. I took the number before unabsorbed depreciation. Okay. So unabsorbed depreciation 2 lakh is fully remaining unadjusted over here, which will be carried forward. So total income sequence you understood? I will start with the book profit. See, I'll put the sequence for you. I will start with the book profit before unabsorbed depreciation. Then I'll adjust salaries under section 40B. What about interest? Interest is already adjusted in book profit calculation. No. So only salaries we will adjust. Then we will adjust business loss brought forward. Then we will adjust unabsorbed depreciation brought forward. That is how we will get the PGBP of the firm. Okay, so here we did not have any profit left to adjust unabsorbed depreciation. That is why entire unabsorbed depreciation we are going to carry forward. So this is the final answer. Your total income is 0. Okay, it's an amazing question, guys. It gives you a very good clarity of the entire concept with regards to this section 40B and book profit calculation. Alright, this was your question number 27. Now come on, let's start with question number 29. This is your first full-fledged question on PGBP. They've given us a bank account of our assessee and they're asking us to find the GTI. So let's begin. The question says, Mr. Sunil is a practicing chartered accountant. He runs a private coaching institute. His bank account is given to you. They've not given you the P&L account, they've given you the bank account. So we have all the receipts on this side and all the payments on this side. Okay. Then they've given us some additional information. What are they asking us? Compute his gross total income for the assessment year, assuming he maintains accounts on cash basis. See, when it comes to the PGBP head and the IFOS head, in these two heads of income, the method of accounting followed by the assessee is relevant. If assessee is following cash basis, then when we are doing computation, we will also consider cash basis of accounting only. If assessee follows accrual basis, when we are doing computation under these two heads, we will also follow accrual basis only. So if assessee is following cash basis, what does it mean? In these two heads of income, when will we consider incomes? We will consider incomes only when assessee actually receives the income. And when will we consider expenses? We will consider expenses only when assessee actually makes the payment of the expense. So we have to follow the cash basis of accounting while we compute the PGBP and IFOS of the assessee. Okay guys, so let's get to work. Let's begin. We are computing the gross total income of our assessee. Which regime are we following? The question doesn't say anything. So because the question doesn't say anything, by default we will be following the new regime. Okay, so come on, let's start. First of all, looking at the receipt side. Audit fees. Assessee is a chartered accountant. He is receiving audit fees. This will become his professional income. This will go into the PGBP head. So under GTI, I'll open PGBP, give reference to working note number 1. I'll open working note number 1, PGBP. Okay, now see guys, here we don't have the net profit number. So what we will do is, we will just take all the taxable incomes, okay, and from that we will subtract the expenses, and that's how we'll get our PGBP number. Okay, so audit fees will become one of the professional incomes. So we'll consider the audit fees. What is the amount? The amount is 22 lakh rupees. So like this, we'll consider all the business incomes. We will subtract all the business expenses and we'll get our PGBP number. Income minus expense, PGBP we will get. Okay. Then we have income from other professional work. So other professional income, even that will come into PGBP head. The amount is 1 lakh rupees. Okay, then we have coaching fees. Remember, the question says assessee is a chartered accountant. He's a practicing chartered accountant and he's also running a private coaching institute. So this is not his main business. His main business, his main profession is he's a practicing CA. In addition to that, he's running a private coaching institute. So this will become other income for him. This coaching income will go under IFOS head. So come to your main answer. Write down IFOS. Give reference to working note number 2. After working note number 1, leave gap of some 7 to 8 lines and then open working note number 2, IFOS. So here we are having coaching fees. What is the amount? 1,200. Done. Then interest on investment. Assessee is having interest income on investment. Even this will come into IFOS head. So how much is the interest income? 2,000 rupees. Fine, this is also done. Then assessee is receiving examiner fees. All this will come under IFOS head. Only the main professional income. Assessee is a practicing CA. Income from his practice, this only will come under PGBP. All other incomes, IFOS. So examiner fees, what is the amount? 1,000 rupees. Then assessee is having rent from property. This will go into IFHP head. So come to your main answer. Write down IFHP. Give reference to working note number 3. After your working note number 2, leave some 3 to 4 lines gap. Open working note number 3, IFHP. In IFHP, the only information that we know right now is rental income from the property, which is 5,000. We need a lot more information to compute IFHP. We need municipal value, fair rent, standard rent. We need a lot of information. So we'll keep this pending. When we read the question, maybe they've given us more information. With that, we will compute later. Okay. Did you notice my style of computing? Did you notice I did not even waste my time reading the whole question? As I'm reading the adjustments, I'm opening the required working notes. This will help you save a lot of time in the examination. Okay. So rent from property, IFHP is still pending. We'll come to it later. Then office expenses. This will become my professional expense. So I'll subtract this in my PGBP. So less office expense amount is 18,000 rupees. And see one more thing, okay, all these are in the bank account, which means assessee has actually paid for these expenses. Why am I saying that? Because assessee is following cash basis of accounting. So I will consider expenses only if assessee has actually paid for the expense. And all of this is in the payment side of the bank account, which means assessee has actually paid for the expense. So we can consider the expenses. Okay. Then we have municipal tax on the property, 800 rupees. In my IFHP head, I'll just make a note of it. We haven't started computing it. Municipal tax is 800 rupees. Then coaching expense. Coaching fees has come to IFOS. So coaching expense also will come to IFOS. So coaching fees was 1,200 minus how much expense have we incurred? 800. So 1,200 minus 800, 400 will be your net income from coaching. Okay, this is done. So basically, if the income is coming under IFOS, corresponding expense will also come under IFOS. Then personal expenses, you won't do anything. Membership fees. Assessee is a chartered accountant, so he would have paid membership fees. It's an expense connected to his profession. So I'll subtract it in his PGBP computation. Membership fees amount is 500 rupees. Okay, then life insurance premium, this will go under ATC only, chapter 6A, but they asked us only for GTI, so chapter 6A doesn't matter over here. Income tax is a personal expense, I will not consider. Then motor car purchased, on this we will claim depreciation. But see, the question says 20% of the car expenses is in respect of the profession. So only 20% of the car we are using for business or profession. The balance 80% of the car usage is for personal purposes automatically now. So let's compute depreciation on the car. So less depreciation on car, show the computation. We purchased the car for 1,80,000. Let us assume we put the car to use for at least 180 days. So I will get full year's depreciation. What's the depreciation rate for motor car? Motor car will come under plant and machinery. General plant and machinery depreciation rate is 15%. But however, this will become the total depreciation for the motor car. But only 20% of the car is used for business or profession. So only 20% depreciation will be allowed. Understanding, the balance 80% of the car is not used for business or profession. So the balance 80% depreciation will not be allowed. Only 20% depreciation will be allowed. How much will this work out to? My depreciation on the motor car will be 5,400 rupees. Okay. Then motor car expenses. So less motor car expenses. What is the expense amount? 10,200. Whole amount I will not subtract. 10,200 is a total expense. Only 20% of the expense is relating to business or profession. So only 20% I will consider. How much will this be? 10,200 into 20%, 2,040. Balance 80% of the car is used for personal purposes. So balance 80% of the expense will be personal expense. I will not consider. Then insurance of property. The property will come under IFHP head. So insurance of property is not a business expense. So it will not impact my PGBP computation. It will come into IFHP head. But even in IFHP, we don't consider the insurance expense and all, right? Basically, we consider 30% standard deduction. That itself includes all expenses. So this insurance of property, first of all, no PGBP head because it is relating to house property. Then in IFHP also, it will not have any role to play because standard deduction itself will include all expenses. So nothing to do about that. Okay. Then after this, the question says depreciation allowance for motor car is 27,000 if wholly used for profession. See, for motor car, we have already calculated depreciation. If I use the car only for profession, what's the total depreciation? 1,80,000 into 15%, 27,000. That 27,000 only they have given to us. So they are saying if the car is used only for profession, then in that case the depreciation will be 27,000. But however, we know that because only 20% of the car is used for profession, so only 20% depreciation only we will get. So 27,000 into 20% is 5,400. We have already done that calculation. So this is only repetition of the adjustment which we have already done. So nothing is left for me to do again over here. I have already allowed the depreciation. 27,000 they are saying is the total depreciation if I use the car wholly for profession. But in reality, we are not using the car wholly for profession. In reality, only 20% of the car we are using for profession. So only 20% of 27,000 will be allowed, which is 5,400, and we have already allowed that 5,400. So nothing is left for me to do. Then the question says, outstanding fees is 2,000 rupees. What about this? Assessee is yet to receive 2,000 rupees fees. I don't care about this. Assessee is following the cash basis of accounting. So only when assessee receives this fees, only then I will consider it in PGBP. Remember, we even made a note over here. Because assessee is following cash basis, we will consider an income only when assessee actually receives the money. But this is still outstanding. Assessee has not received till now. So therefore, right now I will not consider. In the future, when the assessee receives the money, that time only I will consider this amount. Okay. Then the question says, 500 rupees receivable from Mita is considered as bad. Now what do you think? Will I consider this 500 rupees as bad debts over here? No, I'll help you understand. See, my assessee is following the cash basis of accounting, which means I will consider an income only when my assessee actually receives the money, then only I will consider the income. Point number 1. Point number 2, do you remember in an earlier session I had spoken to you about the conditions with respect to bad debt? I had told you that we will allow bad debt in our PGBP computation only if some conditions are fulfilled. And one of the conditions was that earlier that debt should have been included in income. Now such debt, if it is becoming irrecoverable, we will allow it as bad debts. So the condition is earlier it should be included in income. Okay, now listen to me. Assessee has to receive 500 rupees from Mita. It is receivable from Mita, but assessee has not received it till now. Assessee is considering it as bad, which means assessee wants to call this 500 rupees as bad debt. Bad debt means what? Assessee has not received the money. Also, assessee is not going to receive the money. That is the meaning of bad debt, guys. Neither assessee has received it, nor assessee is going to receive it. So, has your assessee received the money? No. Because assessee has not received the money, would you have considered this money as income earlier? No. Because assessee is following cash basis, you will consider an income only when assessee receives the income. But here it is receivable. Assessee has not received it till now. Therefore, because assessee has not received it till now, this money is not taxed as income till now. Now, you can allow bad debt only if the amount was earlier included in income. Tell me, is this amount earlier included in income? It is not earlier included in income because we did not receive it. It was earlier not included in income. So, because it was not included in income, will you allow it as bad debt? You will not allow it. Very interesting. If you go with the flow, if you actually apply the provision, this is how my interpretation will be. I did not even consider this amount as income earlier. So condition is not fulfilled. Therefore, bad debt will not be allowed. That's all, nothing to do. I will ignore. Okay. Then comes my next adjustment. Outstanding fees of 20 to 23. So long back, 20 to 23's fees 10,000 we received during the year, which is included in the audit fees. Okay, great. Assessee is following cash basis. So I will consider income only when I receive it. It is 20 to 23's income, but we received it during the year. So yes, we should consider it as income. And thankfully, it is already included in the audit fees. So there is nothing left for me to do. See, here they're trying to confuse you by saying it is 20 to 23's income. Doesn't matter. The income is belonging to which year, it doesn't matter. What matters is when did assessee receive the income. Assessee received the income in the current year. So current year it will be taxed. And current year it is already included in audit fees. So nothing left for me to do. Similarly, office expenses includes payment of 2,000 incurred during 24-25. So in expenses, I have 2,000 rupees payment which is relating to 24-25. Same thing. The expense is belonging to 24-25, but we made the payment in the current year. We will consider an expense only when the payment is made. So the expense belongs to 24-25. I don't care. What I care about is when did the payment happen. Payment happened in the current year. So I will consider it as an expense in the current year, and it is already included in the office expenses, which means we have already considered the expense. Nothing left for me to do. That's it, guys. Now come on, let's close our answer, add and subtract, and give me the net PGBP of your assessee. Net PGBP of your assessee will be 22,74,060. This will be the net PGBP of your assessee. Bring it to your main answer. 22,74,060. Then what about the IFOS? IFOS of the assessee is 3,400. Take it to your main answer. Then what else are we left with? IFHP head. We have to do the computation. No other information they have given to us, guys. We have rental income, which means definitely it is a let out property. So let out property, we start by checking how many months assessee owns a property for. Assessee owns a property for all 12 months. And you remember in IFHP, I've taught you one shortcut. Municipal value, fair rent, standard rent. None of the three numbers if they give you, then you can use a shortcut. As per the shortcut, your GAV will be actual rent minus unrealized rent minus vacancy loss. We don't have unrealized rent, we don't have vacancy loss. So my actual rent 5,000, this itself will become my GAV, less municipal taxes paid. We paid municipal tax of 800 rupees. So 4,200 becomes our net annual value. From this we will subtract deductions under section 24. Okay, so deductions under section 24, we will have two numbers. Number one, we will have standard deduction, and number two, we will have interest on borrowed capital. Standard deduction will be at 30% of NAV. So 4,200 into 30%, 1,260. We read the whole question. We did not have any interest with respect to the house property. So your net IFHP will be 2,940. Okay, take this to your main answer. That's all. Give me the GTI of your assessee now. 22,80,400. This is the GTI of your assessee. Okay, they asked us for GTI only, so I will not bother about chapter 6A and all. Alright, so this was question number 29, your first full-fledged question with respect to PGBP. And one more unique thing about this question was they did not give us a P&L account. They gave us a bank statement. So when we computed PGBP, we did not use the 5 steps, the indirect method, the net profit number, add expenses, subtract incomes. We didn't do all that. We straight away took the taxable incomes, we subtracted the allowable expenses, and we got our PGBP number. Got it, guys? This was your question number 29. Now come to question number 30. This is also another nice full-fledged question with respect to PGBP. The question says, from the following particulars of Shri Kote for the year ending 31st March 26, find out his taxable income from business. So they're asking us only PGBP over here. They're not asking us for GTI and all. So they're asking us to find PGBP. They've given us a P&L account. We have the net profit number over here. Then they've given us 11 adjustments. They're asking us to find business income. Okay, so let's get to work. Let's begin. They did not tell us which regime assessee is following. So by default, it's going to be the new regime only. So we have to compute PGBP over here. We are going to be following the new regime. Okay, now see, here we have the net profit number. Whenever we have the net profit number in the question, to compute PGBP, we will use a 5-step approach. 5 steps. We'll start with net profit as per P&L account. We'll add expenses debited but not allowed. We'll add incomes which are not credited but taxable. Then we'll subtract expenses which are not debited but allowed. We'll subtract incomes which are credited but not taxable. So 5-step approach we will follow to compute PGBP, because we are having the net profit number over here. See, there are 2 methods of computing PGBP, okay? One is called as the direct method and one is called as the indirect method. In the direct method, this is what we did in the last question. They did not give us the net profit number. So because they did not give us a net profit number, we took the taxable incomes, we subtracted the allowable expenses, and that is how we got our PGBP number, guys. This is a direct method. But however, there's one more method which is called the indirect method. This method we follow whenever they give us a net profit in the question. So if they've given us the net profit in the question, we follow the indirect method, and here we follow 5-step approach. Now what is this 5-step approach? Look at this. We will start with the net profit as per P&L account. We will add expenses which are debited but not allowed. So you will reverse the debit by crediting it, by adding it. You will add incomes which are not credited but they're taxable, but we did not credit them. So we will now credit them. We will now add them. Then we will subtract expenses which are not debited but they are allowed expenses, but we did not debit them. So we will now debit them. We will now subtract them. Then we will subtract incomes which are credited but they are not taxable. So because they are not taxable, we should not credit them, but they are credited. So how will you reverse a credit? By debiting it, by subtracting it. This is your 5-step approach. Okay, come on, let's begin. So they've given us the P&L account. We have the net profit number. Look at the credit side first. Profit on sale of import license. This should be taxed under PGBP head. It's a business income. It's already credited to your P&L. There's nothing left for you to do. Then gift received. See, with respect to gift, one adjustment comes a little later. Look at this adjustment number 6. Gift received was given by a supplier for achieving target sale. So the gift over here is not from friends. It is not from relatives. It is received from supplier because we achieved a sale target. So this gift over here is also relating to your business or profession, and it is already credited in the P&L account. It's taxable under PGBP. Already credited. Your net profit already includes it. So there's nothing left for you to do. Then closing stock, nothing to do. So with this, guys, we're done with the credit side. Now come to the debit side. Opening stock, nothing to do. Purchases, salary, legal expenses, bad debt, rent, interest on loan, depreciation, all these are business expenses. As of now, nothing to do. Later when we see adjustments, if there is something to be done, we'll do it later. Then what about income tax? Income tax is a personal expense, guys. It should not be debited to the P&L, but it is debited. How will you reverse a debit? By crediting it. Crediting means what? You will add it back. So add expenses debited but not allowed. Here I'll add back the income tax amount. The amount is 2000 rupees. Okay. Then comes your next adjustment. Outstanding customs duty, business expense, advertisement, legal expenses. They are all business expenses. What about contribution towards URPF? See, if employer is contributing towards RPF, it will be allowed for the employer. But contribution towards URPF, this will not be allowed for the employer. But it is debited. So how will you reverse a debit? By crediting it, you will add it back. So URPF, employer's contribution, the amount is 5,000 rupees. I'll add it back. Had it been contribution to RPF, I would have allowed. But this is contribution to URPF, I will not allow. Then general expenses, travel expenses, and net profit is 2,58,000. Make a note. Okay. With this, our P&L account is done. Now come to the adjustments. Interest on loan. First of all, do you remember we had interest on loan over here, 2,500 rupees. They've given information about that. Interest on loan is paid to brother of Shri Kote for loan taken for payment of advance income tax. See, when I borrow a loan and if I use the loan for my business or profession, then on that loan, whatever interest I pay, that interest will be allowed in PGBP computation. I hope you remember this point. In the first session, we had seen this point. Over here, however, we borrowed the loan for what purpose? The purpose is payment of advance income tax. So we borrowed the loan. The purpose of the loan is to pay income tax. So is the purpose relating to business or profession? No. Paying income tax is a personal purpose. Is paying income tax business purpose? It is not business purpose. So if the loan is not for the purpose of business or profession, then whatever interest we have paid on that loan, that interest is not allowed in PGBP computation. But this interest is already debited to P&L. So how will you reverse the debit? By crediting it. So you will add it back. Interest on loan. The amount is 2,500. Why am I adding it back? Because the loan is not used for business or profession. The loan is being used to pay income tax, which is not a business purpose. That is why I am reversing the interest. I am disallowing the interest. Okay. Then the question says, during the previous year 21-22, long back, assessee claimed 45,000 as bad debts, out of which 35,000 was allowed. During the previous year, he recovers 25,000. Very important adjustment, guys. I'll open a working note for you. So, working note number 1, bad debt recovered. See, long back in 21-22, understand the adjustment first. Long back, assessee claimed 45,000 as bad debt. So earlier, the debt amount, the amount that we had to receive from debtor was 45,000, and we were saying that this amount we will not receive. So we wanted to claim 45,000 as bad debt, but out of that only 35,000 was allowed. So how much bad debt was actually allowed? Only 35,000 was allowed for us. So therefore, what is the receivable amount now? The receivable amount is 10,000 rupees. 10,000 rupees more we are supposed to receive from the debtor. Understanding, the debt was originally 45,000. We wanted to claim full 45,000 as bad debt, but we claimed only 35,000 as bad debt, which means the balance 10,000 is not bad debt. Balance 10,000 is still receivable. But how much did we receive now? We received now during the previous year, he recovers 25,000, guys. He is recovering 25,000. How much was receivable? 10,000. How much did we receive? 25,000. So do you agree that we have received excess? Over and above 10,000, how much extra we have received? We have received 25,000. What is the excess above 10,000? Excess 15,000 we have received, guys. This excess of 15,000 that we have received, this is going to become bad debt recovered, which will be taxed for us under the PGBP head. Understood? You understand how we should think? We should go step by step. We should first find how much is receivable from the debtor. Okay. Then we should see how much did we actually receive. Oh, we were supposed to receive 10,000, but we actually received 25,000. So how much extra we received? Extra 15,000 we received. That becomes bad debts recovered, and it should be taxable under PGBP. But we saw the whole P&L account. Was this bad debt recovered, credited in our P&L account? It was not credited. No, it was not taxed. So we have to now tax it. We have to now credit it. Credit means what? Add it. We have to now add the income. So it's an income which is not credited, but it is taxable. Bad debt recovered. Give reference to working note number 1. The amount is 10,000. No, sorry, 15,000. Bad debt recovered, 15,000. Okay, it was not taxed in our, it was not included in our P&L. So it was not credited. So we are now crediting it. We are now adding it. Okay, this was a second adjustment. Then comes a third adjustment. Contribution towards URPF was paid within time. I don't care when it was paid. URPF contribution is disallowed. That's all. Then legal expense includes 2,000 paid to prepare income tax return. We are having legal expense over here, right? It includes 2,000 to prepare income tax return. It is okay. Even this is considered for the purpose of business or profession. It will be allowed. See, income tax is a personal expense, but your income tax return has to be prepared. For that, you paid something to the lawyer. It will be considered as business or professional expense. No problem. Then stock is undervalued by 10%. Opening stock, closing stock, both is undervalued by 10%. I'll give you one small tip over here. Listen to me. See, opening stock, closing stock, overvalued, undervalued. Silly mistake happens over here. When to add, when to subtract. One simple tip I will tell you. O add. Repeat again. O add, which means if opening stock is overvalued, O add the difference. For logic and all, you must be knowing. You must have learned the logic and all in your regular class. I am just helping you get the tip and get the point in your memory. So opening stock overvalued, you will add the difference. If you remember this, everything else will fall in place. Tell me, if opening stock overvalued you're adding, then obviously opening stock undervalued, what will you do? You will subtract. If opening stock overvalued you're adding, obviously closing stock overvalued, what you will do? Ulta, no. You will subtract. If closing stock overvalued you're subtracting, then closing stock undervalued, what you will do? Ulta. You will add. Getting the point? So if you just remember this part, that you're supposed to add. If you just remember this part, everything else will fall in place. So in this question, they are saying that opening stock and closing stock is undervalued by 10%. So let's open a working note. By the way, opening stock undervalued, what will you do? You will subtract, and closing stock undervalued, you will add. So let's open a working note. Working note number 2. Stock undervalued. Okay, so we have opening stock and we have closing stock. All right, so under this, write down amount reflected in P&L. How much is reflected in P&L? Opening stock is 1,20,000. Closing stock is 2 lakh rupees. And guys, the question says that all these numbers are undervalued. Undervalued by how much? They are undervalued by 10%. So I can see that these are all 90% numbers only. They are undervalued by 10%. So the 90% number only we have recorded in our P&L. So what will be the correct value then? What will the correct value be? See, this is the amount reflected in the P&L. This is 90% number. It is undervalued by 10% means this is 90% number. So what is the correct value? Correct value will be 100%. Simple cross multiplication. Like for opening stock, see, very simple. 1,20,000 is 90%. So therefore, what is 100%? They are saying it is undervalued by 10%. No, I'll give you one more way of thinking. I'll give you one more way of learning. If the correct stock number is 100 rupees, if the correct number is 100 rupees, okay, then we have undervalued by 10%. So how much we have recorded? We have recorded only 90. Now how much we have recorded? 1,20,000. So what is the correct number? Cross multiplication. Same thing only I was doing earlier. So 1,20,000 into 100 by 90. What is the correct number? The correct stock number will be 1,33,333. Similarly for closing stock, tell me. 2 lakh into 100 by 90. 2 lakh into 100 by 90 will be 2,22,222. So I have the amount which is reflected in my P&L. I have the correct value. So now give me the difference. 1,20,000 minus 1,33,333. I'll get 13,333. And closing stock 2 lakh minus 222,222. So 22,222. I have the difference. Now what to do with the difference? I already told you. Opening stock undervalued, we will subtract the difference, and closing stock undervalued, we will add the difference. Okay, so come back to your main answer. After the 5 steps, write down less opening stock undervalued, add closing stock undervalued. For both, give reference to working note number 2. Bring the amounts 13,333 and 22,222. Understood, right? So in the examination, when it comes to the stock adjustment, first do this small table in your margin. Understand what you have to do. Remember OO add. Once you remember this, rest of the table you can fill on your own. Then do this working note. See how much is recorded in the P&L. See what is the correct value. Find the difference, and the difference will be added or subtracted. Okay, so with this we're done with the stock adjustment. The gift adjustment we already saw. Then the question says outstanding customs duty has been paid on 31st December 2026. Which concept is this? I'll remind you. See, we have section 43B. Section 43B says if assessee has any tax, duty, cess or fee, 43B will apply. So all these expenses, assessee actually has to make payment when payment has to be made within section 139(1) date. Only if assessee makes a payment like this, only then that expense will be allowed. If assessee does not make the payment within 139(1) date, then the expense will be disallowed, guys. But later, whenever we make the payment, in that year it will be allowed. Now, what are the possible 139(1) dates? See, for our examination, whether June 26 examination, whether December 26 examination, for our examination, the possible 139(1) dates are either it can be 31st July 26, or it can be 31st October 26, or it can be 30th November 26, guys. So only these three are the possible 139(1) dates. Here the question says customs duty. So customs duty, first of all, 43B will apply. Payment has been made on 31st December 26. So do you agree that whatever be the 139 date, we have made payment after the 139 date? We are making the payment in December. The latest possible 139 date is November, but we are making the payment in December. So definitely we have not made the payment within 139 date. Therefore, that customs duty will not be allowed for us now. Later, when the assessee makes a payment in 26-27, next year assessee will allow it again, but this year it will be disallowed. You got the point? Step by step. First of all, 43B will apply to customs duty. Secondly, 139 dates are these only, but assessee is making the payment after 139 date. Payment is not made within 139 date, therefore it will be disallowed. Okay, so come back to your PGBP computation. So customs duty, it is debited to P&L, but it is disallowed. It should not be debited because we did not make the payment within 139 date. So we should not debit it. But we have debited, so we will reverse the debit by adding it back. So customs duty, what is the amount? 25,000. Okay, so with this we're done with our 7th adjustment. Now comes the 8th adjustment. During the previous year, he comes to know that his former employee had embezzled cash of 5,000 rupees on 31st March 2025, which was not accounted for. His former employee had embezzled cash. Embezzled cash means what? That cash was stolen. There is a theft of cash. Theft of cash is considered as a business loss. It is allowed in our PGBP computation. Now see, I want you to read the adjustment once again. There's a hidden point over here. The question says, during the previous year, he comes to know that his former employer had embezzled cash. So when did your assessee come to know about the embezzlement? In the previous year. Which previous year? Current previous year 25-26. This is when he came to know. What did he come to know? That there was an embezzlement of cash. Embezzlement of cash is also called as misappropriation of cash, and all this is nothing but theft of cash, which becomes a business loss, and this business loss will be allowed. But this business loss will be allowed when? See, will it be allowed? I'll give you two options. Will it be allowed in the previous year in which the theft happened? In that year, will this loss be allowed? Or will this be allowed in the year in which your assessee has come to know about the theft? Two different years are possible. Like in this question, assessee came to know about the theft in 25-26. But when did the theft happen? The theft of cash 5,000 rupees happened on 31st March 25, which is previous year 24-25. So in this question, if you see, the theft happened in 24-25, but we came to know about this only in 25-26. So two different years are involved over here. So now the provision says, I don't care when the theft happened. What I care about is when did we come to know about the theft? 25-26. So in 25-26, this theft of cash, this embezzlement of cash 5,000 rupees should be allowed. The question says it was not accounted for, so we will now account for it. We will now allow it. Now allow it means we will now debit it. Debit means we will now subtract it. So less expense is not debited but allowed. Under this, write down embezzlement of cash. What is the amount? 5,000 rupees. I am now allowing it. You got the point? They're trying to confuse you by saying that the theft happened last year. Doesn't matter when the theft happened. What matters is when did we come to know about the theft. Assessee got to know about the theft in the current year. So current year this loss will be allowed. Okay. Then traveling expenses. Do you remember we had traveling expense over here? 1 lakh rupees. They're giving us information about that. This traveling expense includes 50,000 cost of trip to Singapore. So foreign travel expense by an employee for 10 days. However, only 8 days of the trip is useful for business. The balance 2 days have been allowed as holiday to employee. It's okay. I mean, it's not a personal vacation. We're giving it to the employee only. 8 days he's using for business. 2 days he's using as a holiday. We will consider these 2 days as staff welfare expense and we will allow it. Getting it? So the total trip is for 10 days. 8 days is anyways business trip. So 8 days will anyways be allowed. The balance 2 days employee is using it for his holiday. We will consider it as staff welfare expense and even this we will allow. So it is supposed to be allowed and it's already debited in the P&L. So there's nothing left for me to do. Okay, then comes the 10th adjustment, rent. We had rent expense in our P&L, if you remember. Rent expense 50,000 we had. They're giving us information about that. Rent includes expenditure on extension of shed on rented building, 26,000 rupees. However, such extension was completed on 1st May 26 with a total cost of 50,000 rupees. So my rent expense is including 26,000 extension of shed. This is a capital expense, guys. I will remove it from my P&L. It's a capital expense. On this expense I should claim depreciation instead. But I can't claim depreciation also because this extension was completed only on 1st May 26. It was completed only in 26-27. So 26-27 next year only I can claim depreciation. Current year it is not ready. Current year I can't claim depreciation. So what do I have to do in the current year? Rent is including 26,000 capital expense. So I will remove the capital expense. It should not include capital expense, but it is including. It's already debited. I will remove the debit by crediting it. Crediting means I will add back. Add expenses debited but not allowed under this rent. The entire rent I will not reverse. Only 26,000 is relating to this extension of shed. This is a capital expense, and because it's a capital expense I will disallow. I will add it back. I will not claim depreciation because it is not even ready in the current year. It will be ready only in next year. Okay. Then we have general expenses. General expense includes salary of 1,200 paid to domestic servant. Now this is a house expense, household expense, personal expense. It's not a business expense. So you should not debit it to P&L, but it is debited. So you will reverse a debit by crediting it by adding it back. So salary to domestic servant, amount is 1,200. I'll reverse it, I'll add it back. Then compensation of 2,000 paid for retrenchment of employee. This is a business expense. You're making payment of retrenchment compensation to employee. It's a retrenchment. It's a retrenchment compensation, business expense. It is allowed, and it is already included in general expense. General expense is already debited in P&L. It is already allowed. There's nothing left for me to do. Okay, so this is it with all the adjustments. Now come on, they just asked us to find the PGBP. Add and subtract and give me the net PGBP of your assessee. $3,38,589. Are you getting this number? Check whether your number and my number matches. 3,38,589. This will become the PGBP of your assessee. Okay, so what were the interesting adjustments over here? The first interesting adjustment, this profit on sale of import license, it's a business income, which should be taxable under PGBP only. Then this gift was relating to our sales target. So it is relating to business only. So taxed under PGBP head only. Then after this, contribution towards URPF. RPF only is allowed under PGBP. URPF straight away will be disallowed. Then interest on loan relating to income tax. You were already aware of this. Then this bad debts recovered was a very interesting adjustment. First time we saw this adjustment, so I'll highlight it. Then URPF I already told you. Then legal expense includes 2,000 to prepare income tax return. This expense is allowed. This must have sounded interesting for you. Then the question says, what else was interesting? This embezzlement of cash was interesting. When it comes to embezzlement of cash, we will see in which year we got to know about the embezzlement. In that year, it will be allowed. Okay. Then outstanding customs duty, we applied 43B, which you all are already aware of. This 2 days, remember travel expense. 2 days employee is using 2 days for a holiday. That will be considered as a staff welfare expense. So that was interesting. Then this extension of shed. This is nothing but a capital expense, and hence it should not be allowed in P&L computation. We saw this, and then these 2 points were simple and straightforward. So that's it, guys. This was your question number 30. With this, I think we're good to close this session over here. So we're seeing some full-fledged PGBP questions back to back. So this session will close. In our next session, we will see some more full-fledged PGBP questions. We will start with question number 31 in our next session. Okay. I hope you're getting some solid clarity. I hope you are not just accepting the provision as I'm telling you. I hope you're understanding and also putting it in your memory, because there's no time to revise all this once again. This should be like your final learning. Okay, so I'll close the session over here. I'll see you in the next session. Bye-bye. Hello champions. So we are starting off with our next session on PGBP. We will straight away start off with question number 31. In our last session we did question number 30. So we're going to start off with question number 31, which is an LDR question. Okay. Let's see what the question says. It says, during 25-26, P&L account of Shri Raj, proprietor of Raj Enterprises, engaged in the business of ready-made garments, shows profit of 1,50,000. So they've given us the net profit number. With the following information, compute his taxable income from business. So only PGBP they're asking us. They're not asking us GTI, total income and all. They've given us a lot of adjustments. With these adjustments, we have to find PGBP. Now, even in the last session, I told you, there are two methods of computing PGBP, direct method and indirect method. Now, when the question has given us a net profit number, of course, I will use the indirect method, which is nothing but my 5 steps. So I've brought my 5 steps over here. Net profit as per P&L account, add expenses debited but not allowed, add incomes not credited but taxable, less expenses not debited but allowed, and less incomes credited but not taxable. So let's read the question. As we read the adjustments, we'll keep doing the necessary writing. Okay. So first of all, we have the net profit number. Net profit is 1,50,000. And by the way, the question does not tell us which regime to follow. So we'll by default, it is of course going to be the new regime. So as per the new regime, I'm going to be computing PGBP. Okay. So let's begin. With the following information, compute his taxable income from business. Interest on capital. Assessee is a sole proprietor. He is putting his capital money into the business. He is paying interest on that capital to himself. Remember, in the last session we had learned notional interest, notional rent, notional salary. We are paying expenses to ourselves. We are paying money to ourselves. This is going to be disallowed, guys. Disallowed means it should not be debited to P&L. All these adjustments are already debited or credited to P&L. So how will you reverse a debit? By adding it back, by crediting it, by adding it back. So I'll add back expense debited but not allowed over here, interest on capital. Understood, right? Assessee is paying interest to himself. He's a sole proprietor. He put capital in his business. On that capital, he's paying interest to himself. So he's paying money to himself. It becomes a notional expense. It will not be allowed. Therefore, I'm adding it back 5,000 rupees. Okay. Then purchase includes goods of 12,000 rupees from his younger brother in cash. However, market value of such goods is 9,000. This is an amazing adjustment, guys. I'll open a separate working note to give you good clarity on this adjustment. The question says purchase includes goods of 12,000 rupees. So 12,000 rupees. Okay. We purchased these goods from younger brother in cash. So this 12,000 payment was made in cash. Because payment was made in cash more than 10,000 rupees, purchase is an expense, and we made payment of 12,000 rupees, which is more than 10,000 rupees. We made the payment in cash, which is non-specified mode. Therefore, section 40A subsection 3 will come into the picture. 40A subsection 3 says, if I'm incurring an expense and if I'm making payment of the expense and if I pay more than 10,000 rupees in one single day to one single person against one single invoice, then I should make the payment in specified mode only. If I make the payment in non-specified mode under 40A subsection 3, it will be disallowed. So first of all, that is attracted over here because purchase, it's an expense, 12,000 rupees, more than 10,000 rupees. Payment is in cash, non-specified mode. So first of all, 40A subsection 3 will get attracted. Then the question says, market value of the goods is 9,000 rupees. Here, section 40A subsection 2 comes into the picture. For the very first time, we are seeing 40A subsection 2. Let me explain the section to you. 40A subsection 2, simple 3 conditions, okay. Condition number 1, assessee has incurred an expense relating to his business or profession. Condition number 2, the expense has to be either excess or unreasonable. That is, if you compare with the market rate, we are incurring a higher amount. And condition number 3, the other party has to be a relative. So if all of these conditions are fulfilled, then in that case, the entire expense will not be disallowed. If all the conditions are fulfilled, whatever is the excess expense, that excess portion alone will get disallowed under 40A subsection 2. Now here if you see, assessee has made a purchase which is an expense, guys. Condition 1 fulfilled. It is excess or unreasonable. Market rate is 9,000. We are paying 12,000. So it is excess by 3,000. Even second condition is fulfilled. Other party has to be relative. Relative means what? Relative means plus spouse with arrows. This is how you will remember. Which means if I am the assessee, my brother, my sister, my parents, grandparents, great-grandparents, and so on, my children, grandchildren, great-grandchildren, and so on, and my spouse. So the other party has to be any of these people. Here, whom did we make the purchase from? Brother. So brother and sister is coming under relatives, guys. So all my three conditions are fulfilled. So what is the excess portion? The excess is 3,000 rupees, right? That 3,000 rupees will get disallowed. So coming back to my question now, working note number 1, 12,000 rupees is a total expense. 40A subsection 3 is also attracted. 40A subsection 2 is also attracted. 40A subsection 3 is attracted because more than 10,000 rupees we made the payment in non-specified mode. 40A subsection 2 is attracted because we paid excess expense and other party is relative. So both sections are attracted. Now which section will you apply first? You will always apply 40A subsection 2 first, then only you will apply 40A subsection 3. Okay guys, so I'll show you how my transaction will be. 12,000 rupees is the total expense. Okay, so I will first apply 40A subsection 2. Under 40A subsection 2, all my conditions are fulfilled. Assessee has incurred an expense relating to business or profession. The expense is excess by 3,000 rupees and the other party is relative. So because all the conditions are fulfilled, what is the excess? The excess of 3,000 rupees is going to be disallowed under 40A subsection 2, guys. Now you will come to section 40A subsection 3. In 40A subsection 3, I will not look at the whole 12,000 because see, out of 12,000, 3,000 we have already disallowed. So how much expense are we looking at now? We're looking at only the 9,000 rupees expense. Now 9,000 rupees only. It is within 10,000 rupees. Up to 10,000 pay however you want, we don't care. Only if you're making the payment more than 10,000 rupees, then only we will scream specified mode, like that we will scream. But here the amount is 9,000 only, which is less than 10,000 rupees. So therefore, even though we made the payment in non-specified mode, no problem. There will be no disallowance on this 9,000. There will be no tax implication on this 9,000. Getting the point? So this is your working note number 1, where we applied both 40A subsection 2 and 40A subsection 3. So why two sections were applicable over here? 40A subsection 3 was applicable because we made the payment in cash. 40A subsection 2 was applicable because it was excess expense. So when both the sections are applicable, we always first apply 40A subsection 2, then only we apply 40A subsection 3. Under 40A subsection 2, the excess portion we disallowed. So out of 12,000, 3,000 we disallowed. So now we are looking at 9,000 only. 9,000 is not more than 10,000. Only if more than 10,000 you make the payment in non-specified mode, then only we disallow. Here the amount is within 10,000. Pay however you want. I don't care. So how much is disallowance now? Only this 3,000 rupees is going to be disallowed under 40A subsection 2. So come to your main answer. Expense debited but not allowed under this 40A subsection 2. Give reference to working note number 1. The excess portion of 3,000 I am disallowing. Okay, I'll highlight this adjustment for you guys. It's a very, very important adjustment. Okay, then comes the next adjustment. Interest paid outside India, 1 lakh rupees without deducting tax. If you incur an expense and if you don't deduct tax, and if the other party is a resident and if you make payment in India, then 30% you disallow. See, I'll give you a reminder. This is nothing but section 40A1 and 40A1A. So in 40A1, what happens is, assessee has incurred an expense relating to business or profession. Condition number 1. Condition number 2, the other party is a non-resident or payment is made outside India. And condition number 3, TDS is applicable on this transaction. Okay. So if all these conditions are fulfilled, then the assessee has to deduct the tax in the previous year and assessee has to remit the tax within 139 date. 2 responsibilities you will put on the assessee. Out of these 2 responsibilities, if any responsibility assessee is not fulfilling, then in that case there will be disallowance. 100% of the expense is going to get disallowed, but this will be reversible disallowance, which means for now we will disallow. Later, whenever you whenever you deduct and remit the tax, in that year we will allow it again. Okay, so it's very simple to remember. 3, 2, 1. 3 conditions, 2 responsibilities, any 1 violation. So if 3, 2, 1, 3 conditions. Condition number 1, assessee has incurred an expense relating to business or profession. Condition number 2, the other party is non-resident or payment is outside India. And condition number 3, TDS is applicable. So if all these conditions are fulfilled, then in that case we will put two responsibilities on the assessee. Responsibility number 1, deduct the tax in the previous year, and responsibility number 2, remit the tax within 139(1) due date. If both the responsibilities, out of the two responsibilities, if even one responsibility is not fulfilled, which means if there is even one violation, then there will be disallowance. 100% of the expense will be disallowed. Okay. Now, very similar section, we have one more similar section, that is 40A 1A. In 40A 1A, what happens is, the other party is a resident and payment is made in India. Understanding? When I told you 40A1, here the other party was non-resident or payment was outside India. But in 40A1A, other party is resident and payment is made in India. So same thing, I'll put same two responsibilities on you. If you do any violation, this time only 30% of the expense will be disallowed. Okay, both 40A1, 40A1A, both are going to be reversible disallowances, which means for now we will disallow, but in the future whenever you deduct the tax, remit the tax, in that year we will allow it again for you. Now come to the question. We are paying interest expense, guys. We are paying outside India, so therefore 40A1 will apply over here. We are incurring an expense and we are making the payment outside India. Let's say TDS is applicable, all my conditions are fulfilled, therefore you will put two responsibilities on me. But the question says we made this payment without deducting tax. We did not deduct tax in the previous year, which means some violation is there. Because there is violation, 100% of the expense we will disallow. Getting it? Come on, come back to your PGBP now. Add expenses, debited but not allowed. Under 40A1, 100% of the expense I will disallow. 1 lakh into 100%, full 1 lakh I will disallow. Had it been 40A1A, had the payment been in India, this is outside India, that's why I applied 40A1. Had it been in India, I would have applied 40A1A. In 1A, only 30% will be disallowed. Okay. This is your third adjustment. Then comes your fourth adjustment, penalty paid to government for not filing GST return. You are paying penalty. You did not file GST return on time. You violated a law. When you violate a law, when you breach a law, for that if you pay penalty, this penalty is going to be disallowed. Disallowed means what? You should not debit it to P&L. But all this is already debited, already credited. So therefore, we will have to reverse the debit. How will you reverse the debit? By crediting it, you will add it back. So penalty relating to GST return. You did not file your GST return on time. So the penalty I am adding back, I am disallowing. The amount is 5,000 rupees. Then coming to our next adjustment, penalty paid to a customer for not fulfilling order within time, 10,000 rupees. Again, it's a penalty. But is it a penalty relating to breach of law? Did you violate a law over here? No, you just did not fulfill an order. You just did not fulfill a contract. There's just a breach of contract over here. Even this we have seen in our very first PGBP session. If you pay any penalty because you did not breach a contract, that penalty and all will be allowed. Only when you breach a law, only when you don't fulfill a law, that is where the penalty will be disallowed. But here the penalty is relating to breach of contract. This penalty and all will be allowed, no problem. Then comes a very interesting adjustment, bad debts, 1 lakh rupees. Money has been advanced to purchase building. I'll help you understand. It will be like such an amazing good morning moment for you. Let's see how much you remember first of all. Do you remember? When it comes to bad debts, you have to fulfill some conditions. Only then the bad debts will be allowed for you in PGBP computation. Do you remember one of the conditions is that this bad debts should be connected to something which was earlier taxed as income for you? Right? Now here the question says we are having 1 lakh bad debts. This is relating to money advanced for purchase of building. See, you will understand the journal entry language very well. You tell me, when you give advance money to purchase building, what journal entry you will pass? You will debit the person to whom you made the payment. Let's say Mr. A, you made payment to Mr. A, you will debit the receiver to cash or bank which is going out. This is a journal entry you will pass. 1 lakh rupees, 1 lakh rupees. You will not debit building because you haven't purchased the building yet. You just paid advanced for the building. So this is a journal entry you will pass. Now tell me, in this journal entry, is there anything in this journal entry which is impacting your income? Mr. A, this is going to be debtor. It will go into your balance sheet asset side. Advance money, it will go into asset side. Cash or bank, even this will reduce the cash balance in your asset side. So both debit and credit over here are not impacting your income. So is the bad debt of 1 lakh over here relating to something which was earlier taxed as income? No. So therefore, will the bad debt be allowed? No. Getting the point, guys? Bad debt will be allowed only if it relates to a transaction which was earlier taxed as income. Here it was not earlier taxed as income. Here the bad debt is relating to money which was advanced to purchase building. The bad debt over here is relating to an asset. It is not relating to an income. So therefore this bad debt will not be allowed. But it is already debited. How will you reverse a debit? By crediting it. Crediting it means what? You will add it back. So add back the bad debts. What is the amount? 1 lakh rupees. Okay, then comes your seventh adjustment. Revenue expenditure on promoting family planning amongst employees. Another amaze max adjustment this is. Listen to me. I'll remind you of the provision first. Here. So, we have section 36 subsection 1 clause 9. This clause says, if assessee is company and if assessee is incurring revex for promoting family planning amongst employees, or if assessee is incurring capex for promoting family planning amongst employees, this will be allowed. The revex will be fully allowed. The capex also will be allowed, but just that the capex will be allowed across 5 years. Okay, but all this is for which assessee? All this is only and only for company assessees. Okay, but who is your assessee over here? Mr. Raj, an individual. Assessee is not a company. So first of all, do you agree that 3619 will not apply over here? Okay, so assessee has incurred revenue expense to promote family planning amongst employees. First of all, 3619 will not come into the picture over here because assessee is a company, because 3619 will apply only if assessee is a company, but here assessee is individual. So therefore 3619 will not apply. But however, we also have section 37 subsection 1, which is your general expenses section. Section 37 subsection 1 says, if assessee has incurred an expense and if this expense is relating to business or profession, and if this expense is revenue expense, and if it is not a fine, not a penalty and all, then it will be allowed in PGBP computation. This is a revenue expense. It is for promoting family planning amongst employees. It is relating to employees. Anything you do for employees is relating to business or profession. So therefore this expense is relating to business or profession. Also it is revenue expense. Therefore it will be allowed not under 3619 but under 37 subsection 1 it will be allowed. And it's already debited in the P&L account. So therefore there is nothing left for you to do. It's an allowable expense. We have already debited. There's nothing left for us to do. Understood, everybody? It's a very interesting adjustment. Generally, family planning expense comes under 3619, but that is only for companies. But here assessee is not a company, assessee is an individual. So under 3619, we are not allowing, but under 37 subsection 1, which is a general expense section, under this section we are allowing. Okay. Then comes your next adjustment, premium paid on health of employees, 6,000 rupees in cash. I'll explain this to you. See, if assessee is making payment of premium, health insurance premium, and if this health insurance policy is in the name of the employee or in the employee's family members, first of all, do you agree for the assessee this is going to be an expense? Assessee is paying health insurance premium for his employee's health. It's an expense for the assessee, but it is for the employee. Anything you do for the employee will be connected to your business or profession. It will be allowed in your PGBP head. Under PGBP head, it will be allowed. But there is one condition. For health insurance premium, specifically there's a condition, and that is that the payment has to be made in non-cash mode. Here, I don't care about the amount, guys. Even if it is less than 10,000, I don't care. The payment has to be made in non-cash mode. Here, if you see, we're talking about premium on health of employees. So, which means we're talking about health insurance premium. But we have made the payment in cash. Whether it is less than 10,000, more than 10,000, I don't care. When it comes to health insurance premium, irrespective of the amount, the payment should be made in non-cash mode. But assessee made the payment in cash, therefore it will not be allowed. But it's already debited. It should not be debited. It should not be allowed. So how will you reverse a debit? By crediting it. Crediting it means what? You will add it back. So add expenses debited but not allowed over here. Health insurance premium paid by cash, 6,000 rupees I am adding back, irrespective of the amount. There's no 10,000 limit over here. Irrespective of the amount, payment must be in non-cash mode. Here payment is in cash, that's why we are disallowing. Okay, so till here what were your learnings? Tell me. First 8 adjustments we are done. The first big learning for us was this transaction where 48 subsection 3, 48 subsection 2 both were involved. So first we disallowed under 48 subsection 2. Then we saw balance money. We saw, oh, it's less than 10,000. It was 9,000 only. So 48 subsection 3 we did not disallow. Then bad debts was interesting. This bad debts was relating to building. It was not relating to an income. So therefore we did not allow the bad debts. Then revenue expense on promoting family planning amongst employees. If assessee is a company, I will apply 3619 and I will allow revex also, capex also. But here assessee is an individual. So under 3619 it will not be allowed. But applying 37 subsection 1 general business expense I will allow. Then premium paid on the health of employees, irrespective of the amount, payment must be in non-cash mode. Here payment was in cash, therefore we disallowed. Okay. Then comes your next adjustment. Premium paid on health of relatives. Health insurance premium paid for relatives. Now this is not a business expense. You're paying this money for assessee's relatives. So therefore this is definitely going to be disallowed. It's debited to P&L. You will reverse the debit by crediting it. Therefore, you will add it back. So, health insurance premium relating to relatives, the amount is 6,000 rupees. So, be careful. The first health insurance premium you disallowed because it was for employees. It was a business expense, but you made the payment in cash. That's why you disallowed the first health insurance premium. The second health insurance premium, that was for relatives. So, it was not even for your business or profession. That is why you disallowed. Okay. Then come to the 10th adjustment. Employer's contribution to RPF is 12,000 rupees. 1/2 of the amount is paid after the due date as per the relevant act, but before 31st July 2026. Here again, I have to discuss one small concept with you. They're unnecessarily trying to confuse you over here. See, we have section 43B, right? 43B covers various expenses. One of the expenses it covers is employer's contribution to RPF or approved gratuity fund or any other fund for the welfare of the employees. This employer's contribution is covered by 43B, which means 43B says this expense will be allowed for you only if the payment of this expense is made within 139(1) date. Only if the payment is made within 139(1) date, only then this expense will be allowed for you. And what are the possible 139(1) dates, guys? For our examination, whether June 26 examination or December 26 examination, for our examination, our 139(1) date will either be 31st July 26 or 31st October 26 or 30th November 26. Only 3 dates are possible. Now here the question says that employer's contribution is 12,000 rupees. Half of the amount is paid after the due date as per relevant act. Relevant act over here is PF Act. So we have paid after the PF due date but before 31st July 26. Employer's contribution to RPF. I don't care about PF due date and all. I just care whether payment is made within 139(1) date. And question says payment is made before 31st July 26, which means payment is made before the due date itself. Whatever be your 139(1) date, payment is made before the 139(1) date. Therefore, that's all. Under 43B, this will be allowed for you, right? They're trying to confuse you by saying that the payment was made after the due date as per relevant act. I don't care whether you make the payment within PF due date or after the PF due date. That is irrelevant for me. Under 43B, PF due date is irrelevant. Only the 139(1) date is relevant. Did you make the payment within 139(1) date? Yes. We made the payment before 31st July 26. So yes, we made the payment within 139(1) date. Therefore, there will be no disallowance. It will be allowed. And you have already debited to your P&L. So there is nothing left for me to do. Okay. Then comes your point K, employees' contribution to RPF. Earlier we spoke about employers' contribution to RPF. Now we are seeing employees' contribution to RPF is 10,000 rupees. Half of the amount is paid after the due date as per relevant act. They are not the same adjustments, guys. They are different. Earlier adjustment was employers' contribution to RPF. Now we are talking about employees' contribution to RPF. See, when it comes to employees' contribution to RPF, here section 43B will not apply. Here instead, section 36(1)(5)(a) will apply, which clearly says that the payment has to be made within the PF due date. Only if the payment is made within PF due date, only then it will be allowed. But here the question says the total was 10,000 rupees, half, which means 5,000 rupees is paid after the due date as per relevant act. So half, that is 5,000 rupees is paid after the PF due date. So therefore that 5,000 will not be allowed. I'll add it back. Okay. So coming back to my answer, add expenses debited but not allowed over here. Employees contribution to PF 10,000 into half, 5,000 rupees. Understanding? So I'll highlight this as a new adjustment for you. Employees contribution to RPF. So when it comes to employees contribution to RPF, you should make the payment within PF due date. Employers contribution to RPF 43B will apply. Their payment has to be made within 139(1) date. But employees contribution to PF 36(1)(5)(a) applies. As per that, payment has to be made within PF due date. You did not make the payment within PF due date, therefore it will not be allowed. Okay, so this was your point number K. Then comes your next point. Interest on late payment of professional tax 1,000 rupees yet to be paid. See, interest on late payment of professional tax, this interest is considered to be compensatory in nature. I'll make one small chart for you. Look at this. If assessee is making payment of interest relating to GST, or if assessee is making payment of interest relating to professional tax, these interests are considered to be compensatory in nature and these interests are allowed in your PGBP computation. But however, if you are paying interest because of late payment of income tax, this interest is considered like a penalty and hence this interest will be disallowed. Okay, so here if you see, we are paying interest relating to late payment of professional tax. Interest relating to late payment of GST or professional tax is compensatory in nature and it will be allowed, but it is already debited in P&L account, so therefore there is nothing left for me to do. Okay, then comes your next point, point M. Interest on loan from SBI 10,000 rupees, 5,000 is not paid till due date of filing return of income. So here again we will apply section 43B, guys. Why section 43B? Come on, by now you should know this adjustment now. Multiple times we have seen this. If assessee has to make payment of interest to bank or NBFC or public financial institution or SFC or SIIC, then payment has to be made within 139(1) due date. The question says 5,000 is not paid within the due date of filing return of income. So 5,000 we did not pay within 139(1) date, that 5,000 we will disallow. So add expenses debited but not allowed. Section 43B, interest to SBI, 5,000 is how much we did not pay within 139(1) date, we will disallow. Okay, then the question says interest on late refund from income tax department. I'll help you understand this. See, income tax expense I'm having, which means I have to pay income tax, and I paid this late. So because I paid this late, I will have to pay interest on late payment of income tax. This expense, interest expense I will be having. So there are two expenses, income tax expense and interest expense. Income tax expense will be disallowed because it's a personal expense. Even this interest on late payment of income tax will be disallowed because it will be considered as a penalty, it will be disallowed. Okay. Now let us say I paid more income tax. So now I'm supposed to get income tax refund. But the income tax department, they gave me the refund late. So because they gave me the refund late, I will ask them to pay me interest. So this income tax refund is an income for me. And relating to the income tax refund, I am getting interest. Even this will be income for me. Now, income tax refund, this is not going to be considered as, this is not going to be taxable. Under any head, it will not be taxable. Income tax refund is not a taxable income. But however, you are getting interest income, right? You got the income tax refund late. So you asked for interest from the income tax department. You received the interest. It's an income for you. This income of this interest income on income tax refund, this will be taxable for us under IFOS head. Okay, so income tax refund is not taxable, but interest on income tax refund is taxable under IFOS head. In this question, we got interest on late refund from income tax department. So we got the income tax refund late. So therefore we asked the income tax department to give us interest income. This should go into IFOS head. This should not be a part of my PGBP head. But all of these transactions are already debited or credited. So therefore this interest income also over here is already credited to our P&L. So how will you remove a credit? You will debit it, that is, you will subtract it. It's an income credited, but it is not taxable under PGBP head. So interest on income tax refund, I am removing it from my PGBP head because it should go into the IFOS head. What is the amount? The amount is 500 rupees. Okay. Then the question says, sales includes sale to Raj 10,000. Who is Raj? Assessee himself. So assessee is selling goods to himself. Cost of such goods is 8,000 rupees. Market value of the goods is 12,000 rupees. I don't care about the market value. He is selling goods to himself. So I will remove this amount from the sale also. I will remove it from the purchase also. So how will you remove something from the sale? Sale is credited to your trading and P&L. So how will you remove a credit? By debiting it. That is by subtracting it. So less income, credited but not taxable. Sale to self. I'll remove this 10,000 rupees. Then I have to remove from purchases also. Purchases debited to the P&L. How will you remove something from purchases? How will you remove a debit? By crediting it. Crediting means you will add it back. So I'll add back purchase to self. The amount is 8,000. Got it? So this was basically a transaction where assessee sold goods to himself. So I removed this transaction from the sale also. I removed this transaction from purchase also. Okay. Then he received 80,000 from a debtor at a time in cash. See, they're trying to confuse you over here. More than 10,000 rupees in cash. No, guys. I will apply all that. I will apply 48 subsection 3 only if assessee is incurring an expense. No. Here assessee is receiving money. He is receiving 80,000 from a debtor in cash. Only if assessee is incurring expense. And if assessee is making payment of the expense more than 10,000 rupees, then only you can say disallow. Here assessee is not making payment. There is no expense over here. Assessee is receiving money over here. Therefore, nothing to do, no tax implication. So this was one new point. This is one new point. Okay. And then after this, recovery of bad debt 10,000 rupees, out of which 8,000 was allowed as a deduction during 21-22. So how much bad debt we recovered? 10,000 rupees. See, this is going to be interesting. Listen carefully. How much was the bad debt that was allowed earlier? Bad debt allowed was 8,000 rupees, guys. This is how much was allowed. How much did we recover now? We recovered 10,000 rupees. So the amount of bad debts recovered cannot exceed bad debts, no. Logically you think, if 8,000 is written off as bad, then maximum how much bad debts recovered I can have? Maximum 8,000 bad debts recovered only I can have. So what's the excess above 8,000? 2,000. That 2,000 is not my income. It should not be credited. How will I reverse a credit? By debiting it. So I'll subtract it. So bad debt recovered. The excess 2,000 I'll subtract. Understanding? If the debt that has been written off as bad is 8,000, I can recover 8,000 only, maximum. I have recovered 10,000 over here. So extra above 8,000 is 2,000. It can't be my income. The extra can't be my income. So I'm removing the credit. How will I remove a credit? By debiting it. I'm subtracting it. Then depreciation not debited in accounts is 20,000. Allowed as a deduction under section 32. So this depreciation is not debited in the accounts. So I have to now debit it. Now debit it means I have to now subtract it. So expense not debited but allowed. Under this we have depreciation 20,000 rupees. That's it, guys. Please add and give me the net PGBP of your SSE. So the total PGBP is 3,60,500 net PGBP of the assessee. Alright, now did you understand why this is an LDR question? It took us around 40 minutes to do this one question because this one question has some amazing adjustments. Alright, you should be seeing this before your examination. Look at the new points that we've seen over here. First new point was combination of 48.3 and 48.2. Then we had bad debt relating to building. Then we had revenue expense relating to promoting family planning. Not allowed under 3619 but allowed under 37 subsection 1. Then health insurance premium relating to employees irrespective of the amount, money should be paid in non-cash mode. Then employees' contribution to RPF should be remitted within PF due date. Then interest on late payment of professional tax is compensatory interest and it will be allowed in PGBP computation. Then interest on late refund from income tax department, this should be taxed under IFOS head. Then receiving money from debtor, I don't care in what mode you receive. Then bad debts recovered. Got it, guys? So please mark this. You have to do this question before your examination. In the day before your examination, this question has to be seen because it covers a lot of adjustments. One question covers a lot of adjustments. Got it? So we'll close question number 31 over here, and now we'll take up question number 32. Question number 32, the same question we have in our CA study material also, and the same question is also here, your model question paper question. It's an amazing question, guys. It will give you some amazing clarity on depreciation and additional depreciation. Okay, both the regimes will be involved in this question, new regime also, old regime also. It will be like one eye-opener question for you. So let's begin, guys. Let's read the question and then we will work it out. So the question says, Mr. Venus engaged in manufacture of pesticides. As soon as I see the word manufacture in the question, immediately additional depreciation comes to my mind. So he's engaged in manufacturing of pesticides. He furnishes the following particulars relating to its manufacturing unit at Chennai for the year ending 31st March 26. WDV of the plant and machinery on 31st March 25. So 31st March 25 WDV they have given to us. This will be nothing but closing WDV on 31st March 25. See, always remember, I hope you recall, even earlier, whenever I've done depreciation related questions for you, if you recall, closing WDV is always on 31st March. On the 1st of April, it's always the opening WDV. Right, guys? From closing WDV on 31st March, you subtract depreciation and that's how you get opening WDV. No. See, I'll remind you. I'll show you. Look at this. So whatever is my closing WDV on 31st March, from that I subtract depreciation and that's how I get opening WDV on the 1st of April. So on that basis only I am saying that because they have given WDV on 31st March, it has to be closing WDV. Okay. So then they've given us depreciation including additional depreciation for 24-25 is 4.75 lakhs. Then new machinery purchased on 1st September 25 is 10 lakhs. New machinery purchased on 1st December 25 is 8 lakhs. And computer purchased on 3rd Jan is 4 lakhs. So these are 3 new assets which we have purchased in our current year 25-26. Okay. Then more information they have given to us. All assets were purchased by account payee check. Good. If more than 10,000, if you're making payment for a depreciable asset, you must make the payment in specified mode only. Good thing they've made the payment in account pay check. Then all the assets were put to use immediately. Okay. Then the new machinery which was purchased on 1st December 25 and the computer have been installed in the office. So this new machinery which was purchased on 1st December and the computer, both of these have been installed in the office. Do you recall, we had seen in one of the questions in the past as well that if your asset is being used in the office or in the guest house, then for that asset there will be no additional depreciation. Do you remember? Air conditioner. Yes, we saw the question where assessee had an air conditioner which was installed in the office. So there I had told you the same AC had it been installed in the factory, I would have enjoyed additional depreciation. But if the asset is installed in office or in guest house, then there will be no additional depreciation. Okay. Then the question says during the year ended 31st March 25. Year ended 31st March 25 means previous year 24-25, guys. So in previous year 24-25, a new machinery had been purchased on 31st October 2024 for 10 lakh rupees. Additional depreciation besides normal depreciation had been claimed thereon. So last year in 24-25, we had purchased one machinery on 31st October 24. So on that machinery, additional depreciation also, normal depreciation also, both we have claimed. Then if we have already claimed it last year, why are they giving me this information? There has to be some reason. There is a reason. See, this machinery was purchased on 31st October 24. Even if it is put to use on the same day, in 24-25, it was put to use for less than 180 days, guys. So in 24-25, you would have enjoyed only half additional depreciation. So the balance 10% additional depreciation you should be getting on this asset in the current year. No, see, if I put the asset to use for less than 180 days, you will give me only half additional depreciation. Only 10% additional depreciation you will give, and you will say, don't worry, SSE, balance 10% you can enjoy next year. This is the reason why they've given us this adjustment. So last year in 24-25 we purchased one plant and machinery. In 24-25 we put that plant and machinery to use for less than 180 days. So in 24-25 we got only 10% additional depreciation. Now that balance 10% additional depreciation on that same plant and machinery you have to give in the next year. What is the next year? 25-26, which is your current year. So in current year, in 25-26, we have to enjoy the balance 10% additional depreciation for that last year's asset. Okay. Then what else are they saying? Depreciation rate for machinery is 15%. Then assessee has no brought forward business loss, no unabsorbed depreciation, no brought forward business loss. Compute depreciation available to the assessee as per provisions of Income Tax Act and WDV of different blocks if he exercises the option of shifting out of the default regime. Shifting out of the default regime means you will be following the old regime. Default regime is nothing but the new regime. If you're not following the new regime, it means you're following the old regime. So as per old regime, we have to compute. Then what if he pays tax under the default regime? That is as per the new regime. So as per both the regimes, we have to compute depreciation. Are you ready, guys? Come on, let's begin. So first of all, they've given us WDV of plant and machinery on 31st March 25, which is nothing but the closing WDV on 31st March. We've already decided that. So closing WDV for 31st March 2025, the amount is 30 lakh rupees. Now, from this, I will subtract depreciation for 24-25. Just now only I told you, closing WDV minus depreciation will give you opening WDV. My current year is 25-26. I need opening WDV on for 25-26. That is, I want opening WDV on 1st April 2025. That will be nothing but closing WDV on 31st March 25 minus depreciation for 24-25. This will give me opening WDV on 1st April 2025. Okay, what's the depreciation for 24-25? See, they've given to us depreciation for 24-25 is 4,75,000. So the balance 25,25,000. This will become your opening WDV on 1st April 2025. Okay. Now see whether my assessee follows default regime, whether he follows normal regime. This calculation will stay the same only, right? Because this is last year's information. Only in the current year, answer will change depending upon old regime and new regime. But this is anyways last year's information. This is going to stay common. Okay. Now come on. By the way, which block was this? We're doing all this for which block? For block 1. Let's call it plant and machinery. 15% block. So right now we are focusing on the plant and machinery 15% block. Okay. Now let's begin. Let's do the entire computation as per the old regime first, and then we will recompute as per the new regime. Okay. So I'm again continuing with this block. That is block 1. Plant and machinery 15%. So we're doing the calculation for the current year. My current year is 25-26, right? So we will start with opening WDV on 1st April 2025. Just now we computed 25,25,000. To this we will add actual cost of assets acquired. That is, we will add the new assets over here. How many new assets have we purchased? 3 new assets we purchased in 25-26. New machinery purchased on 1st September. Machinery will enter into this block. So number 1, we have purchased some machinery. We purchased it for how much? 10 lakh rupees. Now try to recall, I've taught you, whenever a new asset enters into the block, I always make you check 2 things. Number 1, was it put to use for at least 180 days, guys? It was purchased on 1st September 25. Put to use on the same day. Definitely put to use for at least 180 days. Then tell me, will I get additional depreciation on this asset? Yes or no? See, we are doing as per the old regime. It is machinery. Assessee is a manufacturer. It is not second-hand plant and machinery and all. So I will be eligible for additional depreciation over here. Full 20% additional depreciation I will get for this asset. Okay. So this is done. Then we have new machinery purchased on 1st December 25. So we have one more machinery. But this was purchased on 1st December 25, guys. So definitely this one was put to use for less than 180 days. And this machinery was put to use in office. We've already done the decision. Because it was put to use in office, on this asset there will be no additional depreciation. depreciation. So what is the cost of this asset? 8 lakh rupees. Okay. Then after this, we also purchased a computer. Will computer enter into 15% block? See, computer will also come under plant and machinery, but 40% plant and machinery, right? It will not come under the 15% block. So in the 15% block, we have only 2 assets. So then we will subtract monies receivable for assets sold. We read the whole question. Did we have any sale of asset in this question? No. So therefore now what's a closing WDV on 31st March 2026? Give me the net number. The closing WDV on 31st March 2026 is 43,25,000. Now you know very well the WDV number you always split into how many parts? Into 3 parts, guys. We see out of the WDV how much has been put to use for 0 days. Then we see out of the WDV how much has been put to use for less than 180 days. And then we see the balance WDV. Right, guys? So this WDV which we have now 43,25,000, we will split this into these 3 numbers. I've always told you these 2 numbers you always find from the new asset. Now tell me, in these new assets, do you have anything which was put to use for 0 days? No, we have nothing which was put to use for 0 days. Then tell me, in these new assets, do you have anything which was put to use for less than 180 days? Yes, less than 180 days we have 8 lakh rupees. Okay, now on this 8 lakh rupees, come on, calculate normal depreciation. Less than 180 days, guys. So 8 lakh rupees into 15% into less than 180 days. So therefore you will get only half year's depreciation. So 8 lakh into 15% divided by 2, I am getting 60,000 rupees. Okay, then will you get additional depreciation on this 8 lakh rupees? On this 8 lakh rupees, no additional depreciation. We have already done the thinking. So no additional depreciation. Okay, so with this asset is done fully. Then what's your balance WDV? Simple, right? 43,25,000 will be split into 3 parts. So 0, 8 lakhs. So what's the balance over here now? 43,25,000 minus 8 lakhs. Your balance WDV will be 35,25,000. Okay, now calculate. What's your normal depreciation? Normal depreciation will be 35,25,000 into 15%. Full year's depreciation. This is 5,28,750. Then what about additional depreciation? See, we do have 20% additional depreciation on 10 lakhs. We have already done the thinking. 20% additional depreciation on 10 lakhs. So 10 lakhs into 20%, which is going to be 2 lakh rupees. Now at this stage, please know one very common mistake which multiple students make, which you will ensure that you don't make. You should not end up taking additional depreciation on this number itself. Always come back to your table and see where have you written additional depreciation. So on that amount only you will calculate additional depreciation. Okay, so 2 lakhs is your additional depreciation. All this is done. Then in addition to all this, do you recall we had seen that last year in 24-25 we had purchased one asset. We had put it to use for less than 180 days. So for that asset, balance 10% additional depreciation we have to give now. Let's do that now. So write down balance 10% additional depreciation for plant and machinery acquired in previous year 24-25. Show the calculation. We purchased that asset for 10 lakh rupees. 10 lakh into 10%. 10% we would have enjoyed in 24-25. Balance 10% I am making you enjoy now. So 10 lakh into 10% will be 1 lakh rupees. Okay. Now come on, add up and tell me what's the total depreciation. There are 4 numbers. Add up and tell me. Total depreciation is 8,88,750 for this 15% plant and machinery block. So what is your opening WDV on 1st April 2026? 34,36,250. So for this block, what's your total depreciation? Keep that in your mind. 8,88,750. This is the first block, guys. The plant and machinery 15% block. Now we have one more block, no? The 40% computer block. Let's do that one now. So block 2, Even computer will come under plant and machinery, but it will be 40% plant and machinery. Okay, so we purchase a computer for how much? Just a moment. Yeah, so we purchase a computer for how much? For 4 lakh rupees. In the current year only we purchase a computer. So what will be your normal depreciation for this computer? 4 lakh into 40% into, we purchased it on 3rd Jan 2026. So even if you put it to use on the same day, it will definitely be put to use for less than 180 days. So therefore you will get only half year's depreciation. So your total normal depreciation for the computer will be 80,000. Then will you have additional depreciation for this computer? It is plant and machinery, but it is being used in office. Therefore, no additional depreciation. So for this 40% plant and machinery bucket, what's your total depreciation? 80,000 rupees. So in block 1, plant and machinery 15%, my total depreciation is 8,88,750. Plant and machinery 40%, my total depreciation is 80,000 rupees. So what is the total depreciation now? If your assessee follows the normal regime, the total depreciation is going to be 8,88,750 plus 80,000, which will totally work out to rupees 9,68,750. This is your conclusion under the old regime. Now we have to recompute the whole thing all over again, imagining what if the assessee is following the default regime. See, look at this. I've copied and pasted the whole thing as it is. Let's see where and all things will change. Your opening WDV will stay the same, guys. 25 lakh 25. Remember how we found 25 lakh 25? 30 lakh was a closing WDV they gave for the last year. That minus 4 lakh 75,000 last year's depreciation. That's how we got the opening WDV. That will stay the same only. See, basically, if assessee is following the new regime, only one thing will change. No, in your block computation, in your depreciation computation and all, because of change of regime, only one thing will change. That is additional depreciation. Everything else will stay the same only. So only additional depreciation you have to attack. Okay. Then we will add actual cost of assets acquired to assets we acquired. No question of additional depreciation only over here, because new regime. So no additional depreciation. I won't even check anything. No additional depreciation. Story over. Okay. So this is your closing WDV. Again, you will split your closing WDV into 3 parts. 0 days, less than 180 days, balance. All this will stay the same. Additional depreciation you will not have. So even here, this additional depreciation of 2 lakhs I'll have to remove. In the new regime, in default regime, in 115 BSE, no additional depreciation. Okay. Then this balance 10% additional depreciation for the last year, even that you will not get in the new regime, guys. Basically, in the new regime, you will have only normal depreciation. That's the only change. No additional depreciation. So what will be the total depreciation in this 15% block in the new regime? Total depreciation will be 5,88,750. So your opening WDV for the next year will be 37,36,250. Okay, this is as per your, this is for the 15% plant and machinery block. Then what about the 40% plant and machinery block? There we anyways did not have additional depreciation. So this will stay the same only, 80,000 rupees. You're getting the point. No scope of confusion only. If the assessee is changing the regime, only one thing will change. No additional depreciation, that's all. Everything else will stay the same only. So in this new regime, now give me the summary. What's the total depreciation? Total depreciation will be 5,88,750, which is for the 15% block, plus 80,000. So the total depreciation will be 6,68,750. Got it, guys? So this was your question number 32, purely a depreciation based question. So this question majorly gives you an eye opener that if assessee is following the new regime, no additional depreciation. Everything else stays the same when it comes to depreciation computation. Okay. So now come on, let's move on to our next question. Question number 33. Again, a full-fledged PGBP question. Okay. Let's see what the question says. Calculate the gross total income. So they're not asking us just PGBP, they're asking us to find GTI. GTI of Mr. Inder Kumar Basu on the basis of the following particulars. Extract of P&L account. So they have given us the net profit number, guys. So therefore, when I compute PGBP, I will use my indirect method. The 5 steps I will use. Okay. So they've given us our P&L account. Then they've given us all these adjustments. What are they asking us to find? They're asking us to find the GTI of the assessee. So let's get to work. So GTI computation. Now, they've given us a P&L account. We have the net profit number. So, of course, we will have PGBP. Let's give reference to working note number 1. Now, how will we compute PGBP? We have the net profit number. So, the 5-step approach we will follow. What is a 5-step approach? We will start with net profit as per P&L account. We will add expenses debited but not allowed. We will add incomes not credited but taxable. We will subtract expenses not debited but allowed. And we will subtract incomes which are credited but not taxable. Okay. So, this is going to be my working note number 1 for PGBP. Let's read the P&L account now. Look at the credit side. Gross profit, nothing to do. Then what about interest on debentures of an institution? Interest on debentures should go into your IFOS head. So what will you do in your PGBP? See, it is credited into PGBP. It should go into IFOS head. So how will you remove a credit? How will you remove this from PGBP? You will remove a credit by debiting it. Debiting means what? You will subtract it. So you will remove it from PGBP. You will subtract it. It's an income which is credited to your P&L account, but it is not taxable under PGBP. So interest on debentures, the amount is 10,000 rupees. I'll remove it from PGBP and I'll take it to IFOS head. So come to your main answer. Write down IFOS. Give reference to working note number 2. After working note number 1, open working note number 2 with the heading IFOS. So here we will tax interest on debentures. The amount is 10,000 rupees. Okay. This is done. Now come to the third adjustment. Rent from house property. This will go into IFHP head. So what should I do in my PGBP head? I'm supposed to remove this from my P&L. How will you remove a credit? By debiting it. Debiting means what? You will subtract it. So less income credited. It is credited but it is not taxable. Rent from house property, 36,000. I'll remove this from my PGBP. I'll come to my main answer. IFHP. Give reference to working note 3. After working note 2, leave some 4 to 5 lines gap and then open working note number 3, IFHP. So in IFHP, see, we have right now only the rental income. I need municipal value, fair and standard rent. So much information I need. I don't have all that right now. So I'll just make a note of the rent amount, 36,000. The computation and all we'll do later. Okay, with this credit side is done. Now come to the debit side. Interest, repair, insurance, depreciation. All these are your business expenses. Compensation, law charges, labor welfare charges, subscriptions. All these are your business expenses. Then net profit number, put this into your PGBP computation. Net profit as per P&L account is 1,30,000. Okay, now come to the adjustments, guys. First adjustment, interest. Do you remember we had interest over here? Interest of 1,800. So that interest includes 200 rupees on loan taken for purchasing debentures of a company. So tell me, where will this interest go? See, from these debentures, what income you earned? Interest income. That interest income you put under which head? IFOS head. So relating to that same income, whatever expense you are having, interest expense, even this should go into IFOS head only. No, this expense is not relating to your business. This expense is relating to purchasing debentures. It is not relating to your business. So first remove it from your PGBP. How will you remove a debit? By crediting it. So you will add this back in your PGBP. It is debited but it is not allowed. Under this write down interest, debentures, amount is 200 rupees. I'll remove this from my PGBP. I'll take it to my IFOS head. Against this, I'll subtract, against my debenture interest income, I will subtract the interest expense of 200 rupees. So the net interest income which is taxable under IFOS head will be 9,800 rupees. Then the question says same interest, it includes 300 rupees loan taken to reconstruct the house property let out. So this 300 rupees is relating to IFHP head. Again, this 300 rupees interest is not relating to business or profession. So I have to remove it from PGBP. How will you remove a debit? By crediting it, by adding it back. So I'll disallow the interest relating to house property, 300 rupees, and I'll take this to my IFHP head. So here we have interest of 300 rupees. Okay, First adjustment done. Then comes the second adjustment. Expenses relating to house property let out are 40% of the repair and renewal expense. So we are having this repair and renewal expense, right? Out of this, 40% is relating to house property. So first of all, 40% will not be relating to business. So I have to reverse that 40%. I have to reverse the debit. How will you reverse the debit? By crediting it, by adding it back. So it is expense debited, but it is not allowed. Repairs and renewals. Why is it not allowed? Because it is not relating to the business of the assessee. It is relating to house property. Is it the entire expense? No. The question says only 40% of this expense is relating to house property. So 2200 into 40%, 880. I am removing it from PGBP. See, I will not take it to IFHP head because in IFHP I enjoy standard deduction. That standard deduction itself takes care of all these expenses. But I removed it from my PGBP. Okay. Then come to the third adjustment. Depreciation includes 1200 on house property let out. You can claim depreciation only for those assets which you are using for your business or profession. So out of the depreciation, 1200 is relating to your house. So it is not relating to your business asset. So this has to be removed from your PGBP. So how will you reverse a debit? By crediting it, by adding it back. So depreciation relating to house property, 1200, I'll reverse it, I'll add it back. Then comes your fourth adjustment. Compensation was paid to an employee whose dismissal was in business interest. Remember we had compensation over here 10,200. About this you are giving us information that this compensation was paid to an employee whose dismissal was in business interest. So it is relating to the business of the assessee only. So nothing to do. It's already debited to P&L. It is allowed. It's already debited. So there's nothing left for me to do. Then what else is the question saying? Insurance. We had insurance expense. No. See, insurance 4,200. What are they saying about that? This insurance includes 30% for fire insurance of the house property, 30% for workers' accident insurance, and balance for life insurance. Let's make one working note, guys. This is an interesting adjustment. So I'll open working note number 4 for insurance. Total, how much insurance have we paid? See the question. Total insurance is 4,200. This 4,200 they are saying it has 3 components, guys. So first of all they are saying that 30% is fire insurance of the house property. 30%, which is 1,260. This is relating to fire insurance of house property. So this is not relating to business or profession. So therefore this 1,260 has to be disallowed because it is not relating to business or profession. Then the question says 30% is for workers' accident insurance. 30% will again be 1,260. This is for workers' accident insurance, which means it is relating to employees. Anything we do for the employees will be connected to business or profession. So this is going to be definitely allowed. Yes, and the balance they are saying is for life insurance. So 30 plus 30, 60. Balance will be 40%. So the 40% number will be 1,680. This is for life insurance. Now life insurance premium and all will go to 80C. That is chapter 6A. But I will think about chapter 6A only if they are asking me to compute total income. But here they are asking me to compute gross total income only. So therefore, chapter 6A and all, I won't waste my time on all that. But what about PGBP? Is life insurance premium relating to your business or profession? No, right. It is not relating to your business or profession. It's your personal expense. So even this has to be disallowed. So now finally, how much has to be disallowed? Disallowed. 1,680 plus 1,260, total 2,940 you will disallow. Got the point? Come to your main answer, come to your PGBP answer. Expense is debited but not allowed. Over here, insurance. Give reference to working note number 4, 2,940 you're disallowing. You understood? This 1,260 is relating to business. That will be allowed. The balance 30% and 40%, both of these I'm disallowing. Okay, this was your adjustment number 5. Now comes adjustment number 6. Law charges includes 2,000 relating to a petition filed against breach of contract and the balance regarding sales tax appeal. So we have law charges. It is relating to breach of contract and sales tax appeal. Both are business connected only, guys. So it's already debited in the P&L, business expense, nothing left for me to do. Then subscription. We had subscription in our P&L. Subscription 5,800. This includes 2,000 given for election purpose to political party. You're making a donation to political party. Is that a business expense? It's not a business expense, right? So it has to be removed from your PGBP. So how will you remove a debit? By crediting it. That is, you will add it back. So 2,000 is donation to political parties. I will add it back. Expense debited but not allowed. Over here, political contributions. What is the amount? 2,000 rupees. I'm adding this back. Okay. Now be careful. Donation to political parties comes in chapter 6A also. You have ATGGB, ATGGC. But again, same thing. I will think about chapter 6A and all only if they're asking me to compute total income. Here they ask me only for GTI. So I will not bother about chapter 6A and all over here. These are my first 7 adjustments. Then we have the last 3 adjustments. Amounts not debited to P&L account. So which means we have to now debit them. They are not debited to P&L account. Number 1, expense incurred on the occasion of festival, 800 rupees. This is like Diwali expenses. Diwali expenses, puja expenses, they are all incurred for the promotion of business and these expenses are allowed. They are not debited to P&L. So we will now debit. Okay. Similarly, theft of cash from locker. Theft of cash, sometime back only we saw. Embezzlement of cash, misappropriation of cash, all this will be considered as business loss and even this will be allowed. It is not debited to P&L, so we will now debit, we will now allow it. Okay. Then expenses for new telephone connection in business. Telephone connection expense, even this will be allowed. It is not debited, so we will now debit. So 3 expenses we have to now debit. Debit means what? We have to now subtract. So less expenses not debited. They are not debited but they are allowed. So 3 expenses we have over here. One is festival expense. Then another point is theft of cash. And the last one is telephone installation. What are the amounts? 800, 1,200, 2,000. 800, 1,200 and 2,000. That's it, guys. Come on now. Close your working note. First give me the PGBP amount. $87,520 is your PGBP. Please check. Yes, so take it to your main answer. PGBP 87,520. Then IFOS is 9,800. Then we are left with only IFHP. IFHP, no other information they have given because they have given us rental income. Of course, it is a let out property. Let out property, you will start by checking how many months assessee owns a property for. Assessee owns a property for all 12 months. So let's start the computation now. GAV, municipal value, fair and standard rent, no information they have given to me. So I'll use a shortcut. GAV will be actual rent minus unrealized rent minus vacancy loss. That's going to be nothing but 36,000. Then we don't have any municipal tax paid in the question. So this 36,000 itself becomes your net annual value. From this you subtract deductions under section 24. We'll have 2 deductions. Number 1, we'll have standard deduction at 30% of NAV. That will work out to 10,800. Then interest on borrowed capital. We have interest for the house property, 300 rupees. So that's it. What's your IFHP number now? 24,900 will become your IFHP. Take this also to your main answer. So if you add up, what's the GTI of your assessee? 1,22,220. This will become the GTI. You will not think about rounding off and all because you round off only total income. This is only the GTI number. Understood. This was question number 33. I think after doing the last two questions, this question felt a little easier and also a little smaller. So with this, I think we're good to close this session over here. I'll see you again in our next session and we'll continue with the next set of questions. I think we will need a minimum 2 to 3 sessions more for PGBP. A nice quality of questions we're doing, nice adjustments we are seeing. I want to do a few more sessions because we have to ensure we pocket the 7 marks for sure. Okay, I'll see you in the next session. Bye bye. Hello champions, so we're continuing with our PGBP chapter. We are straight away starting off with question number 34. This is like a full-fledged question on depreciation. Inside this one question, we have several situations. In each situation, independently, we have to calculate depreciation. Okay, let's begin. So Messrs. Anita Enterprise has WDV in furniture block, a 10% depreciation rate on 1st April 25, 80,000 rupees. So 80,000 is WDV on 1st April 25. This becomes our opening WDV, guys. Then the block consists of two furniture, X and Y. So we are having two furniture, X and Y. Compute depreciation in the following cases. We're targeting just the first case. In the first case, furniture X is sold for 20,000 rupees. So we just sold furniture X. Now, whenever we sell away depreciable asset, I hope you recall the flow chart. We will first check whether the block is empty or whether the block is not empty. Here, block is not empty. I still have furniture Y. So because my block is not empty, I will first try for depreciation. Only if depreciation is not possible, only then we will come to capital gains. Okay, so let's begin. We are targeting case A first. So what's your opening WDV? 80,000 rupees. Then in this case, did you purchase any new asset? Any new asset purchased? No. Money is receivable for asset sold. We sold X for 20,000 rupees. So what's your closing WDV at the end of the year? 60,000 rupees. We will split the WDV between 0 days, less than 180 days and balance. I've told you every time that 0 days and less than 180 days, both the numbers you take from the new assets. We don't have any new assets over here. So 0 days WDV is 0. Less than 180 days WDV 0. So the entire WDV will come under balance WDV. So on this, how will you calculate depreciation now? 60,000 into 10%. Why 10%? Furniture, guys. Furniture will be 10% depreciation. And also see, no concept of additional depreciation, because additional depreciation comes into the picture only for plant and machinery. This is furniture. So no question of additional depreciation and all. So your depreciation is going to be 6,000 rupees. So depreciation is possible, therefore no question of capital gains and all. So what's your total depreciation now? 6,000 rupees. So the opening WDV for the next year will be 54,000 rupees. Alright, they're asking us to compute depreciation. So in our first scenario over here, our depreciation is 6,000 rupees. Okay, this is case A. Now come on, let's move to case B. So in case B, again we are having two furnitures. We are having X and Y. This time what happened? In case B, furniture X is sold. Again we sold one furniture. We sold furniture X for 1 lakh rupees. So again same thing, sale of depreciable asset. I will check whether the block is empty or not empty. Block is not empty. I still have Y. So therefore, because block is not empty, I will first try for depreciation. Only if depreciation is not possible, then only I will have capital gains. Okay. So first, let's try depreciation. Let's do the normal block computation. What's your opening WDV? Your opening WDV is the same number, 80,000 rupees. Then add actual cost of assets acquired. We read the whole question. We did not acquire any asset during the year. Then money is receivable for assets sold. We sold furniture X for 1 lakh rupees. So what's your closing WDV now? You'll get a negative 20,000 rupees. Now tell me, can you have a negative number in WDV? No. So we'll restrict it to 0. So we'll restrict the money is receivable for assets sold. It's actually 1 lakh rupees, but we'll restrict it to 80,000. Now tell me guys, block is not empty. We first tried for depreciation. Is depreciation possible? Depreciation is not possible. So because depreciation is not possible, now we will come to capital gains computation. Okay. So to compute capital gains, first of all, what's a full value consideration? We are selling furniture X for how much? We are selling it for 1 lakh rupees. And what will the cost of acquisition be? Remember, we had seen even in the past, when it comes to depreciable assets, the cost of acquisition will always be opening WDV plus additions. What was our opening WDV? 80,000 rupees. We did not have any additions. So your cost of acquisition will be 80,000 rupees. So the net number 20,000. This will become your SDCG. Got it? So block was not empty. We first tried for depreciation. Depreciation was not possible. Therefore we came to capital gains. So in case A, my final answer is depreciation. Depreciation is 6,000 rupees. In case B, depreciation is 0. I am just having STCG of 20,000 rupees. Okay, so like this, we're going to be seeing one case after the other. We're done with the first two cases. Now let's move on to the third situation. So in the third situation, again we have two assets. First, X and Y. So furniture X is sold for 1 lakh rupees. So furniture X is sold. We still have furniture Y, but it's sold for 1 lakh rupees, and furniture S is purchased for 35,000 rupees. So we had furniture X that is sold. We're having furniture Y, and then furniture S is newly purchased, okay, for 35,000 rupees on 1st July 2025. So again, same thing. I am having a sale of depreciable asset, but my block is not empty. So because of that, I will first try depreciation. Only if depreciation is not possible, only then I will come to STCG. Okay, so this is case C. So let's begin. What's your opening WDV number? That stays the same, 80,000 rupees. Then actual cost of assets acquired. We have acquired furniture S. So we acquired it for how much? Furniture S is purchased for 35,000 rupees. Now, whenever we purchase a new asset, we always check two things. Number one, was it put to use for at least 180 days? It was purchased on 1st July 25, guys. So definitely it was put to use for at least 180 days. And will I get additional depreciation? This is furniture. For furniture, there will be no additional depreciation. Then money is receivable for assets sold. We have sold furniture X. We sold furniture X for how much? For 1 lakh rupees. So I'll subtract that. So what's your closing WDV now? 80,000 plus 35,000 minus 1 lakh. Your closing WDV will be 15,000. This closing WDV you have to split between three things: 0 days, less than 180 days, and balance. You know very well, 0 days and less than 180 days, both these numbers you take from the new assets. Now in the new assets, do you have anything which is put to use for 0 days? Do you have anything which is put to use for less than 180 days? No, guys. So my balance, my WDV 0 days is 0. WDV less than 180 days is 0. So my entire WDV will come under balance WDV. Now on this, I'll calculate my normal depreciation, which will be 15,000 into 10%, which is 1,500 rupees. So this itself will become the total depreciation in this case. So what's your opening WDV for the next year now? 13,500 will become the opening WDV for the next year. So in the third case, my depreciation is 1,500 rupees. So because depreciation is possible, there is no question of capital gains in the third situation. Okay, so this was our case C. Now come on, let's come to the fourth case, case D. Again in the beginning, by the way, case D. So in the beginning of the year, we had two furnitures X and Y. Then furniture X is sold for 10,000 rupees. So X is sold, and furniture S is purchased for 40,000 rupees on 1st July 2025. So S is purchased. Again same thing, we sold an asset, but block is not empty. Because block is not empty, I will first try depreciation. Only if depreciation is not possible, only then we will have capital gains. Now what's your opening WDV number? That stays the same, 80,000 rupees. Then actual cost of assets acquired. We have acquired furniture S. We acquired furniture S for 40,000 rupees. Now whenever we purchase a new asset, we check two things. Was it put to use for at least 180 days? It was purchased on 1st July 2025. Let's say put to use on the same day. So definitely put to use for at least 180 days. Then will you have additional depreciation? This is furniture. There will be no additional depreciation. Okay. Then money is receivable for assets sold. We sold furniture X for 10,000 rupees. So what is your closing WDV now? Your closing WDV will be 1,10,000 rupees. Now again the same thing, you will split the closing WDV between three things: WDV 0 days, WDV less than 180 days. Both of these numbers you will get from the new assets. In the new assets, do you have any asset which is put to use for 0 days or less than 180 days? No, guys. So therefore WDV 0 days is 0. WDV less than 180 days is 0. This entire WDV will come under balance WDV. Okay. Now calculate your normal depreciation. Normal depreciation will be 1,10,000 into 10%, which is 11,000 rupees. Okay, so what's your opening WDV for the next year? 99,000 rupees. Again, same thing, depreciation was possible over here, so no question of capital gains. So in my fourth situation, my total depreciation is 11,000 rupees. This was case D. Now moving on to case E. So even over here, initial part remains the same. We have X and Y, two furnitures we have in the beginning of the year. Then furniture X is sold for 10,000 rupees, so X is sold. And furniture S is purchased for 40,000 rupees on 11th November 2025. So the sale of depreciable asset, but block is not empty. So same song guys. First I will try depreciation. Only if depreciation is not possible, only then we'll have STCG. So normal block computation, I will try for depreciation first. So what's your opening WDV? That stays the same, 80,000. Then actual cost of assets acquired. We purchased a new furniture. We purchased furniture S. We purchased furniture S for 40,000 rupees. Whenever we purchase a new asset, we check two things. Number one, was it put to use for at least 180 days? This furniture was purchased on 11th November 25. So even if it is put to use on the same day, definitely put to use for less than 180 days. And of course, no additional depreciation because furniture, not plant and machinery. Then what's the monies receivable for assets sold? What's the selling price? Furniture X is sold for 10,000 rupees. So what is your closing WDV now? 1,10,000. Now I will split the closing WDV into three parts: 0 days, less than 180 days, and balance. Same song guys, 0 days and less than 180 days. Both I will get to know from the new assets. Tell me, in the new asset, do you have any asset which was put to use for 0 days? No. In the new asset, do you have something which was put to use for less than 180 days? Yes. Furniture S is put to use for less than 180 days. 40,000 rupees. Okay, so what's your balance WDV now? 1,10,000 minus 40,000. The balance 70,000 will be your balance WDV. Okay, now compute depreciation. So I'll compute normal depreciation. This 40,000 is under less than 180 days. So you will get only half year's depreciation. So 40,000 into 10% into half. That's going to be 2,000 rupees. Okay, then on the balance WDV, on this how will you compute normal depreciation? On this you will compute full year's depreciation. So 70,000 into 10%, which is 7,000 rupees. So what's your total depreciation now? 7,000 plus 2,000, 9,000 becomes your total depreciation. So your WDV, opening WDV for the next year will be 1,01,000. So what was special about case E? Here we had asset put to use for less than 180 days. So therefore we got only half year's depreciation. So in case E, my total depreciation is 9,000. Now same thing, depreciation was possible over here. So therefore no question of STCG. Now come to case F, your sixth situation. This time again in the beginning of the year, we have the same two assets, first X and Y. So furniture X is sold for 2 lakh rupees. So X is sold. Furniture S is purchased for 40,000 rupees. So furniture S is newly purchased on 11th November 2025. So my initial information stays the same. Opening WDV is 80,000 rupees. We sold an asset, but the block is not empty. So first we will try for depreciation. Only if depreciation is not possible, we'll come to STCG. Okay. Then actual cost of assets acquired. We have acquired furniture S. We acquired furniture S for how much? For 40,000 rupees. Now, whenever we purchase a new asset, we always check two things. Number one, it was put to use on 11th November 25. So, definitely it's put to use for less than 180 days. Then, will you get additional depreciation? No, because it's furniture and not plant and machinery. Then, money is receivable for assets sold. We sold furniture X for how much? We sold it for 2 lakh rupees. So, what is your closing WDV on 31st March 2026? You will get a negative number, a negative of 80,000 rupees. But tell me, can WDV be negative? No guys. So therefore you will restrict it to 0. So therefore the selling price, even though it is 2 lakh rupees, you will restrict it to 1,20,000 rupees. Now tell me, if WDV itself is 0, will you have any depreciation? You will not have depreciation. So depreciation is not possible over here. Therefore, now you will come to capital gains computation. Okay, tell me, what's your full value consideration? For how much did we sell furniture X? We sold it for 2 lakh rupees. Then what's your cost of acquisition? Come on. Depreciable asset cases, your cost of acquisition will be opening WDV plus additions, right? What's your opening WDV? 80,000. What is your additions? 40,000. So your cost of acquisition will be 1,20,000. So therefore 80,000, this will become our STCG. Yes, depreciable asset will always be short term only. Okay, so in my sixth situation, depreciation is nil, but we will have STCG of 80,000. Now moving on to case G, our seventh situation. So again, in the beginning of the year, we have furniture X and furniture Y. Now furniture X and Y both are sold. X is also sold, Y is also sold for 10,000 and 35,000 respectively. So my block itself is empty. So because my block is empty, no question of depreciation. Straight away you will have capital gains only. So I won't even waste my time doing the block computation. Straight away I'll come to capital gains. What's your full value consideration? You're selling for how much? 10,000 plus 35,000. So 45,000 will be your full value consideration. Then cost of acquisition will be opening WDV plus additions. Opening WDV is 80,000 rupees. In this situation, we did not purchase any new asset. So 80,000 becomes my cost of acquisition. So your net number will be a negative 35,000. This will be STCL. Negative number, no? So therefore loss. Got the point? So block was empty. Because block is empty, no question of depreciation. So straight away I'll come to capital gains. And in capital gains computation, I'm having a negative number over here. Therefore, it's going to be a loss. Okay. This was your case G. Now come to case H. So even over here in the beginning of the year, you have two furnitures X and Y. Then furniture X and furniture Y both are sold. X is also sold, Y is also sold for 10,000 and 35,000 respectively on 11th November 25. New furniture T is purchased for 5,000 on 1st July 25. So over here if you see, my block is not empty. Because we still have furniture T in our block, this new furniture, we have it in our block. So because block is not empty, same thing, I will first try for depreciation. Only if depreciation is not possible, only then I'll come to capital gains, guys. Come on, help me with the numbers. What's your opening WDV? 80,000. Then actual cost of assets acquired. We have acquired furniture T. We acquired furniture T for how much? For 5,000 rupees. It was acquired on 1st July 2025. So definitely put to use for at least 180 days. And there will be no additional depreciation because this is furniture and not plant and machinery. Then money is receivable for assets sold. We sold furniture X, furniture Y, both we sold for 10,000 and 35,000 respectively. So total selling price is how much? 45,000, guys. So what's your net number now? 80,000 plus 5,000 minus 45,000, your net number 40,000. This will become your closing WDV on 31st March 26. Now this number you will split into three parts. WDV 0 days, WDV less than 180 days. Both these numbers you will find from your new asset. In your new assets, do you have something which was put to use for 0 days? Do you have something which was put to use for less than 180 days? No. So WDV 0 days is 0. WDV less than 180 days is 0. So what's my balance WDV? This entire 40,000 becomes my balance WDV. Now on this I compute my normal depreciation first. So normal depreciation will be 40,000 into 10%, which is going to be 4,000 rupees. Of course, no additional depreciation, nothing. So 4,000 becomes your total depreciation. So 36,000 will be your opening WDV for the next year. So in situation H, the total depreciation for my assessee is 4,000 rupees. So case G and case H, till H 8 situations we have completed already. Now come to situation I next. So in the beginning of the year, we already have X and Y. Then furniture Z is purchased for 40,000 rupees. So we are having a new furniture now, furniture Z, purchased on 1st July 25 and put to use on 11th November 25. So what's your opening WDV? All that remains the same. Opening WDV is 80,000 rupees. Then new asset acquired. This time we have acquired furniture Z. We have acquired furniture Z for how much? For 40,000 rupees. We will check for two things. Number one, did we put it to use for at least 180 days? Question says it was put to use on 11th November 25. So definitely put to use for less than 180 days. And of course, no additional depreciation. This time we have not sold any asset, guys. So 1,20,000 as it is becomes your closing WDV. Now this you will split into three parts. 0 days, less than 180 days and balance. So we have less than 180 days. Less than 180 days is 40,000. 0 days is nil. So what's your balance WDV now? 1,20,000 minus 40. 80,000 will be your balance WDV. Now come on, compute normal depreciation. 40,000 into 10% into less than 180 days. Therefore, you will get only half year's depreciation. That's going to be 2,000 rupees. Okay, then on this balanced WDV, how will you compute normal depreciation? 80,000 into 10%, which is 8,000. So what's your total depreciation now? 8,000 plus 2,000. Then 10,000 becomes your total depreciation. So 1,10,000 will become the opening WDV for the next year. So total depreciation is 10,000 rupees. Alright, this was your question. This was your subdivision I. Got the point? Here we did not sell any asset, we only purchased an asset. Okay, this was simple. Now come to situation J. Even over here in the beginning of the year, I have two assets X and Y. Then furniture Q is purchased. So we purchased one new asset Q. It was purchased for 50,000 rupees on 1st July 25 and it was put to use on 1st November 25. So come on, same thing now. Usual process. What's our opening WDV in the beginning of the year? Our opening WDV is 80,000 rupees. Now comes our next step, the new assets. We have purchased a new asset furniture Q. It was purchased for 50,000 rupees. It was purchased on 1st July 25, but please make a correction in the question. It was put to use on the 1st November 2026. So was it put to use in the current year? No, it was put to use only in 26-27, not even put to use in the current year. So current year, no depreciation on that asset. So it won't even enter into the block, guys. Then money is receivable for asset sold. We did not sell any asset during the year. So therefore, our closing WDV will be 80,000. WDV put to use for 0 days is 0. WDV put to use for less than 180 days is 0. Your entire WDV will come under balanced WDV. On this, I will claim my usual normal depreciation, which will be 80,000 into 10%. So my total depreciation will be 8,000 rupees and opening WDV for the next year will be 72,000 rupees. So in situation J, my total depreciation is 8,000. So the new point over here is that in the current year, I did purchase a new asset. I did purchase asset Q, but I did not put it to use in the current year. I put it to use only on 1st November 2026, which is previous year 26-27. So in the current year, I did not put it to use. So on this asset, no depreciation in the current year. So I did not even let it enter into the block, and therefore I claim depreciation on this opening WDV of 80,000 only. Okay, this was point J. Now come to your next situation, your situation K. Even over here in the beginning of the year, we have two assets X and Y. Then what happened? Furniture R was purchased. So new furniture R is purchased for 30,000 rupees on 1st July 24. So this was purchased in 24-25. Last year it was purchased, but put to use on 11th November 25, which is 25-26. So case K is total opposite of case J. See, I'll tell you why. Listen to me. If you look at case J, the new asset, when did we purchase a new asset? In case J, we purchased a new asset on 1st July 25. In previous year 25-26, we purchased the asset, we acquired the asset. But when did we put the asset to use? Only on 1st November 26, which is previous year 26-27. So in 25-26, the asset will not enter into the block. On this asset, no depreciation. Everything will happen only in 26-27. Same way, in case K, if you see, here when did we purchase a new asset? Here we purchased a new asset on 1st July 24. In previous year 24-25, we acquired the new asset. But however, we put the asset to use only in 25-26. In November 2025, we put the asset to use in previous year 25-26. So don't you think for this asset in 24-25, because you did not put the asset to use in 24-25, you would not have enjoyed any depreciation. In 24-25, you wouldn't even have let the asset enter into the block. You would have said everything will happen now in 25-26 only when you put the asset to use. Getting the point? So come on. Now this particular furniture R, which we purchased last year, but we did not put it into use last year. So last year it would not even have entered into the block. Current year you are putting the asset to use. Current year only it will enter into the block. Current year only you will claim depreciation first time. Okay. So come on, tell me what's the opening WDV? All that stays the same. Opening WDV is 80,000. Then actual cost of assets acquired, I will put furniture R into the block now. Furniture R. I purchased it for how much? 30,000 rupees. Actually, I purchased it last year. But last year we did not put it into use. Current year only we are putting it into use. Current year only it will enter into the block. Now tell me, will you check 180 days? No guys, you will not check 180 days because this asset R is being put to use in the subsequent year. 25-26 becomes a subsequent year, right? See, only if I'm putting the asset to use in the year of acquisition itself. then only you check whether it was used for 180 days or not. But if I'm putting the asset to use in subsequent year, 180 days is irrelevant. Even if I put the asset to use for 1 day, I will get full year's depreciation. Okay, so I will not even think about the 180 days point. No additional depreciation, of course, because it is building and not plant and machinery. So I'll keep moving on now. Did we sell any asset during the year? No. So total 1,10,000 becomes your closing WDV. WDV 0 days, WDV less than 180 days we don't have. So what's your balance WDV? The entire 1,10,000 will be your balance WDV. On this you will compute your normal depreciation, which will be 1,10,000 into 10%, which will be 11,000 rupees. That will be your total depreciation. So 99,000 rupees will be your opening WDV for the next year. This is an amazing situation, guys. So here, what was your biggest learning? Learning number one, that you did not put the asset to use in the last year. So therefore, last year it will not even enter into the block. You're putting the asset to use in the current year. So current year only it will enter into the block. Learning number one. Learning number two, so the current year becomes subsequent year for this asset. So if it is subsequent year, you will not care about 180 days. Even if you put the asset to use for 1 day, you will still get full year's depreciation. Got it? This was your case K. Now come to case L. Let's see what has happened here. In situation L, furniture S was purchased for 10,000 rupees on 1st July 25 and put to use on 11th November 25. So we already have furniture X and furniture Y. Then we purchased furniture S. It was purchased for 10,000 rupees on 1st July 25 and put to use on 11th November 25. And furniture X and Y were sold for 10,000 rupees and 6,000 rupees respectively. So X and Y are both sold, and furniture S we have sold depreciable asset, but of course block is not empty. Because block is not empty, first I will try for depreciation. Only if depreciation is not possible, then only I will come to capital gains. So come on, what's the opening WDV number? All that will stay the same only. Opening WDV is 80,000 rupees. Then actual cost of assets acquired. We have acquired S during the year. We have acquired it for 10,000 rupees. When did we put it into use? 11th November 25. So definitely we have put it into use for less than 180 days, and of course no additional depreciation because this is furniture. Then money is receivable for assets sold. We did sell X and Y. We sold it for 10,000 and 6,000 respectively. So our total sale price is 16,000 rupees. We'll subtract that. So what's your closing WDV number now? Your closing WDV number will be 74,000 will be your closing WDV. Now tell me, in this how much WDV is put to use for 0 days? Nil. WDV less than 180 days. Come on, remember 0 days and less than 180 days, both you will get to know from the new asset step. So here we don't have 0 days, but we do have less than 180 days of 10,000 rupees. So on this, what will be your normal depreciation? 10,000 rupees into 10% into less than 180 days. No, so therefore you will get only half year's depreciation. That's going to be 5,000 rupees. Then after that, 500 rupees. 500 rupees will be your normal depreciation. Then what's your balance WDV? Out of 74,000, we put 10,000 here. We still have balance WDV of 64,000. On this, your normal depreciation will be 64,000 into 10%, which is 6,400. So your total depreciation, 6,400 plus 500, your total depreciation will be 6,900. So your opening WDV for the next year will be 67,100. So in situation L, your total depreciation is 6,900. This was simple, okay? This was your case L. Now come to case M. Just the last 3 cases, guys. Don't lose your patience. So again, in the beginning of the year, we have X and Y. And then what happened? Furniture R is purchased. R is purchased for 30,000 rupees. So we purchased furniture R on 1st July 2025. And it was sold for 40,000 rupees on 11th November 25. So what has happened in this situation is, during the year, we purchased furniture R. And in the same year, we also sold furniture R. Getting the point? We purchased and sold this new furniture in the same year itself. Opening WDV remains the same, 80,000 rupees. Then actual cost of assets acquired. We acquired furniture R. We acquired it for how much? We purchased it for 30,000 rupees. Now, was it put into use for at least 180 days? See, there are 2 ways of thinking now. First way of thinking is I purchased it on 1st July 2025. I sold it on 11th November 25. So what is this time gap? Now this time gap is going to be less than 180 days. So therefore put to use for less than 180 days. Therefore half year's depreciation. This is one way of looking at it. Another way of looking at it is that we purchased the asset on 1st July 2025. Now I don't care when did I sell it. 1st July 25 till the end of the year, if you see, is definitely at least 180 days. So therefore I will get full year's depreciation. Please know that I know that this first one is sounding more logical, but this is not right. We will not see from the date of purchase to the date of sale. We will not see like that. Instead, what we will see is when did we put the asset to use? On 1st July 25. 1st July 25 till the end of the year, if you see, is definitely at least 180 days. So therefore, this asset is put to use for at least 180 days and there will be no additional depreciation also. Then money is receivable for asset sold. The same furniture we sold for 40,000 rupees. So your closing WDV will be 70,000 rupees. So your big learning over here is even though we sold the asset on 11th November, we will not count the days of put to use from 1st July to 11th November. No. 1st July we purchased the asset, till end of the year we will see. 1st July to 31st March. That's definitely at least 180 days. So full year's depreciation. Okay. Then WDV 0 days is 0. WDV less than 180 days is 0. So the entire amount will come under balance WDV. So on this, when I calculate my normal depreciation, 70,000 into 10%, this will be 7,000 rupees. Okay, so 63,000 rupees will become your opening WDV for the next year. So in this situation, my total depreciation is 7,000 rupees. This was your case M. Now come to case N. So here assessee sold furniture X and Y. So in the beginning of the year, we have X and Y. So we sold both. We sold X and Y, we sold both for 95,000 rupees on 1st July 25, and then we purchased furniture R for 30,000 rupees on 11th November 25. So we sold both the assets and we purchased one new asset. So opening WDV remains the same, 80,000 rupees. Then actual cost of assets acquired, we acquired furniture R. We acquired furniture R for 30,000 rupees. See, we acquired it on 11th November 25. Even if it is put to use on the same day, definitely put to use for less than 180 days and definitely no additional depreciation. Then money is receivable for assets sold. We sold X and Y for 95,000 rupees. So your closing WDV at the end of the year will be 15,000 rupees. Now this you will split into three parts. WDV 0 days and less than 180 days you will get to know from the new asset. In the new asset you don't have 0 days, but you do have less than 180 days, 30,000. Now listen very carefully. This is where the main part of this question is. See, how much do we have in less than 180 days? We have 30,000. But tell me, can I write 30,000 fully over here? No guys, my WDV has to be split between these three numbers. If WDV itself is 15,000 rupees, how can you write 30,000 over here? So no doubt less than 180 days is actually 30,000, but I will have to restrict it to 15,000. Are you getting my point? Yes, see, my WDV is 15,000 only. This only we split into three parts. So no doubt less than 180 days is actual 30,000, but you can't write 30,000 here fully because WDV itself is 15,000 only. So how can you write 30,000 here? So that is why even though it is 30,000, we will restrict it to 15,000. So how much is your balance WDV now? Balance WDV is nil. Total WDV was 15,000. Full 15,000 we have written over here. There is no WDV left now. So come on, calculate normal depreciation. Normal depreciation will be 15,000 rupees into 10% into less than 180 days. So therefore you will get only half year's depreciation, which will be 750 rupees. So your total depreciation for the year will be 750 rupees and your net opening WDV for the next year will be 14,250. Okay, so in situation N, you will have depreciation of 750. So the main thing in this situation is that even though less than 180 days, you actually have 30,000, but you can't write 30,000 over here because your WDV itself is 15,000 only. It is 15,000 that you're splitting into three parts. So when WDV itself is 15,000 only, how can you write 30,000 over here? So even though it is 30,000, we restricted it to 15,000. Okay, this was your point N, and now one final situation O. Now situation O, your last situation, this is a combination of 2 to 3 situations, okay? So this is of course important. So the question says, of course in the beginning of the year we have X and Y, then we sold furniture X, okay, for 90,000 rupees on 11th July 25, and the following furniture were put to use. So these are put to use furniture, new furnitures which were put to use in the current year. Furniture A was put to use on 18th December 2025, purchased on 17th December 2025 for 30,000 rupees. Then we put to use furniture B on 18th December 26, purchased on 15th August 25, furniture B. So like this, they have given us 5 furnitures A, B, Z, P, Q. They were all new ones which are purchased and put to use somewhere in the current year. Okay, so let's start solving. As we start solving, we'll keep looking at these adjustments and we'll keep making a note. My opening WDV stays the same only. Opening WDV is 80,000 rupees. Now come on, let's see the new assets one by one and we'll put them down. Let's talk about furniture A first. It was put to use. See, this date over here is when was it put to use? Purchased on these dates. So these dates is when was the asset purchased. Okay, so furniture A was purchased on 17th December 25 and put to use on 18th December 25. The amount is 30,000 rupees. See, it is put to use on 18th December 25, which is definitely less than 180 days. So therefore here you will get only half year's depreciation and of course no additional depreciation. Then comes furniture B. This is for how much? This is for 50,000 rupees. Now this furniture, if you see, was purchased on 15th August 25 current year and put to use on 18th February 26 current year, but put to use in February, guys, so definitely put to use for less than 180 days. So therefore we will get only half year's depreciation and of course no additional depreciation. Then comes furniture Z. Furniture Z is for how much? 60,000 rupees. Now this furniture was purchased on 17th July 2024. It was purchased last year, guys, in 24-25, but it is put to use in 18th April 2025. It is put to use in the current year. Remember, some situation in the past, situation M, situation N was all this only. We had purchased this last year in 24-25, but in 24-25, we did not put it to use. So in 24-25, this would not have entered into the block. When are we putting it to use? In 25-26. So now when we put it to use, it will enter into the block. 60,000 rupees. Now this current year becomes subsequent year for this asset. So I will not check 180 days, less than 180 days and all. I will not even check. Okay. This was furniture Z. You were able to recall, right? It was purchased last year, put to use in the current year. So because it was not put to use in the last year it will not even enter into the block. Current year, you're putting it into use. So current year, it will enter into the block. But current year becomes the subsequent year for this asset. So when it is subsequent year, you will not bother about whether it is, whether it is less than 180 days or more than 180 days, you will not bother. Then we have furniture P. Furniture P was purchased on 17th May 24. Again, it was purchased last year and it was put to use on 8th December 25. It is put to use in the current year. So last year it was not put to use. So last year it will not even be a part of the block. Current year it is put to use. So current year this number will enter into the block. But current year becomes the subsequent year for this asset. So I will not bother about 180 days and all. I will straight away get full year's depreciation. Then comes furniture Q. This furniture was purchased on 31st March 26, purchased in the current year, but it is put to use on 1st April 26. It is put to use in 26-27. It is not put to use in the current year. It is put to use only in the next year. So next year only it will enter into the block. Current year it will not enter into the block. Current year no depreciation on this asset. So furniture Q will not enter my block. Getting the point? It is not put to use in the current year. So therefore current year no depreciation on this asset. Current year it will not impact my block. Okay. Then assets sold. We sold furniture X. We sold furniture X for 90,000 rupees. So what's your closing WDV now? Your closing WDV will be 1,40,000 rupees. Now this you will split into 3 parts. Tell me how much WDV 0 days and less than 180 days. Both of this you will get to know from the new asset. In the new asset, do you have anything for 0 days? No. Do you have anything for less than 180 days? Yes. 30,000 and 50,000. 80,000 is for less than 180 days. So what's your balance WDV now? Out of 1,40,000, 80 you have written over here, 60,000 becomes your balance WDV. Okay, now on this 80,000, compute your normal depreciation. 80,000 into 10% into 1 by 2 by 1 by 2. It is put to use for less than 180 days. Therefore, you will get only half year's depreciation. This is going to be 4,000 rupees. Okay, then on the balance WDV compute depreciation, your normal depreciation will be 60,000 into 10%, which is 6,000 rupees. So your total depreciation will be 10,000 rupees, and your opening WDV for the next year will be 1,30,000 rupees. So this is your situation O, where your total depreciation will be 10,000 rupees. Got the point? So with this, you're done with question number 34. The whole objective of question number 34 is to give you various situations with respect to depreciation, so that you know what exactly you should do in the examination. See, chances of you getting question number 34 as it is in the examination is 0. It is impossible for you to get this question in the examination. Then why did we do it? Because any situation, any case can be a part of your question. So you should know exactly how to handle. Okay guys, this was your situation, your question number 34. Now let's close this question and come to question number 35. Question number 35 is also a depreciation related question, but this is a concept which comes into the picture when there is a succession or when there is a conversion. Like for example, here in this question you will see that a sole proprietary concern is getting converted into a company. So in conversion cases, in succession cases, how will you split the depreciation between the two entities? All that you will learn in question number 35. It's a model question paper question. Okay, we'll take this up next. So the question says, Messrs. Siddhant & Co., a sole proprietary concern, is converted into a company, Siddhant Company Limited, with effect from 29th November 2025. The written down value of the assets on 1st April 25 is given to you. Situation is clear. Initially, we had a sole proprietary concern, which is now getting converted into company. When did the conversion happen? 29th November 2025. Okay. Then they've given us the WDV of the assets on 1st April 25. So opening WDV they have given to us for building, for furniture, and for plant and machinery. So 3 blocks we're having. For each block, opening WDV they have given to us. Okay. Then on 15th October 2025, Messrs. Siddhant & Company purchased a plant for 1 lakh rupees. Rate of depreciation is 15%. So did they purchase this before conversion or after conversion? Conversion happened in November. They purchased this plant in October. So they've purchased it before the conversion. Okay. Then after conversion, the company added one more plant worth 50,000 rupees after the conversion. So there are totally how many new assets purchased? Totally 2 new plants are purchased. One is purchased before the conversion and one is purchased after the conversion. Okay. Examine the amount of depreciation available to Messrs. Siddhant & Company and Siddhant Company Limited for the year. So basically what has happened is, during the year, the sole proprietary concern has converted into company. So for a part of the year, depreciation will be enjoyed by the earlier entity, that is sole proprietary concern. And for the second part of the year, the depreciation will be enjoyed by the new entity, that is a company. So we'll have to split the depreciation between the two entities, okay? But however, this new asset which is purchased after conversion, this 50,000 plant and machinery which is purchased after conversion, this plant and machinery who will enjoy depreciation? Only company will enjoy depreciation, right? Because this was purchased by the company after conversion. So whatever happens after conversion, leave that. Whatever has happened before conversion, consider that first. Okay, so let's do the computation. So we are having totally 3 blocks over here. Let's take them up one by one. First, let's compute the depreciation as if there is no conversion, as if there is 1%. First, let's compute depreciation like that. So first of all, building. Now building, there is no new asset and all purchased during the year. So for building, opening WDV is how much? 3,50,000. So 3,50,000 into 10%, 35,000 will become the depreciation for the entire year. The whole block computation not required over here because we didn't purchase any new building. We didn't sell any building. So 3,50,000 opening WDV into 10%, 35,000, that will become the WDV. Easy, okay. Then come to the second block. What's the second block? Furniture. Even furniture, same thing. We did not purchase any new furniture during the year. We did not sell any furniture during the year. So whatever is the opening WDV, we'll work with that itself. The opening WDV is 50,000. So 50,000 into 10%, 5,000 will be the depreciation on furniture. All this I am computing as if there is no change, as if there is no conversion. Okay. Then comes your plant and machinery block. Here I'll have to do the whole block computation, guys, because we have a new plant which we purchased for 1 lakh rupees before conversion, and we have one plant which we purchased after conversion. Whatever happened after conversion, leave that for now. For now, we will focus only on whatever has happened before the conversion. Okay, so plant and machinery, if you see, what's your opening WDV? On 1st April 2025, opening WDV is 2 lakh rupees. Then you add the actual cost of assets acquired, that is your new assets basically. So we have one new asset, one new plant. This new plant was purchased for how much? It was purchased for 1 lakh rupees. Okay, when was it purchased? On 15th October 25. So definitely it's put to use for less than 180 days, and the question does not say assessees into manufacturing and all, therefore no additional depreciation. Okay, so this is one plant. One more plant is purchased, but that is purchased after conversion, so right now I will not bother about that. Okay, then less money is receivable for assets sold. We have not sold any asset during the year, so therefore what is your closing WDV now on 31st March 2026? Your closing WDV will be 3 lakh rupees. Okay, and then you know very well we always split our WDV into three parts. WDV which is put to use for 0 days, and WDV which is put to use for less than 180 days. Both of these numbers we generally find from the new asset step. In the new asset step, we don't have anything for 0 days, but we do have less than 180 days, which is 1 lakh rupees. Okay, so on this, what will be your normal depreciation? 1 lakh into 15% into less than 180 days. So therefore only half year's depreciation I will get. That will be 7,500 rupees. Okay, no additional depreciation, we already concluded. And then the last part will be your balance WDV. So out of 3 lakhs, on 1 lakh you have already computed. So WDV 0 days was 0. WDV less than 180 days was 1 lakh. So what's your balance WDV? 2 lakhs will be your balance WDV. On this, what will be your normal depreciation? 2 lakh into 15%, full year's depreciation I will get 30,000 rupees. Okay, so what's your total depreciation now? 7,500 plus 30,000. Your total depreciation for this plant and machinery block will be 37,500. Do you agree? 7,500 here, 30,000 here, total is 37,500. So now what is your opening WDV on 1st April 2026? 3 lakhs minus 37,500, 2 lakh 62,500. This will become your opening WDV for the next year. Alright guys, now come on, let's do the table now. So whatever depreciation we have calculated, we will split the depreciation between the sole proprietorship and the company. Total how many blocks are we having? 3 blocks, building, furniture and plant and machinery. So each depreciation number we will pick and we will split between these two entities. Okay, we'll go one by one. Let's start with the easy ones first. Let's start with building. So for building, what's the total depreciation? First of all, see, the total depreciation was 35,000 rupees. Okay, now this 35,000 I will split between both the entities in what ratio? Now you have to be very careful when you calculate the ratio. When did the conversion happen? 29th November. Which means I can say that from 1st April 2025 to 28th November 2025. For these days, we had the sole proprietorship concern. Then 29th November 2025 to 31st March 2026. For this period, we have the company. So how many days? Calculate and tell me now. April to November, 30 days in April, 31 days in May, 30 in June, 31 in July, 31 in August, 30 in September, 31 in October, and in November 28 days. So sole proprietorship concern is for 242 days. So the balance number of days, that is 365 days total. 365 minus 242, the balance 123 days we have the company. So whatever is the depreciation, we will split the depreciation between the sole proprietorship concern and the company in the ratio 242 is to 123. So what's the ratio? 242 is to 123. Come on, let's split. So how will you split? Like for example, 35,000 is a depreciation. This into 242 by 365 will be enjoyed by the sole proprietorship concern. So 35,000 into 242 by 365, which is going to be 23,205, and the balance will be enjoyed by the company, that is 35,000 into 123 by 365. So this will work out to 11,795. You're understanding? So whatever is the depreciation, we're going to split the depreciation between the proprietorship concern and the company in this ratio of number of days. Okay, this is for building. Now same way we will do for furniture. First tell me, for furniture, what was the total depreciation? The total depreciation for furniture was 5,000. Same thing now. This 5,000 I will split between both the entities in the same ratio. 242 is to 123. That is 5,000 rupees into 242 by 365. Then 5,000 rupees into 123 by 365. Calculate how much are you getting. For the sole proprietorship concern, it will be 3315. And for the company, the balance 1685. Okay, so building and furniture we are done. Now comes plant and machinery. Here we have to be a little extra careful. So my third asset is plant and machinery. See, plant and machinery will go one by one. Okay, first have a look at the block. How many depreciation numbers are you having in plant and machinery? I am having two numbers, guys. I am having the 7,500 number and this 30,000 number. See, the 7,500 depreciation is on this 1 lakh rupees new asset. Are you noticing? The 7,500 depreciation is on this 1 lakh asset. 1 lakh asset is a new asset, the new plant which we had purchased before conversion. So in my plant and machinery block, I am having totally three things. I am having my opening WDV. Then I am having the new plant which I purchased before conversion. And then I have one more plant which I purchased after conversion. So I am having three things. So each of these three things we will do one by one, guys. I'll show you how. First of all, the opening WDV. What is the opening WDV in the beginning of the year? 2 lakh rupees. On that 2 lakh, what is the depreciation? See, we calculated here. On that 2 lakh, our depreciation is 30,000 rupees. So we have totally three things in plant and machinery. The opening WDV, the new plant purchased before conversion, and new plant purchased after conversion. So on the opening WDV alone, my depreciation is 30,000 rupees. This will be split between the old entity and the new entity. Same thing in the ratio 242 is to 123. That is 30,000 into 242 by 365. And then 30,000 into 123 by 365. Do the computation, please. 19,890 and 10,110. Okay, then we have the new plant and machinery, the new plant which was purchased before conversion. On that new plant, how much is the depreciation? The 1 lakh asset, on that the depreciation is 7,500 rupees. So this 7,500, this will be split into what ratio? Not same ratio, guys. This will be different ratio, because see, when was the new plant purchased? 15th October 25, right? So 15th October 2025 to 28th November 2025. For this period, the new plant and machinery was enjoyed by the sole proprietary concern. The balance period, that is 29th November 25 to 31st March 2026, for the balance period it was enjoyed by the company. Now this period is how many days? See, this and this are the same periods only, right? This is totally 123 days. Now 15th October to 28th November, this is how many days? Calculate. In October, 31 minus 15 plus 1, because even 15th October you will count. Then November, 28 days. So the sole proprietorship concern has enjoyed the asset for 45 days. Getting the point? So the opening WDV and all, we split between the two entities for across the entire year in the ratio 242 is to 123. But however, the new plant which we purchased before conversion, we purchased on 15th October only. So 15th October to 20th November, it was enjoyed by the sole proprietorship concern for 45 days. And for the remaining period, it was enjoyed by the company. So totally, this new asset has existed for how many days? Totally, it has existed for 168 days. In that 168 days, 45 days by the old entity and 123 days by the new entity. So on the new plant and machinery, my depreciation 7,500. This will be split in the ratio 45 is to 123. Okay, 45 is to 123. That is 7,500 into 45 by 168 and 7500 into 123 by 168. Calculate and tell me now. 2009 and the balance 5491. Understood. So with this we have handled building, furniture, and in plant and machinery, we've handled the opening WDV, we've handled the new plant and machinery which was purchased before the conversion, and now we have one more plant and machinery, guys, the new plant and machinery which we purchased after the conversion. 50,000 rupees. Now this one was purchased by the company after conversion. So on this 50,000, whatever is the depreciation, the entire depreciation will be enjoyed only by the company. So 50,000 rupees into 15% depreciation into 1 by 2. Why 1 by 2? Because it is purchased after conversion. Conversion itself happened on 29th November 25. So if we purchase after 29th November, definitely less than 180 days. So only half year's depreciation. That's going to be 3,750. The entire depreciation will be enjoyed by the company only over here. We will not split this between the two entities because this asset was purchased after conversion only. Okay, that's it, guys. So add up now and tell me what's the total depreciation that the sole proprietorship concern will enjoy and the total depreciation that the company will enjoy. For the sole proprietorship concern, you will have 48,419. And for the company, for the company 32,831. Got it? That is it with question number 35. It's a unique question where there is a conversion or there's a succession. So you split the depreciation between the two entities. But remember, whichever asset is purchased after the conversion, on that asset, whatever is the depreciation, the entire depreciation will be enjoyed by the new entity only. Okay, this was question number 35. Now come on, guys, come to question number 36. Now question number 36 is a full-fledged PGBP question. So we've done 2 questions in this session. Even the earlier question was all about depreciation only. It was not a full-fledged PGBP. Even the question we did now was focusing on depreciation. Now come to question number 36. It will feel a little different. We're coming back to our full-fledged PGBP question. The question says Mr. Gopal is a proprietor of a business. Following is his P&L account. So they have given us his P&L account. We have the net profit number. Then they've given us some information. Compute income taxable under the head business and profession. So they're not asking us for total income. They're only asking us to compute PGBP. Mr. Gopal does not opt to be taxed under 115 BAC. So he does not want 115 BAC. 115 BAC is nothing but the new regime, the default regime. He does not want this new regime. So which means my entire computation will be as per the old regime. So come on, let's begin. They're only asking us for PGBP computation as per the old regime. Let's start. Now because I have the net profit number to compute my PGBP, I'm going to use my indirect method, that is nothing but my 5 steps method. In simple words, we will start with net profit as per P&L account. Then we will add expenses debited but not allowed. Then we will add incomes not credited but taxable. Then we will subtract expenses not debited but allowed. And finally, we will subtract incomes which are credited but not taxable. By now, I'm guessing you would be used to this method. Okay, let's begin. We always look at the credit side first. Gross profit, nothing to do. Then interest on government securities. See, this will go into the IFOS head. So how will I remove this from my PGBP, guys? It's already credited in the P&L. How will I remove a credit? By debiting it. Debiting means you will subtract it. So it's an income credited but not taxable. Over here, I'll subtract this interest on government securities. The amount is 5,350. Alright, because it should go into the IFOS head instead. Then rent from property. Even this should go into IFHP head. So, but then it is credited to P&L. So, how will you remove it from your PGBP? How will you remove it from your P&L? How will you remove a credit? By debiting it. That is again subtracting it. So, rent from house property, 5,400. We've removed this also. Now, come to the debit side. Establishment charges, rent rates, taxes, sundry expenses, they're all business expenses, nothing to do. But what about household expense, personal expense, guys? This is not relating to your business or profession. This should not be debited to P&L, but it is debited. So how will you reverse a debit? By crediting it. You will add it back. So household expenses, expense debited but not allowed. household expenses, what's the amount that is to be added? 1880. Okay, then we have provision for bad debts. Provisions and all will always be disallowed. See, bad debts will be allowed, but provisions and reserves will be disallowed. So provision for bad debts, 1200. I'm reversing it, I'm adding it back. Okay, then come to the remaining transactions. Loss on sale of motor car used for private purpose. Loss on sale of car, that too it is used for personal purpose. It is not a business loss. So I'm supposed to remove this from my P&L. How will you remove a debit? By crediting it, you will add it back. Loss with respect to car, 1800. Then salaries, business expense, nothing to do. Insurance premium, including life insurance of 1790. See, life insurance of 1790 will go to ATC, chapter 6A. It's a personal expense. This life insurance should not come into your P&L, but it has been debited. So how will you reverse a debit? By crediting it, you will add back this 1790. So life insurance premium 1790 I am adding back. Then interest on bank loan, I'll assume the loan was used for business or profession. Then provision for depreciation, I'll assume this depreciation is as per Income Tax Act. And then we have the net profit number. Net profit number, make a note, 1,80,150. Okay, now come to the additional information. Bad debts written off during the year, 650. So I'll assume it is relating to the business of the assessee. I'll assume it was earlier considered as income. I'll assume it has been written off as bad in the books of accounts. So this bad debts will be allowed. So it's an expense, it's a loss. It is not debited, but it is allowed. Bad debts. How much is the amount? 650. We are now allowing it. Okay. Then admissible depreciation as per income tax rules is 1600. So if this is a depreciation as per Income Tax Act, it means that this depreciation which is already debited in the P&L, this is not as per Income Tax Act. So I'll reverse this depreciation and I'll allow 1600. So how will you reverse a debit? By crediting it, by adding it back. So first you will reverse the entire depreciation as per P&L account, which is 6400. I'll first reverse it fully. Then I'll allow the correct depreciation. What is the correct depreciation as per Income Tax Act? The correct depreciation is 1600 rupees. Okay, this is also done. Then comes your third adjustment. The assessee is running his business in a rented property, half of which is used by him for his own residence. Are you understanding what has happened? This is the most important adjustment in this question. This is an examination question, guys. If you see, when compared to all the questions which we've done till now, it feels pretty simple, right? But there's only this one adjustment over here which we have to ensure we do it properly. The assessee is running his business in a rented property. So he has taken a property on rent and this is where he is doing his business, half of which is used by him for his own residence. So out of this property, half of the property is used for his residence and half of the property is used for his business or profession. Okay, and this is a rented property, which means he will be having rent expense for this property. Okay, rent of 2400 in respect of the entire house is included in rent rates and taxes. For this entire house, the rent is 2400. And this 2400 is already included in rent rates and taxes. So this 2400 is already fully debited to the P&L, guys. So let's handle this part first. So this last adjustment is still left. Till here alone we're handling first. Okay, 2400 is already debited. Now what to do? See, half of it is anyways relating to business or profession. That is not a problem. But this half which is relating to residence, this should not be debited to P&L because it becomes a personal expense. So half of this which is relating to the residence portion, 1200, this will be disallowed. Disallowed means what? I will add it back. Okay, so rent relating to residence, 2400 into half, 1200 I am adding back. You got the point? Half is relating to residence, which is not relating to business or profession. That half I am disallowing. Okay, then listen. Total, how much is the rent rates and taxes? 2900. Out of this 2900, they have given us information of 2400. At 2400 is rent for the entire property. We have handled it. How much more is there in rent, rates and taxes now? Out of 2,900, they've given us information for 2,400. We still have 500 in the rent, rates and taxes. That 500 they are saying the balance 500 is on account of municipal tax paid for the property given on rent. Do you recall we are having rental income? Do you recall we are having rental income over here, which means assessee has a property which is given on rent, which will go into IFHP head. So relating to that property, we have municipal tax of 500 which has been debited to the P&L. This 500 is relating to the let out property. This 500 is relating to the IFHP head. So I have to remove it from my PGBP. I will disallow it. I will add it back. So municipal tax 500 rupees, I'm reversing it. You got the point? This entire 500 is relating to the property given on rent. Assessee has a let out property from which assessee is having rental income, which will go into the IFHP head. So relating to that property, we are having 500 municipal tax. So I have to remove it from my PGBP because it is not relating to my business or profession. That's it, guys. Come on, add up and give me your PGBP number. PGBP is 1,81,920. Please check. Got it, guys? So the entire question was simple. The only one adjustment over here that was slightly tricky was this adjustment, this entire adjustment over here. I hope you got it. First, they gave us information about the rent. Half of the rent is relating to residents, so we disallowed that. Then they told us 500 is municipal tax relating to the let out property, so we disallowed that also. Got it? So this was your question number 36, guys, an examination question, your December 23 examination question. Okay, so with this we will close this session over here. I'll see you in our next session. We'll take up question number 37 onwards in our next session. Thank you. Bye-bye. Hello champions, so let's begin our next session. We're going to straight away start off with question number 37. This is relating to the assessment of firms. I hope you recall one similar question we had done a little earlier as well. So it'll be more or less similar to that question, okay? The question says Messrs. T&U Company, a partnership firm having two equal partners, Taresh and Umesh. The firm furnishes the following P&L account to you relating to the financial year 25-26. So we have the P&L of the firm. We have the net profit number of the firm. Okay. Additional information. Firm has brought forward business loss of 20,000 rupees and unabsorbed depreciation of 40,000 rupees relating to last year, assessment year 25-26. So we have brought forward business loss of 20,000 rupees and we have unabsorbed depreciation of 40,000 rupees. Okay. Interest is paid to Taresh at the rate of 16% per annum. Firm took a loan from Taresh. Getting it? So it is not interest on capital, it is interest on loan. Firm took a loan from Taresh and on that the firm is paying 16% interest. The scheduled banks in India charge interest at the rate of 20%. So they're trying to tell you that the market rate is 20% and we are paying 16%. Okay. The partnership deed does not contain any clause relating to payment of interest to any partner. This is the game changer sentence in this question, guys. See, when it comes to interest, not only should the 12% number come to your mind, but there's one more point, and that is the interest has to be authorized by the partnership deed. Only then the interest will be allowed for the partnership firm. But here the question says the partnership deed is silent about interest, which means a partnership deed is not authorizing the interest. So whether it is less than 12% or more than 12%, I don't care. The interest will not even be allowed in this case, because whether interest, whether salary, it has to be authorized by the partnership deed. Only then it will be allowed. Okay, we have to find the PGBP of the partnership firm. So let's get to work. If you look at the P&L account, we have salary to partners, but we know for a fact that we can't directly allow the salary as it is fully. We have to do the book profit computation. We have to find the allowable working partner salary. Then only we can, decide how much salary is to be allowed. So let's focus on that part first. Later we'll come to the PGBP computation. Okay, we'll do the answer in parts. My first part 1 will be book profit computation. Now first of all, tell me, what do you mean by book profit? Book profit is nothing but normal PGBP. Consider all PGBP adjustments, just that you should not debit salary to partners. If you have debited salary to partners, reverse the debit. So without debiting salary to partners, whatever is a PGBP, that is called as book profit. In this book profit calculation, should I consider business loss brought forward? No. In this book profit calculation, should I consider unabsorbed depreciation brought forward? Yes. You're aware of it. Okay. Come on. Let's work it out. So what's a net profit? Net profit given to us is 2,87,000. Gross profit, nothing to do. Rent received from let out property. This should go into IFHP head of income. So I have to remove it from my PGBP. How will I remove it from your P&L? How will you remove a credit? By debiting it. So you will subtract it. So rental income you will subtract. Amount is 3,60,000. Then come to the debit side. Rent paid, nothing to do. Salary to employees, nothing to do. General expenses, depreciation, nothing to do. What about interest to Tarish? Just now we saw the interest is interest on loan, but it is not authorized by the partnership deed. Therefore, it will not be allowed. So because it is not allowed, it should not be debited to the P&L, but it is debited. So how will you reverse a debit? By crediting it, you will add it back. So I'll add back interest, 3 lakhs. Then salary to Umesh, I'll add this also. Umesh is a partner. We are finding book profit. Book profit means we have to find PGBP without debiting salary to partners. But salary to partners is already debited. So how will you reverse a debit? By crediting it, by adding it back. Okay. And so therefore, what is your number as of now? As of now, it is 8,67,000. What are we computing? Book profit. What is book profit? Normal PGBP. Just like how we compute PGBP, that's how I'm computing. Just that salary should not be debited. Salary to partners. But it was debited. So I reversed the debit. I added it back. Then, in book profit calculation, do you consider business loss brought forward also? No. Because it is set off and carry forward chapter adjustment. It is not PGBP adjustment. But tell me, in my book profit calculation, will I consider unabsorbed depreciation? Yes, unabsorbed depreciation is a PGBP adjustment. But you remember even the question which we did earlier, I have unabsorbed depreciation of 40,000. Will I straight away blindly adjust it? No. Do you remember we do one side calculation over here to check how much unabsorbed depreciation we are allowed to adjust? So we will do that over here. Look, do the computation. Book profit before unabsorbed depreciation 8,67,000. We will first adjust business loss brought forward, which is 20,000. So we still have 8,47,000 profit left. Now we will adjust our unabsorbed depreciation brought forward. It is 40,000. We are allowed to adjust it fully. So are you understanding? Why did we do this calculation? This is just one side calculation to check how much unabsorbed depreciation we are allowed to adjust. So unabsorbed depreciation that can be adjusted. So I'm doing this calculation only to find how much is the unabsorbed depreciation which I'm allowed to adjust. How much am I allowed to adjust? Full 40,000 I'm allowed to adjust. My profit is enough to absorb the whole unabsorbed depreciation. So this entire 40,000 unabsorbed depreciation I'll adjust. So now tell me, what's a book profit? 8,27,000. This is the book profit of your SSE. See, I'll show you. This is very similar to question number 27, which we had worked out some sessions earlier. Even in question number 27, to compute book profit, okay, we subtracted unabsorbed depreciation brought forward, but we did not subtract it directly. We first did one side calculation over here. We found how much unabsorbed depreciation we can adjust. Why do we do the side calculation? Because we are supposed to adjust business loss brought forward first, then only we can adjust unabsorbed depreciation. We have a sequence. Why that sequence? Because business loss has a life of only 8 years, but unabsorbed depreciation has indefinite life. So that is why we are always supposed to adjust brought forward loss first, then only unabsorbed depreciation. So we do the side calculation and we see how much unabsorbed depreciation it is possible for us to adjust. That much only we will adjust over here. Same thing I did even over here, guys. While computing book profit, I am supposed to adjust unabsorbed depreciation, but I did not directly subtract. I did one side calculation over here. I found how much unabsorbed depreciation I am allowed to adjust. That much only I will adjust over here. So I have my book profit number now. My book profit number is 8,27,000. Okay, now comes my part 2. So in my part 2, I am going to find the maximum allowable working partner salary. Now, how much working partner salary is allowable, that will fully depend upon the book profit, guys. So, what's the book profit of your firm? We just computed. Book profit is 8,27,000. Just a moment. Yeah. So book profit is 8,27,000. I will split this book profit into two parts, guys. The first 6 lakhs of your book profit, and then the balance book profit. What will be your balance? After 6 lakh, balance will be 2,27,000. On the first 6 lakhs, how do you calculate? On the first 6 lakhs, 90% of 6 lakhs or 3 lakhs, whichever is higher. So 90% of 6 lakh will be 5 lakh 40. So 5 lakh 40 or 3 lakhs, which is higher? Clearly 5 lakh 40 will be higher. Then on this balance book profit, how will you calculate? Whatever is the balance book profit on that 60%. So 2,27,000 into 60%, which will work out to 1,36,200. So what is the maximum allowable working partner salary now? Both put together will be how much? 6,76,200. This is going to be your maximum allowable working partner salary. Okay, so the maximum allowable working partner salary is 6,76,200. But what is the actual salary? How much salary are we actually paying to the working partners over here? Salary to Umesh, 6,40,000 we are paying. So the salary which we are paying is well within the limit, guys. It is within 676,200. So how much salary is going to be allowed in our computation of PGBP? 6,40,000 will be fully allowed, right? Because it is well within the limit of 676,200. So what and all have we done? We computed the book profit. We found the maximum allowable working partner salary. Now we'll do the third part, the last part. They asked us to find PGBP of this firm, right? Let's find the PGBP. How to find the PGBP? We had already learned this format in that earlier session when we did question number 27. There itself we had learned this format. Same thing I copied from there. We will see what is a book profit before unabsorbed depreciation. Book profit before unabsorbed depreciation is 8,67,000. Then from this we will adjust salary which is allowed under 40B. How much salary will be allowed? We just did the computation, 6,40,000. Okay. Then we will adjust business loss brought forward. What's our business loss brought forward? 20,000 rupees. And finally, we will adjust our unabsorbed depreciation brought forward, 40,000 rupees. So what is the PGBP of your assessee? The PGBP will be 1,67,000. Alright, so some of you might have forgotten all this a little bit because it's been quite some time since we did question number 27. This was like a much needed reminder for us. First, we computed book profit. In book profit computation, we should not subtract salary. But salary was already debited. So we reversed the debit by adding it back. And we are supposed to adjust unabsorbed depreciation. But we can't directly adjust the entire unabsorbed depreciation. We should do one side working. We should check how much unabsorbed depreciation we are allowed to adjust. That much only we are allowed to adjust. Okay. Then after that we did the maximum allowable working partner salary computation on the basis of book profit. Then we did PGBP. So for the firm, how to compute PGBP? We'll see what is a book profit. We will subtract salary under section 40B. We will subtract business loss brought forward. We will subtract unabsorbed depreciation brought forward, and that's how we get our PGBP number. Got it? This was your question number 37. Now come on, let's move on to our next question, question number 39. Question number 39 is again a full-fledged PGBP question. The same question is there in the CA Inter study material also. And for CMA students, this is an examination question, the June 23 examination question. It's a very good question, guys. It's a combination of presumptive taxation and the usual PGBP computation. Let's read the question. Mr. Shivam, a retail trader of Cochin, gives the following trading and P&L account for the year ended 31st March 26. So, the trading and P&L account they have given to us over here. I have the net profit number. Then they've given us a lot of adjustments. What are they asking us? Compute the profits and gains of Mr. Shivam under presumptive taxation 44 AD and profits and gains as per the regular provisions. Which means they're asking us to find PGBP as per 44 AD also, as per the regular computation also. Assuming he has exercised the option of shifting out of the default regime. He's shifting out of the default regime means he is not following the default regime. He is not following the new regime. We have to do the entire computation as per the old regime. Okay. Assume whole of the turnover received by account payee check or electronic clearance system through bank account. So we have to compute PGBP as per 44AD also, as per normal computation also, both. So let's do that, guys. Let's finish off PGBP as per 44AD first. See, we can't blindly apply 44AD. We first have to check the conditions. Do you remember? We have already seen the conditions. 4 conditions I had taught you. The first condition is that assessee must be a resident, individual or HUF or partnership firm. Assessee is an individual. Assessee is Mr. Shivam. Assessee is an individual. I'll assume he's a resident. Then condition number 2, assessee must be carrying on a business, but this should not be the business of plying, hiring, leasing, goods carriage. Also, it should not be agency business. Yes, guys, it is not plying, hiring, leasing, goods carriages. It is not agency business also. He is a retail trader. So even this condition is fulfilled. Then condition number 3, he must not be enjoying 10AA. He must not be enjoying Chapter 6A Part C. We'll assume this condition is fulfilled. Condition number 4 is that turnover of the assessee should be either within 2 crore or within 3 crore depending upon the case. Here if you see, turnover of the assessee is 1 crore 12 lakh 11,500. See, generally what happens is, turnover should be within 2 crore if the cash receipt is more than 5% of the turnover. But if cash receipt is within 5% of the turnover, then the turnover has to be within 3 crore. So we have 2 criteria. But here I don't care whether the cash receipt is more than 5% or less than 5%. I don't care because the turnover is only 1 crore around. It is 1 crore around, which means it is within 2 crore also. It is within 3 crore also. So whatever be the turnover limit, my turnover is within the limit. So all my conditions are fulfilled. Therefore 44AD will apply. So under 44AD, how do you compute PGBP? Remember, we will see what is the turnover of the assessee. Out of the turnover, we will see how much has been realized in specified mode within 139 one date, 6% of that, and whatever is our balance turnover, 8% of that. In this question, if you see, the question says clearly, whole turnover is received by account payee check or electronic clearance system. So entire turnover we have received by specified mode. So whatever is the turnover, 6% will be your PGBP. So my turnover is 1 crore 12 lakh 11,500. This into 6% will become your PGBP. So this will work out to 6 lakh 72,690. So if your assessee follows 44AD, then the PGBP of your assessee under section 44AD will be 670 to 690. And one more thing, if assessee actually follows presumptive taxation like this, if assessee declares PGBP to be so much, then in that case assessee will enjoy some benefits. Do you recall the benefits of the section? 3 benefits you have. Benefit number 1, assessee need not maintain books of accounts under 44AA, not required. Then assessee need not get tax audit done. Section 44AB tax audit is not required for the assessee. Then third benefit, advance tax. 100% advance tax assessee will still have to pay, but entire advance tax has to be paid only in the last installment. So 3 benefits your assessee will be having. Okay, so this is the first part of my answer. PGBP as per 44AD. So if assessee follows 44AD, PGBP will be 670 to 690 and all these benefits assessee can enjoy. Now come on, let's move on to the second part of the answer. They also asked us to compute regular PGBP. Now to compute regular PGBP, I have the net profit number with me. Therefore to compute PGBP, I will use the indirect method, that is the 5-step approach. We will start with net profit as per P&L. We will add expenses debited but not allowed. We will add incomes not credited but taxable. We will subtract expenses not debited but allowed, and we will subtract incomes credited but not taxable. Okay, let's begin. So looking at the credit side first, sales, closing stock, nothing to do. Gross profit, nothing to do. What about income from UTI? This has to go into your IFOS head of income. So how will you remove it from your P&L? How will you remove a credit? By debiting it. We'll subtract it. So less incomes, it is credited but it is not taxable. Under this we have income from UTI. Income from UTI, what is the amount? 2,400 rupees. I am removing this from my PGBP. Now come to the debit side, opening stock, purchases, gross profit, nothing to do. Salary, rent and rates, interest on loan, depreciation, printing and stationery, postage and telegram, nothing to do. What about loss on sale of shares? short-term loss on sale of shares, this is going to be your capital loss. This is not relating to my business or profession. So therefore, this has to be removed from my PGBP. How will you remove a debit? By crediting it, you will add it back. So add expenses debited but not allowed. Loss on sale of shares. What is the amount? 8,100 rupees. Okay, this is also done. Then other expenses 7,060, net profit 50,000. Make a note of your net profit number, 50,000 rupees. Okay, then there are some more information given to us. 6 adjustments are given to us. It was found that some stocks were omitted to be included in both opening stock and closing stock. Tell me first of all, is this overvaluation or is this undervaluation of opening stock? The question says stocks were omitted to be included, which means some amounts we did not put in the stock numbers. So whatever stock numbers we have are lesser numbers. Some amounts we forgot to put. So it is undervaluation of stock. It is undervaluation of closing stock, undervaluation of opening stock. Do you remember the tip I had given you? I'll draw the table for you. I had told you, you simply have to follow one table for undervaluation or overvaluation of stock. Overvaluation, undervaluation. Opening stock, closing stock. Remember? Add. So opening stock overvalued, I will add. So everything else will be ulta pulta. Yes guys, this is how my table will be. This is a case of undervaluation. Undervaluation of opening stock, undervaluation of closing stock. So undervaluation of opening stock I'm going to subtract. Undervaluation of closing stock I'm going to add. So I'll add undervaluation of closing stock and I'll subtract undervaluation of opening stock. What is the amount? See, they have given us a difference already. How much stock we did not put into the trading and P&L? Opening stock 9,000 rupees and closing stock was 18,000 rupees. Okay. Then comes the second adjustment. Salary includes 10,000 paid to brother, which is unreasonable to the extent of 2,000. Which section comes to your mind? Come on, tell me. We've already learnt all this. Do you recall section 40A subsection 2? Here we had learnt 3 conditions. Condition number 1, assessee has incurred an expense relating to business or profession. Condition number 2, the expense happens to be excess or unreasonable. And condition number 3, the other party happens to be a relative. If all these conditions are fulfilled, then whatever is the excess portion alone will be disallowed. And do you remember the meaning of relative for this purpose? I had drawn one diagram for you. Plus, spouse, with arrows I had drawn for you. Here tell me, are the conditions fulfilled? We're talking about salary expense. So yes, it is an expense relating to assessee's business or profession. Is it excess or unreasonable? Check. The question says it is unreasonable to the extent of 2,000 rupees. So yes, it is excess. Then is the other party relative? Other party is brother. Brother and sister will also come under relatives. So all my conditions are fulfilled. Therefore, the excess of 2,000 rupees, this is going to be disallowed in our PGBP computation. So I'll disallow this. I'll add this back. So under section 40A subsection 2, the excess salary. See, we don't disallow the entire expense. No, we disallow only the excess portion. What is the excess? What is the unreasonable portion? 2,000. That alone we will disallow. Okay, then comes your third adjustment. The third adjustment says the whole amount of printing and stationery. Do you remember first of all we had printing and stationery expense? See here, we have printing and stationery expense of 23,200. This entire amount they are saying was paid in cash by way of one-time payment to Mr. Ramesh. What comes to your mind? Assessee has incurred an expense, printing and stationery expense. It is more than 10,000 rupees. In what mode assessee should pay? Specified mode assessee should pay. Assessee made the payment in cash. Gone guys. Entire expense will be disallowed. 23,200 will be disallowed. 40A subsection 3. Printing and stationery expense 23,200 fully I am disallowing. Why am I disallowing? Because the payment is made more than 10,000 rupees in non-specified mode. Okay. Then comes your fourth adjustment. This is all about depreciation. So basically we have to recompute the whole depreciation. So whatever depreciation is already debited in the P&L, I'll remove it. I'll freshly calculate depreciation and I'll allow it. Okay, so I'll add back the depreciation as per the P&L account, which is how much? 1,05,000. And then I'll open a working note. Let's call it working note number 1. Here we'll compute depreciation under section 32. Let's first of all carefully read and see what information they have given. This whole para is about depreciation only. So the depreciation provided in the P&L 1,05,000, which we have reversed already, is based on the following information. Opening balance of plant and machinery, that is WDV on 31st March 25 minus depreciation for 24-25 is 4,20,000. So this is the opening WDV on 1st April 25. They've already given us that. Then the question says a new plant falling under the same block of depreciation was bought on 1st July 25 for 70,000 rupees. So we already had opening WDV, then we purchased a new plant, and 2 old plants were sold on 1st October 25 for 50,000. So we already had opening WDV, then we purchased one new plant and we sold 2 old plants. So is my block empty? See, we sold a depreciable asset. That's the first question will come to our mind, right? That is the block empty or not? Block is not empty. I'm still having my new plant and machinery with me in the block, because the question says only 2 old plants were sold. So my new plant is still there in the block. So my block is not empty. So because my block is not empty, I will first try for depreciation. Only if depreciation is not possible, only then I'll have STCG. Okay, so come on, let's begin. So my very first step, our usual block computation, guys. We will start with opening WDV on 1st April 2025, which is 4,20,000 rupees. Then we will add actual cost of assets acquired. We have acquired one new plant and machinery over here. What is the value? See, we bought on 1st July 25 for 70,000 rupees. Now, by now, you know what I'm going to ask you next. Whenever a new asset enters into the block, we check how many things? 2 things. Thing number 1, was it put to use for at least 180 days? See, it was purchased on 1st July 25. Even if it is put to use on the same day, definitely it's put to use for at least 180 days. Then tell me, will I get additional depreciation over here? My assessee is following old regime. This is plant and machinery, but is your assessee a manufacturer? No, guys. In this question, assessee is a trader. He is not a manufacturer. Therefore, no additional depreciation and all. Okay. Then we will subtract monies receivable for assets sold. Yes, we have sold over here. We have sold 2 old plants. The question is saying, what is the selling price? For how much did we sell? 2 old plants were sold for 50,000 rupees. Okay. So what is your closing WDV on 31st March 2026 now? It's going to be 4,40,000 rupees. Okay. Now this WDV number we split into how many parts? 3 parts. Number 1, closing WDV which is put to use for 0 days. Number 2, closing WDV which is put to use for less than 180 days. And number 3, your balance WDV. Now if you see, you know very well, the 0 days and less than 180 days, both you will get to know from the new assets. Now in the new assets, do you have anything which was put to use for 0 days? Do you have anything which was put to use for less than 180 days? No. So your entire WDV will come under balance WDV, 4,40,000. Now come on this you compute the normal depreciation first. 4,40,000 into 15%. Why 15%? Plant and machinery block, guys. 15% only it will be. So this is going to be 66,000. No additional depreciation we already concluded. So what's the total depreciation? 66,000. So what's your opening WDV for the next year? Opening WDV for the next year will be 3,74,000. Now listen to me. Carefully tell me which number will you take into your PGBP computation now. 66,000. This is the depreciation number. This is the biggest blunder that students make, guys. They'll do the whole block computation and this final 3,74,000 number, this is what they will take into the main answer. No, this 3,74,000 is what? Opening WDV. What is depreciation? 66,000. It is 66,000 that should enter into your PGBP computation. Okay. So expense is not debited but allowed. Under this depreciation under section 32, give reference to working note number 1. 66,000 is your depreciation. Okay, then comes your fifth adjustment. Rent and rates includes GST liability 3,400 paid on 7th April 2026. So we have rent and rates over here, right? 36,000. They are saying this includes 3,400 which is paid on 7th April 26. Which section are they expecting us to apply? See, in case you get confused, no, I will give you one small tip over here. When it comes to PGBP, if they talk about the mode of payment, like for example, if they say that payment is made in cash or payment is made in specified mode, when they talk about mode of payment, you will think about 40A subsection 3, guys. 40A subsection 3 says more than 10,000. If you make payment of expense, make the payment in specified mode only, otherwise it will be disallowed. So you will think about that one. Then if the question talks about excess payment or unreasonable payment of expense and all, there you will think about 40A subsection 2. This section right here, the other party is a relative, excess expense, the excess will be disallowed. Then if the question says a TDS is deducted or not remitted and all, then you will think about 40A1 and 40A1A. Remember these two sections? We had seen these earlier. In 40A1, 100% of the expense will be disallowed. In 40A1A, only 30% will be disallowed. Tax is deducted, not deducted, remitted, not remitted. You will think about these sections. And finally, when they talk about the date of payment, when they say when the assessee made the payment, then you will think about 43B. Because what does 43B say? 43B says you should make the payment within 139 date. So now tell me, in this question they are saying that rent and rates includes GST liability which was paid on 7th April. These are like your golden rules of PGBP. They're talking about the date of payment. I will think about 43B. Now tell me, what does 43B say? 43B says if you have to pay any tax, any duty, any cess or fee, 43B will apply. 43B says these expenses, payment has to be made within 139 date. Payment has to be made within your ITR return filing due date. Okay. If you make the payment within this 139 date, great. It will be allowed for you. If you don't make the payment within 139 date, gone. It will be disallowed for you. But don't worry, later whenever you make the payment, in that year it will be allowed for you. Okay, this is 43B. Now tell me, what are the possible 139 dates? What are the possible ITR dates? In our examination, it will either be 31st July 26 or 31st October 26 or 30th November 26. It will be one of these three dates, guys. Now in this question, tell me, when did you make the payment? Assessee made the payment on 7th April 26. So do you agree? Whatever be the 139 date, whatever be the due date for filing return, assessee has made the payment before the due dates. Due dates will start only in July. Assessee made the payment in April itself. So has your assessee made the payment within 139 date? Yes, guys. So therefore it will be allowed and it's already debited in the P&L account. Rent and rates is already debited in the P&L account. Nothing is left for me to do. Getting the point? So nothing is to be done over here. Everybody clear? GST liability. We're talking about GST liability. GST will come under tax. 43B will apply. We have to make payment within 139 date and we made payment within 139 date. Therefore, it should be allowed. And it is already debited in the P&L. There's nothing left for me to do. Okay, and then we have one final adjustment. The question says, other general expenses includes 2,000 paid as donation to public charitable trust. Donation to a trust. It is not a business expense, guys, but it is debited to the P&L. How will you reverse a debit? By crediting it, add it back. So add expenses debited but not allowed. Donation, why are you adding it? Because it is not a business expense. The amount is 2,000 rupees. So now come on, that's it. Add and subtract and give me the net PGBP number of your assessee. You will get 1,30,900, guys. Okay, now see. Let's make a final summary now. So if assessee follows 44AD, as per 44AD, what is a PGBP of the assessee? We calculated already. 6,72,690. 6,72,690. But however, if assessee does not follow 44AD, then what is the PGBP of the assessee? 1,30,900. Of course, which is better, guys? Of course, where is the PGBP lesser? If assessee does not follow 4480, of course, this is better because your PGBP will be much lesser. But consequence will apply. Presumptive taxation is mandatory for you. If presumptive taxation is applicable, but if you don't apply, then in that case, you will have to suffer from consequences. 4 consequences. Consequence number 1, you will have to maintain books of accounts under 44AA. Consequence number 2, you will have to get the books of accounts audited under 44AB. Of course, both these consequences will apply only if total income is more than basic exemption limit. Then consequence number 3, advance tax you will have to pay in all 4 installments. And consequence number 4 is 44AD subsection 4, because of which next 5 years you will become ineligible for 44AD. So my final conclusion is, if assessee follows 44AD, no doubt assessee will get benefits, like no need to maintain books, no need to get them audited. Assessee will get benefits, but PGBP will be higher. PGBP will be lesser only if assessee does not follow 44AD. But in that case, assessee will have to suffer from consequences. So assessee is advised to not follow 44AD, pay tax on just 13900 and bear the consequences. Got it, guys? This is your question number 39. Through this question, 44AD got very nicely revised for you once again. Now come on, let's begin with question number 40. Now question number 40 is again a presumptive taxation question. Let's read the question first. Mr. Aman, engaged in retail trade of stationery, has a turnover of 2 crore 99 lakhs for the financial year 25-26. Amount received in cash during the year is 13 lakh 50,000. This is how much he has received in cash. And balance he has received through prescribed electronic mode on or before the due date of filing return of income. So his turnover is 2 crore 99 lakhs. Out of this, how much has he received in cash? He has received 13 lakh 50,000 in cash. And the balance, they are saying, how much is the balance, by the way? 2 crore 99 lakh minus 13 lakh 50. The balance will be 2 crore 85 lakh 50,000. This balance we have received in specified mode within 139 1 date, the question says. Okay. His income from the business as per books of accounts is 14 lakh 50,000. So his PGBP as per the books, which means if you don't follow presumptive taxation, his normal PGBP computation will be how much? 14 lakh 50,000. Okay. This is as per chapter 4D PGBP. Then retail trade is the only source of income, which means apart from this business income, he is not having any other income. Assessment year 25-26, last year. So previous year 24-25, this was the first time when he declared his business income in accordance with provisions of presumptive taxation under 44AD. So 24-25 was the first time when he declared his PGBP as per 44AD. Now what are they asking us? Decide whether Mr. Aman is he eligible for presumptive determination of income or not. If so, determine his income from retail trade as per the applicable presumptive provisions. Indicate clearly the reasons for treatment of each item. A lot of irrelevant information they have given. They are asking us only 2 things. First, they are asking us, is he eligible for presumptive determination of income? Basically, is he eligible for presumptive taxation? In simple words, we have to check whether he is fulfilling the conditions or not. Then they are saying if he is fulfilling the conditions, then we have to determine his income from the retail trade as per presumptive provisions. So first we have to check whether he is eligible for presumptive taxation or not. Then if he is eligible, we have to compute his PGBP as per presumptive taxation. That's all what they are asking us. Let's finish what they are asking us first. Then a little extra discussion also I want to do with you. Okay. First of all, come on, let us check. Is he eligible for presumptive determination or not? Is he eligible or not? Section 44AD. How many conditions in section 44AD, guys? So, by the way, why am I thinking about 44AD? There are 3 presumptive taxation sections. We have 44AD, we have 44ADA, we have 44AE, We have 3 presumptive taxation sections now. Why am I thinking about 44AD only? Because 44AE applies if assessee is in the business of plying, hiring, leasing goods, carriages. Is he doing all that over here? No. 44ADA applies only if assessee is carrying on a specified profession. Is he doing that over here? No. 44AD applies if assessee is carrying on a business. Assessee is carrying on business, retail, trade of stationery. So 44AD will apply. Okay, so if you want to follow 44AD, 4 conditions you have to fulfill. Condition number 1, the assessee has to be a resident individual or HUF or partnership firm. Assessee is an individual, I'll assume he's a resident. Condition 1 is fulfilled. Then condition 2 is that assessee must be carrying on a business. It should not be plying, hiring, leasing goods, carriages. Also, it should not be agency business. Yes, guys, assessee is doing retail trade of stationery. He is not doing plying, hiring, leasing goods, carriages. He is not in agency business. Condition 2 is also fulfilled. Condition 3 says that he must not be enjoying 10 AA. He must also not be enjoying Chapter 6A Part C. We'll assume this is fulfilled. Now comes condition 4, the highlight of this question, the turnover of the assessee. The turnover has to be either within 2 crore or the turnover has to be within 3 crore. Now tell me, when will the 2 crore limit apply? If the cash receipt happens to be more than 5% of turnover, then the 2 crore limit will apply. But if the cash receipt is within 5% of the turnover, then the 3 crore limit will apply. Now check how much is a cash receipt. Is it within 5% or is it more than 5%? Let us check. Very simple. Tell me first of all, what's the turnover of your assessee? 2 crore 99 lakhs. Right? What is 5% of this turnover? 2 crore 99 lakh into 5% will be 14 lakh 95,000. What is the cash receipt of the assessee? Out of the turnover, how much have we received in cash? 13 lakh 50,000. Tell me, is your cash receipt within 5% of turnover? My cash receipt is 13 lakh 50,000. 5% of turnover is 14 lakh 95,000. Is my cash receipt within 5% of turnover? Yes, guys, 13 lakh 50 is within 14 lakh 95, which means my cash receipt is within 5% of turnover. If cash receipt is within 5% of turnover, what turnover limit will apply for you? 3 crore turnover limit will apply for you. 2 crore turnover limit will not apply for you. This is the most interesting part of the question. You got a grip over it. My turnover is 2 crore 99 lakhs. 5% of that turnover is 14 lakh 95,000. My cash receipt is only 13 lakh 50,000, which is within 14 lakh 95,000. So therefore my cash receipt is within 5% of turnover. So therefore turnover has to be within 3 crore. Is it within 3 crore? Our turnover is 2 crore 99 lakh. It is within 3 crore. So all my conditions are fulfilled. Therefore, yes, my assessee is eligible for presumptive taxation under section 44AD. This is the first question that they had asked us, that whether our assessee is eligible or not. My answer is yes, he is eligible. Okay, this was the first part of my question. Then second part of the question, they also asked us that if he is eligible, we have to compute his PGBP as per presumptive taxation. So under 44AD, how will you compute PGBP? Multiple times we have seen this by now. By now you're comfortable. I will see what is the turnover of the assessee. Out of this turnover, I will see how much has been realized in specified mode within 139 date. Right? Of this turnover, 6% will be your PGBP. Then whatever is the balance turnover, I don't care whether it is received, whether it is not received, in which mode it is received, I don't care. Whatever is the balance turnover, this into 8% will be your PGBP. So our turnover is how much? 2 crore 99 lakhs. And out of this, how much is received in specified mode? See, we've already done the calculation. How much is received in specified mode? 2 crore 85 lakh 50,000. And my balance turnover is 13 lakh 50,000. Now come on, find the PGBP as per 44AD. So 2 crore 85 lakh 50,000 into 6%. This is going to be 17 lakh 13,000. Then 13 lakh 50,000 into 8%, this is 1 lakh 8,000. So your total PGBP as per 44AD, total PGBP will be 18,21,000. So if you look at the question, these were the only two things they had asked us. They had first asked us whether assessee is eligible for 44AD or not. For that, we concluded that yes, assessee is eligible. Then they asked us what is a PGBP as per 44AD. That we have computed, it is 18,21,000. So as per this examination question, this much only is the answer. But see, they have not tested in this question, but there is some more information given to us in the question for which they can test in the examination. So some extra discussion I want to do with you now relating to the same question, question number 40. Just a few extra points, but I'm telling you again and again, exam point of view, our answer is over here. Alright, now see. Sometimes in the same question they can ask us which is better. Basically, if I do the PGBP without 44AD, as per the books, what is the PGBP as per books? Remember, it was given to us 14,50,000. And what is a PGBP as per 44AD that we just computed? We computed how much? 18,21,000. So PGBP as per 44AD is 18,21,000. So they can ask us which is better. Of course, which is better, guys. Where is PGBP lesser? PGBP as per books is lesser. So of course, this is better. So, but however, if 44AD is applicable, but if assessee does not follow 44AD, if assessee declares PGBP, which is not as per 44AD, then in that case, consequences will come into the picture. No doubt, this is lesser. 14,50,000 is lesser than 18,21,000. So, of course, we will suggest the assessee 14,50,000, but consequences will come into the picture. What are the consequences? First consequence, assessee, you will have to maintain books of accounts under 44AA mandatorily. Consequence number 2, you will have to get the books of accounts audited under 44AB. Both of these will apply only if total income is more than basic exemption limit. The question says assessee does not have any other income. So total income will be 14,50,000, which is more than basic exemption limit. So assessee, you have to maintain books of accounts. You have to get the books of accounts audited. Then the third consequence, advance tax you will have to pay. In the usual 4 installments you will have to pay. Then comes the fourth consequence. This is what I want to talk to you about. 44AD subsection 4. Every time I have discussed 44AD subsection 4 only orally with you. But this time I want to compute and show you. What does 44AD subsection 4 say? 44AD subsection 4 says, listen carefully, once you apply 44AD, next 5 years you have to follow 44AD. In this question it is mentioned, see we even made a note over here, it was given that first time we applied 44AD in 24-25. So, once in previous year 24-25 we applied 44AD. Now, next 5 years means what? Previous year 25-26, 26-27, 27-28, 28-29, 29-30. In these 5 years, assessee, you don't have an option. You have to follow 44AD. But however, my current year is 25-26. In 25-26, assessee is not following 44AD. Assessee wants to declare PGBP as per books because it is lesser than 18,21,000. So in 25-26, in my current year, assessee is not following 44AD. So now 44AD subsection 4 will come into the picture. If this happens, see, once you follow 44AD, next 5 years you have to follow 44AD. In these next 5 years, even 1 year, if you don't follow 44AD, then the next 5 years means what? 26-27, 27-28, 28-29, 29-30 and 30-31. These 5 years now you will become ineligible for 44AD. Which means in these 5 years now, even if you want to enjoy 44AD, you can't enjoy. Getting my point? This is 44AD subsection 4. So 44AD subsection 4 says, once you follow 44AD, next 5 years, you have to follow 44AD. But in my case, in 25-26, we are not following 44AD, we are doing a violation. So when that violation happens, now next 5 years, you will become ineligible for 44AD. Okay, so they did not ask us all this in this question. I'm just showing it to you that by chance they decide to test this, you must be ready. So first of all, which is better for us over here? Definitely PGBP as per books is better because it is lesser than 18,21,000. But if you declare PGBP as per books, that is, if 44AD is applicable for you, but still if you declare PGBP as per books, then consequences will come into the picture. 4 consequences you will have. You will have to maintain books of accounts. You will have to get the books of accounts accounts audited, then advance tax you will have to pay in usual 4 installments and 44AD subsection 4. Because of 44AD subsection 4, now next 5 years assessee will become ineligible for 44AD. Got it? This was your question number 40, guys. This was another question on presumptive taxation. Alright, can I close this? Can I take you to question number 41 now? Question number 41 is also an examination question, June 25 examination question, a full-fledged PGBP question, guys. Let's read the question and then we will work it out. Question number 41. So what does the question say? Mr. Ayush aged 50 years. So I'll conclude at this stage that Mr. Ayush, you are not a senior citizen. He's only 50 years. He's a retail trader of Patna, Bihar. He furnished his P&L account. P&L account they have given to us. Net profit number also we have. They've given us 5 adjustments. Then the question says, assuming Mr. Ayush exercises the option of shifting out of the default regime. He's shifting out of the default regime, which means he does not want to follow the default regime. He does not want to follow the new regime, which means my computation will be as per the old regime, guys. He's following the old regime. So assuming Mr. Ayush exercises the option of shifting out of the default regime provided under 115 BSE, indicate clearly the reasons for treatment of each item. One more thing over here. Calculate income chargeable to tax under PGBP. So they're not asking us to find total income and all. We just have to find PGBP of the assessee. Let's begin. That too we have to compute as per the old regime only. Okay. So I'll bring my format. So what is the situation here? We're doing PGBP computation as per the old regime. Now to compute PGBP, which method will I follow? See, they have given us a net profit number. So therefore, we will follow our indirect method, our 5 steps. That is, we will start with net profit as per P&L. We will add expenses which are debited but not allowed. We will add incomes which are not credited but taxable. We will subtract expenses which are not debited but allowed. And finally, we will subtract incomes which are credited but not taxable. Okay, slowly, carefully, let's have a look at the P&L account first. We always look at the credit side first, guys. Only PGBP they are asking us. Total income and all they are not asking us. Gross profit, nothing to do. What about dividend? Dividend always goes into IFOS head. So how will I remove this from my P&L? How will you remove a credit? By debiting it. Subtract it, that's all. So, less incomes credited but not taxable under this dividend income. What is the amount? 15,000 rupees. Okay, then agricultural income. Now, agricultural income will be exempt. So, it is not taxable income. So, you have to remove this. It is an exempt income. So, how will you remove it from your P&L? How will you remove a credit? By debiting it, subtract it. So, agricultural income, 1,85,000. Okay. Then winning from lotteries, net of TDS. Lottery winnings will go into IFOS head. So, I have to remove this from my P&L. How will you remove a credit? Same thing, by debiting it, you will subtract it. So, lottery winnings, 10,500. Okay, now come to the debit side. Rent and rates, nothing to do. Salary to staff, interest expense, admin expense, general expense, depreciation, nothing to do. What's the net profit number? 445,100. Okay, now come to the other information. Following additional information is furnished. Rent and rates includes GST liability of 5,600 paid on 5th April 2026. Now tell me which concept comes to your mind. They're talking about the date of payment. Rent and rates includes GST liability 5,600 paid on 5th April 26. Just sometime back in this session only, remember, I gave you some 4 to 5 tips with respect to your PGBP computation. I told you when they talk about date of payment, they're talking about the date of payment over here, right? When they talk about the date of payment, I should think about section 43B. So come on, let's think about 43B. What does 43B say? If you have to pay any tax or duty or cess or fee, you must make the payment within 139 date, only then it will be allowed. If you make the payment late, For now, I will disallow. Later, whenever you make the payment, in that year, I will allow. Now, in this question, if you see, assessee is talking about GST liability, which is tax, guys. So, what are the possible 139(1) dates in this question? It will either be 31st July 26 or 31st October 26 or 30th November 26. Only 3 139(1) dates are possible. But when did we make the payment? On 5th April 26. So do you agree that whatever be the 139(1) date, we have made the payment before 139(1) date. So we made the payment before 139(1) date. So therefore the expense will be allowed for us. We made the payment in April itself. Within 139(1) date we made the payment. It will be allowed for us. It's already debited. The question says rent and rates includes GST liability. So it's already debited. It is allowed. There's nothing left for me to do over here. Okay, then the question says salary includes 12,000 rupees paid as commission to brother of Mr. Ayush. The commission amount at market rate is 10,000. So market rate is 10,000. We are paying 12,000. So it is excess by 2,000. Now again, think about the golden tips which I have given you with respect to your PGBP head. Which section is coming to your mind? When the question talks about excess or unreasonable, what comes to your mind? Excess or unreasonable? I will think about 40A subsection 2, guys. My 3 conditions. Come on, tell me. What does 40A subsection 2 say? 40A subsection 2 says, assessee has incurred an expense relating to business or profession. This expense is excess or unreasonable and the other party happens to be a relative. If all these conditions are fulfilled, then whatever is the excess portion, the excess is going to be disallowed, right? And who is relative for this purpose? Plus spouse with arrows. This is what I taught you. Check the conditions. First of all, commission expense, condition 1 fulfilled. Is it excess? Yes, it is excess by 2,000 rupees. Second condition fulfilled. Then is the other party relative? Brother, guys. Is brother coming in this relative definition? Yes, brother and sister is coming in the relative definition. All my 3 conditions are fulfilled. Therefore, the excess portion will be disallowed. What is the excess? The excess of 2,000 will be disallowed. See, are you noticing? I'm not blindly taking 2,000 and I'm disallowing. I'm checking my conditions. This is what you will do in the examination. No skipping steps in the examination. You will sing the song every time. Why? Because what if the relative is not coming in this bucket? Then there should be no disallowance. What if it is not expense? What if it is income? Then also no disallowance. So please, no overconfidence in the examination. Check the conditions. Only if all the conditions are fulfilled, only then disallow. So we've checked everything is fulfilled. So under section 40A subsection 2, what is the excess portion? 2,000. That is what we will disallow. Okay, this is your second adjustment. Then come to the third adjustment. Admin charges include 30,000 rupees towards medical expense for employees due to a fire accident in business purpose. 30,000 rupees medical expense for employees. Anything we do for employees, it is connected to business or profession only. So allowed, already debited in the P&L, nothing left for me to do. Then general expense includes 1,500 penalty paid to GST department for non-compliance of GST provisions. Penalty for breach of law. Penalty is not allowed. So penalty relating to GST. How much is the amount? 1,500. I'll disallow. I'll add it back. Also includes 2,500 donation paid to public charitable trust. Donation paid to a trust. It's not a business expense. I will disallow. Donation how much? 2,500. Fourth adjustment. Then comes the fifth adjustment. The total depreciation provided in P&L account 1,12,500 was based on the following information. So basically we have to recalculate depreciation. So whatever depreciation is debited to the P&L, let's reverse and then we will recalculate it all over again. So depreciation as per P&L account, it's how much? 1,12,500. And then we'll open a working note. Working note number 1 for depreciation. So what's your opening WDV? Let's read the adjustment. Opening WDV of the plant and machinery block on 1st April 25 was 4,35,000. Then a new plant falling under the same block of depreciation, 15%, was bought on 1st July 25 for 85,000 rupees. So we purchased a new asset. One old plant was sold on 10th October 25 for 52,500. Very similar to the last question we worked out. So my block is not empty. So first I will try for depreciation. Only if depreciation is not possible, we'll have STCG. So opening WDV, then add actual cost of assets acquired. We have acquired a new plant. We've acquired a new plant for how much? For 85,000 rupees. So we always check for two things. Number one, was it put to use for at least 180 days? Question says 1st July 25. Definitely put to use for at least 180 days. Then assessee is a trader. He is not a manufacturer, so no additional depreciation. Then less money is receivable for assets sold. We have sold one old plant, sold for 52,500 rupees. So now what's your closing WDV on 31st March 2026? Closing WDV will be 4,67,500. Okay. Now we start computing our depreciation. We will first split our WDV into two parts. WDV put to use for 0 days, WDV put to use for less than 180 days, and balance WDV. We know very well that we get 0 days and less than 180 days from new assets. In new assets, we don't have anything for 0 days or less than 180 days. Entire WDV will come under balance WDV. So your depreciation will be 467,500 into 15%, which will be 70,125. This is your depreciation. So what's your opening WDV for the next year? Opening WDV for the next year will be 3,97,375. Now be careful, what is the silly mistake possible? You should not take this number to the main answer. No. What's your depreciation number? Depreciation is 70,125. This is what will go into your main answer. So expense not debited but allowed. Depreciation under section 32. Give reference to working note number 1. 70,125. That's all guys. No other adjustment. So add and subtract and give me the net PGBP of this assessee. So the net PGBP will be 2,82,975. That is what they had asked us. They had asked us to find the PGBP. No, don't think about rounding off and all. We round off only a total income number. This is not total income. This is only the PGBP. Got it? We'll close this question. So I think it was very similar to the question that we had already worked out a little earlier. They were more or less repetitive adjustments, but it's an examination question, so we had to work it out. Alright, can I close this question and can we come to question number 42 now? Now before we start question number 42, let me give you a quick reminder of the provision which is involved over here. See, in a partnership firm, whenever there is a change in constitution, for example, if there is retirement of a partner, okay, then in that case, we will see what is a business loss brought forward in the firm. Now, in this business loss brought forward, we will see what is the share of the retiring partner. Okay, so in the business loss brought forward, whatever is a share of the retiring partner, this you will ignore. You cannot adjust this, you will ignore. So if my partnership firm, if there's a change in the constitution of the partnership firm, like for example, if the partner is retiring, then the retiring partner's share in the brought forward business losses cannot be carried forward, cannot be adjusted, it has to be ignored. But will you apply the same point even to unabsorbed depreciation brought forward? No. This point is applicable only to business loss brought forward. Understanding? So one last time repeating, in case as a partnership firm, and if a partner retires over here, then whatever is this retiring partner's share in the brought forward business losses, that to that extent, you can't adjust the loss, you'll have to ignore the loss. Okay, keep this in your mind and come to the question. One last question for this session. The question says P, Q and R are partners in a firm sharing profits and losses in the ratio 1:1:2. Provide the following information. They're saying find firm's net income. They're asking you to find the firm's net income, assuming salary and interest are not paid to partners. So this firm is not paying salary to partners. It does not pay interest to partners. We have to find this firm's net income. This firm has 3 partners. Profit sharing ratio is 1:1:2. Net income of the firm in assessment at 25-26. which is previous at 24-25. So last year, the income of the firm is a loss of 1,20,000, out of which unadjusted depreciation is 40,000. So in previous year 24-25, the last year basically, my business loss is how much and my unabsorbed depreciation is how much. Unabsorbed depreciation, they are saying it is 40,000 rupees, and the total net income is 1,20,000 negative, which includes unabsorbed depreciation of 40,000. So business loss will be the balance 80. Total loss is 1,20,000. In that, unabsorbed depreciation is 40. So my business loss will be the balance 80. This is last year's information. Okay. Then current year, 31st May 2025, R retires from the firm and other partners carry on the same business. So partner R, he is leaving the firm. Okay, when? On 31st May 25. So April, May, 2 months he was a part of the firm. After 2 months, 31st May, he left the firm. Firm's income for assessment at 26-27. Current year's income of the firm before adjusting these losses and depreciation is 1,20,000. So previous year 25-26, before adjusting the loss and the depreciation, this firm's income is 1,20,000. We have to find the net income of the firm. Okay, we'll go step by step. My first part will be, part 1 will be to find what is partner R's share in profits of the current year, that is previous year 25-26. See, what's the total profit of the current year? 1,20,000. Now R was a partner only for 2 months, April and May. So 1,20,000 is the entire year's profit. I want 2 months profit. So into 2 by 12 I will do. Then our profit sharing ratio, if you see, it is 1:1:2. So R's profit sharing ratio will be 2 by 4. So 1,20,000 into 2 by 12. This will give me 2 months profit. Now in that 2 months profit, R's share is 2 by 4. So how much will this work out to? 1,20,000 into 2 by 12 into 2 by 4. This is going to be 10,000 rupees. So this is R's share in the current year profits. Okay, this is the first part of my answer. Then comes part 2. So in part 2, I want to know what is R's share in brought forward loss of previous year 24-25. Basically, last year in 24-25, we have a loss of 80,000. In that, what is R's share? So 80,000 into 2 by 4. This will be R's share. That's going to be 40,000 rupees. Okay, so this is his share in the loss and this is his share in current year's income. So now comes my part 3. Tell me, what is R's net share of brought forward loss? Net share. See, his brought forward loss share, his share in previous year 24-25's brought forward loss will be what we calculated, 40,000 rupees. But he has a share in current year income. His share in 25-26 is business income, that is 10,000 rupees. So what is his net share of the brought forward loss? His net share in the brought forward loss is 30,000 rupees. You understood what I did? I first found what is his share in 25-26 current year's profits. Then I found out what is his share in the brought forward losses. So I can adjust the brought forward loss against the business income, right? So if I adjust the business income against the brought forward loss, what is his net share in the brought forward loss? His net share in the brought forward loss is 30,000 rupees. Okay. Now focus very carefully. So to the extent of his share in the loss, to this extent we will ignore the loss. So how much is the brought forward loss? Actually 80,000, but in that 80,000 we will ignore 30,000 and the balance 50,000 only we will be able to adjust. Okay, now comes part 4, our final part. They asked us to find the net income of the firm. So net income of the partnership firm, if you see, what is previous year 25-26 is business income, current year business income is 1,20,000. From the income, we first adjust the brought forward business loss. The brought forward business loss is actually 80,000. But from this 80,000, we have to ignore the retiring partner's share in the loss. The retiring partner's net share in the loss is 30,000. I'll ignore that. So I'll be able to adjust only 50,000 rupees worth of loss, and then I'll adjust my brought forward unabsorbed depreciation, which is 40,000 rupees. So the net income of this firm will be 30,000 rupees. So basically, you are supposed to ignore the retiring partner's share in the brought forward business loss. But did we do the same thing even for brought forward unabsorbed depreciation? No. Only the retiring partner's share in the brought forward loss has to be ignored. Okay. How did we find the retiring partner's share? We saw what is his share in the current year profits. We saw what is his share in the brought forward losses. So when we netted them off, we found his net share in the brought forward loss. So to that extent, we ignored the loss. So 80,000 was a total brought forward loss. Out of that 80,000, we ignored this 30,000 and we considered only the balance 50,000. Okay, this was your question number 42. So with this, guys, we will close this session over here. We will meet again in our next session. Question number 43 onwards, we will take up in our next session. Hello champions, so let's begin our next session. In this session, we will take up question number 43 onwards in our PGBP chapter. Let's read the question. From the following particulars of Sri Sanju for the year ending 31st March 26, find out his business income. So they're not asking us to find his total income, we just have to find his PGBP. They've given us a P&L account, they have given us a net profit number, they have given us some 7 adjustments. Now, they did not tell us which regime assessee is following, but we know for a fact if nothing is mentioned, by default, the default regime is the new regime 115 PSE. Okay, keep that in your mind. We have to find the PGBP of the assessee. Now, how to find PGBP? I have the net profit number. So, because I have the net profit number, I will use the indirect method. That is, I will use my 5-step approach. I will start with net profit as per P&L account. I will add expenses debited but not allowed. I will add incomes not credited but taxable. I will subtract expenses not debited but allowed. And finally, I will subtract incomes credited but not taxable. Now let's begin. Let's start with our credit side first. Gross profit, nothing to do. Then recovery of bad debts disallowed in the earlier previous year. Now this is a very interesting adjustment in this question. Let me explain this to you. Listen to me. See, if I had incurred bad debts earlier, then only first of all, there's a question of bad debts recovered. Right? So bad debts recovered is possible only if earlier I have bad debts. So when I had incurred bad debts, okay, that time if you had allowed the bad debts for me in PGBP computation, then now when I recover the bad debts recovered will be taxable for us. Logical. So when I had incurred the bad debts, it was allowed for me. Then now when I recover the bad debts, it's an income for me. It should be taxable. But however, when I had incurred the bad debts, at that time, if the bad debts were not allowed for me, for whatever reason, like you know very well, bad debts will be allowed only if conditions are followed. The debt has to be relating to the business of the assessee. It should be connected to something which was earlier taxed as income. So you have conditions. Only if conditions are fulfilled, only then bad debts will be allowed. But for some reason, if the bad debts were not allowed earlier, then now when you recover it, these bad debts recovered should not be taxable. Getting my point? So earlier when you had incurred it, that time if it is allowed, then now when you recover it, it will become a taxable business income for you. But earlier when you had incurred it, that time if it is not allowed, then now when you recover it, it will not be taxable for you. Here the question says it was disallowed in the earlier years, which means in the earlier years it was not allowed. So because it was not allowed in the earlier year, now when you are receiving it, it should not be taxable. So now it should not be taxable in your PGBP head. But it is credited in your PGBP head. It is credited in your P&L. How will you reverse a credit? By debiting it, you will subtract. You understood? Earlier it was not allowed. So therefore, now when you are recovering it, it will not be taxable. It is not a taxable income, but it is credited to your P&L. You will reverse a credit by debiting it. That is, you will subtract it. So it's an income credited but not taxable. Under this, bad debt recovered. What is the amount? 5,000 rupees. Okay, then comes your next point, income tax refund. This I've discussed with you already. Interest on income tax refund will be taxed in IFOS head. But income tax refund, this will not be taxable under any head. It's just a personal income for you. It will not be taxable under any head. So it is not taxable, but it is credited to your P&L. How will you reverse a credit? By debiting it, you will subtract. So income tax refund Amount is 12,000 rupees. Okay, then profit on sale of long-term investment. Sale of long-term investment. Profit on sale of long-term investment. This is capital gains. So this will go into the capital gains head, not in PGBP head. So how will you remove it from your P&L? How will you remove a credit? By debiting it, you will subtract. Profit on sale of long-term investment, 40,000 rupees. Okay, and then sundry receipts. Sundry receipts, I'll assume it is relating to the business of the assessee. Now come to the debit side. Wages and salaries, legal expenses, bad debts, rent, depreciation, all of these are business expenses. For bad debts, I'll assume conditions are fulfilled. Then what about income tax? Income tax is going to be a personal tax. It should not be debited, but it is debited. How will you reverse a debit? By crediting it. That is, you will add it back. So add incomes, add expenses, debited but not allowed under this income tax. What's the amount? 2,000 rupees. Okay, then GST. GST is going to be a business expense, nothing to do. Advertisement, entertainment expenses, nothing to do. Then purchase of machinery for scientific research. See, this is scientific research. You will think about section 35. Now, in section 35, tell me, is this in-house scientific research or is this contribution to outsider? We are not making a contribution to outsider. We are purchasing a machinery. So, which means we are purchasing a machinery for in-house scientific research. So, in-house scientific research, whether old regime, whether new regime, doesn't matter. In both the regimes, it will be allowed. Right, guys? Only contribution to outsider for scientific research, that only is not allowed under the new regime. But in-house scientific research, whether new regime, whether old regime, it is allowed under both the regimes and it's already debited in the P&L. So, there's nothing left for me to do. Then charities and donations. Now this we know very well, charities and donations, this is not a business expense. You're making a donation. You're making a charitable contribution. It's not a business expense. It should not be debited to P&L, but it is debited. So how will you reverse a debit? By crediting it, you will add it back. So charities and donations, the amount is 10,000. I'm disallowing it, I'm adding it back. Then audit fees, general expenses, nothing to do. What about extension of building? See, this is going to be a capital expense, right? Extension of building, it will be a capital expense. On this expense, you should claim depreciation. So you can't debit the capital expense itself. You're supposed to claim depreciation on this asset. So I will reverse the debit. I will reverse the debit by adding it. Extension on building, the amount is 35,000. It's a capital expense, so I'm disallowing it, but I will keep this adjustment pending for now. On this adjustment, I have to claim depreciation, right? Because building is going to be a depreciable asset, I should claim depreciation, but for now I'll keep it pending. Then compensation paid to retrenched employee, this is going to be a business expense only, and net profit number 267,350, make a note. 267,350. Compensation paid to retrenched employee. It's a business expense only. Already debited. Nothing left for me to do. Now look at the adjustments. We have some 7 adjustments over here. The first adjustment. In computing the income, the following facts are to be taken into consideration. In the item of rent, first of all, we have rent over here, 1,20,000. They're giving us information about that. So, in that rent, 24,000 rupees is included in respect of rent of office building, which is owned by Shri Sanju. Sanju is the assessee. He is paying rent to himself. That is what has happened. No, read again. 24,000 is included in respect of rent of office building, which is owned by Sanju. So, Sanju owns an office building. And to himself, he is paying rent. He is paying rent of 24,000. He owns one office building. He is doing business in that office building. So for that office building, can I show rent, guys? No, right? See, rent will be an expense only if I have to pay rent to somebody else. Here I am paying rent to myself. It will become notional rent. And notional rent is never going to be allowed. But it's already debited. So how will you reverse the debit? By crediting it, you will add it back. So we have notional rent over here, 24,000 rupees. Okay, then comes the second adjustment. In the amount of salaries, 5,000 is included in respect of employer's contribution to RPF. In salaries, we have 5,000 employer's contribution to RPF. This is an expense relating to business or profession. Assessee is contributing money into RPF. employer's contribution to RPF is considered as an expense relating to business or profession, and it is allowed. So I'll give you one tip, okay, if you're not able to understand this. In PGBP head, who is your assessee? Your assessee is the employer. So employer is putting money into employees' RPF. That is employer's contribution to RPF. I am putting money into employee's RPF account. So for me it's an expense only? No. For me it's an outflow, it's an expense. But it's an expense relating to my business or profession. It is allowed. And it is already debited to P&L. So there's nothing left for me to do. Then comes the next question. Closing stock is valued at cost. So closing stock, no problem. But opening stock is valued at 25% above cost. Which means if the cost is 100 rupees, how much have we recorded in the trading and P&L account? We have recorded 125 rupees. So overvaluation of opening stock we have done. It is valued at 25% above cost. Value of opening stock taken in the trading account, 2 lakh rupees. You first understand the adjustment. Opening stock is valued at 25% above cost. So whatever is the cost, 25% above that we have put in our trading and P&L. So which means we have overvalued our opening stock. What is the opening stock value which is written in my P&L account? 2 lakh rupees. Okay, now listen to me. I'll make one small table for you. I'll remind you of the provision first. Remember the tip which I gave you for stock valuation? Opening stock overvalued, what should you do? Add, remember? So here opening stock is overvalued, so you will have to add the difference. Okay, so let's make one working note for stock valuation. Stock over here is overvalued, not closing stock, only opening stock is overvalued. Okay, now what is the amount reflected in the P&L? In the P&L we are having 2 lakh rupees. So can I say that this 2 lakh rupees is 125%? Because the question is saying it is valued at 25% above cost, which means if cost is 100 rupees, then we have written 125 rupees in the P&L. So 125% we have mentioned, which is 2 lakh rupees. What will the correct value be? The correct value will be 100%. Understanding? In simple words, if the correct amount of opening stock is 100 rupees, how much we have recorded in our P&L account? 25% extra. We have recorded 125 rupees. We have actually recorded in our P&L account 2 lakh rupees. So therefore, what is the correct stock number now? Cross multiplication. The correct stock number will be 2 lakh rupees into 100 by 125. Simple cross multiplication I did. So what will your answer be? 2 lakh into 100 by 125, you will get 1,60,000. This is going to be your correct stock number. So what is the difference now? 2 lakh minus 1,60,000, 40,000 will become the difference. And what will you do with the difference? Just now we learned opening stock overvalued, we will add the difference. Okay, so come to your PGBP working note here. Add opening stock overvalued 40,000 rupees. Perfect clarity. Okay, this was your third adjustment. Till here everybody is perfectly clear? Yes, so first of all we saw our entire P&L account. Then the first adjustment was notional rent. Second adjustment was employer's contribution to RPF. Third adjustment, closing stock is fine, but opening stock is overvalued. So we found the difference and we added the difference. Now comes the fourth adjustment, bad debts. First of all, do you remember we had bad debts over here? See, we had bad debts of 30,000 rupees. About that they are saying, so bad debts includes 10,500 due from one customer who is solvent. So customer is not bankrupt, customer is not insolvent, customer is solvent, and no legal step has been taken yet to recover the amount. See, when it comes to bad debts, okay, in PGBP, it is not necessary that the debtor has to become bankrupt. It is not necessary. There is no condition that we have to take legal action against a defaulting debtor. There is no condition like that. Only thing is, the debt has to be relating to assessee's business. Assessee must have written off the debt in the books of accounts as irrecoverable, and the assessee, the bad debt should be something which was earlier taxed as income. That's all. Whether the debtor is solvent or insolvent, I don't care. Whether we have taken legal action against a defaulting debtor or not, I don't care. So they're trying to confuse you here by saying he is solvent. We have not taken action against him. Doesn't matter. We will still allow the bad debt. And it's already debited in the P&L. So there's nothing left for me to do. Okay. Then legal expense includes 900 rupees for GST appeal. GST appeal will be a business expense allowed. 2000 rupees penalty for infringement of customs rules. You have breached the customs rules. You've breached a law, and there you have to pay a penalty of 2000 rupees. Not allowed, disallowed. I will add it back. So penalty how much? 2000 rupees. Then comes your sixth adjustment. Advertisement includes expense of 4000 rupees spent for purchasing presentation articles for distribution to regular customers on New Year's Day. Advertisement expense includes 4000 rupees spent to buy articles to give to customers on New Year's Day. You're giving to customers only, no? You're not giving to friends and relatives. You're giving to customers. You're giving to employees. It's all connected to your business only. It is a business expense, business promotion expense, already debited in the P&L. Nothing is left for you to do. Then comes the seventh adjustment. He owned the following assets on 1st April 25. Building 1,60,000. Machinery 1,20,000. Furniture and fixtures 50,000. And rates of depreciation are 10% on building, 15% on machinery, and 10% on furniture and fixture. Why are they giving me all this information? Why? They want me to compute depreciation. So which means whatever depreciation is already debited in the P&L account, this depreciation of 6,000 is not correct. So I will reverse this depreciation and freshly I'll calculate depreciation. So depreciation as per P&L account, 6,000 rupees I'll disallow, and I'll open a new working note number 2 for depreciation. See, totally how many assets are we having? Building, machinery, furniture. We'll do one by one. First, let's talk about building. What's the opening WDV? Opening WDV is 1,60,000. Then remember we had extension of building. So we have addition now. New building, 35,000 rupees. This becomes your addition. I'll assume over here it is put to use for at least 180 days. Okay. So the total amount is 1,95,000. Depreciation rate will be 10%. So 19,500 is depreciation on building. You got the point? 35,000 new building. Remember we had kept the depreciation pending. We had said extension of building is a capital expense and we had disallowed it from our PGBP, and we had said on this amount we will claim depreciation later. That is what I did. I claimed depreciation on this amount. Total depreciation on building 19,500. Then we have two more assets. We have machinery. What's the opening WDV of machinery? 1,20,000. We did not purchase any new machinery and all during the year. 15% depreciation, which is 18,000 rupees. And finally, one more asset we have, furniture and fixtures. The opening WDV is 50,000 rupees. For furniture, depreciation rate is 10%. See, don't expect in the examination that they will tell you 10% building, 15% machinery, 10% furniture. If they give you in the examination, great. But you should also know the rates even if they don't give you the rates in the examination. So furniture and fixtures, 10% depreciation, 5,000 rupees. So what's your total depreciation now? 42,500 rupees. Take this to your main answer. Depreciation under section 32. Give reference to working note number 2. 42,500 is your total depreciation. That's it, guys. Add and subtract and give me the net PGBP of your SSE. $2,86,850. This will be the PGBP of your SSE. Got it? So what were your big learnings in the question? The first big learning was this bad debt recovered. When I incurred the bad debt, if they are not allowed for me, so now when I recover the bad debts, it should not be taxable for me. This was one big learning for us in the question. Then if you look at the adjustments, we had one adjustment for notional rent over here. Then employer's contribution to RPF, they had given just to confuse us. Then stock valuation, you're comfortable by now. Then this was another interesting adjustment. They were trying to confuse us by saying that the debtor is solvent. The debtor, we have not filed a case against the debtor. All that doesn't matter. Right guys, rest of the adjustments were fine. Depreciation we recalculated and our net PGBP now is 286,850. Okay, there will be a slight difference between our answer and the answer in the vivid reviewer. The only reason for the difference is because we have taken depreciation for the addition for the entire year. Basically, we assumed that the new building was put into use for at least 180 days. But in the reviewer, in the book, they have assumed that the assessee has put the new asset to use for less than 180 days. So on this, they would have charged half year's depreciation. That's the only reason for the change in the answer. But both the answers will be fine because they have not told us over here when the new asset was put to use, which means I'm free to assume whatever I want to assume. I assumed that put to use for at least 180 days. So according to that assumption, your answer will be 286,850. Okay, so this was question number 43. Now come on, let's move on to our next question. Question number 44, another full-fledged PGBP question. The question says, following is a receipts and payments account of CMA Debnath, a practicing cost accountant for the year ended 31st March 26. Compute his income from profession. So they are not asking us to find total income and all. They're just asking us to find professional income. But please notice, they have not given us P&L account over here. They have given us receipts and payments account, which means we don't know the net profit number. Net profit number is not given. We just have the receipts and the payments. So remember, the first full-fledged question we did in PGBP, there they had given us a bank account of the assessee, something very similar. So because we don't have the net profit number, we cannot follow the indirect method over here. We'll have to follow the direct method instead. And what do we do in the direct method? Direct method is in fact way simpler. In direct method, we just take the taxable incomes and we subtract the allowable expenses. So income minus expense will give us our PGBP number. Okay, so the direct method is what we have to follow over here. They've given us two small adjustments. So let's get to work. Okay, so only PGBP only they have asked us. Nothing is mentioned about which regime to follow. By default, assessee follows a new regime. Alright, so come on, let's begin. Direct method. Okay, look at the receipts side first. The question says professional receipts 8,20,000. So professional receipts 8,20,000. Then fee from other accounting works. Fee from other accounting works 65,000 rupees. Understanding what I'm doing? I'm just taking the taxable incomes. I will subtract the expenses and I will get the PGBP. Then salary from a college as guest lecturer. You tell me now, what will this be called? I've discussed this with you multiple times in the past. Whatever remuneration you get as a guest lecturer, whatever remuneration you get for conducting seminars, whatever remuneration you get as an examiner for correcting papers, for evaluating papers, whatever remuneration you get for setting question papers, all this is called as honorarium, and honorarium will be taxed under which head? IFOS head. So will this impact my PGBP head of income? No. Then gift from client. See, any gift you get from employer, salaries head. Any gift you get from friends, relatives, IFOS head. Any gift you get from your clients, from your customers, from your suppliers, it's relating to your business. So gift from client will come under the PGBP head. So even this will be a taxable income. I'll consider this gift from client 40,000 rupees. Then examiner's remuneration from ICMAI. Again, this will become honorarium. It will go into the IFOS head. Interest on deposit, even this will go into the IFOS head. It will not impact my PGBP head. So with this, I'm done with the incomes. Now come to the expenses. Electric charges. First rent. Rent 1,80,000. See, the adjustment says 1/5 of the motor car expenses is related to personal use. So when it comes to the car expenses, only 4/5 of the car is business or profession, because 1/5 is personal. This you keep in mind. Then rent and electric charges, electric charges also are in respect of a house, of which half the portion is used for residence and remaining half portion is used for office. So when it comes to rent and when it comes to electric charges, only half I will consider, guys, because half is relating to residence and half is relating to business. So only to the extent it is relating to business, only half I will consider. So when it comes to rent expense, only half I will consider. That is 1,80,000 into half, which is 90,000 rupees. Similarly, when it comes to electric charges also, only half I will consider. 12,000 into half, only 6,000 we will consider. Okay, then remuneration to office clerk. This is a business expense. I will consider this. The amount is 80,000 rupees. Then salary to office staff. Even this is my business expense. 1,20,000 rupees. Then we have life insurance premium. Will I consider this? No, life insurance premium is not my business expense. I will not consider this in my PGBP computation. Then miscellaneous office expenses we will consider. Miscellaneous office expenses amount is 8,000 rupees. Then they are saying purchase of car. Why have they given us purchase of car? It's not an expense. It's not a business expense. On this car we should claim depreciation. So depreciation on car. See, 3,50,000 is the cost of the car. What's the depreciation rate? Car guys, plant and machinery block, 15%. Then it is purchased on 1st April 25. So definitely put to use for at least 180 days. I'll get full year's depreciation. And then no additional depreciation. Assessee is not a manufacturer. Also we are computing as per new regime. So no additional depreciation and all. Then 1/5 of the car is used for personal purpose. So only 4/5 I will allow for business or profession. So 4/5. So what is going to be your total depreciation on the car now? 42,000 rupees. Okay. Then we have motor car expenses. So car expenses, the amount is 75,000. Only 4/5 of the expense I will consider because 1/5 is personal expense. This is going to be 60,000 rupees. Then the next adjustment is membership fees of ICMAI. If you recall, the question had said that your assessee is a practicing cost accountant. So for him, the membership fees which he pays to ICMAI will be his professional expense. So I'll subtract that. Membership fees 1,500. Then donation to a recognized university. They did not say it is for scientific research and all. So don't think about section 35 first of all. Second, it's a donation. Donation is not business expense. So therefore, it should not be allowed. I will not consider it in my PGBP computation. Okay. Household expenses I will not consider because it's a personal expense. I am considering only professional expenses. Then purchase of professional journals. This is going to be an expense for my profession. I'll consider this. Professional journals. The amount is 10,000 rupees. That's it guys. The car adjustment also we are done. Rent and electricity charges also we are done. So give me the net number. What is the PGBP of your assessee? The PGBP of my assessee is 5,07,500. Okay. So here they did not give us a net profit number. So we did the entire computation as per the direct method, which means we took all the taxable incomes and we subtracted all the profession related expenses. Expenses which were not related to profession like household expenses, donation and all we did not consider. We subtracted only profession related expenses and we got our PGBP of 5,07,500. This is one small mistake over here. Gift from client should be 25,000. I wrote 40,000. So if you rectify, you will get 4,92,500 as your PGBP. Answer will still not match with the Vividsu reviewer. The reason being the depreciation on car they would have calculated wrongly. So that's why answer will not match. But this is going to be your correct answer, 492,500. Now come on, let's move on to the next question. Question number 45. The question says from the following P&L account of Sonu for the year ended 31st March 26, compute his gross total income. They're asking us to find his GTI, not just PGBP. GTI we have to find. They've given us a P&L account. We have the net profit number. They've given us 8 adjustments. Okay. So let's begin. GTI computation. The question does not say which regime. So of course by default we will follow the new regime. Because they have given us a P&L account, of course we will have PGBP. So PGBP, let's give reference to working note 1. Now how will I compute PGBP? We have the net profit number which is given to us. We have the net profit number. Therefore, to compute PGBP, we will follow the indirect method, that is our usual 5 steps. We will start with net profit as per P&L. We'll add expenses debited but not allowed. We'll add incomes not credited but taxable. We'll subtract expenses not debited but allowed. And we'll subtract incomes credited but not taxable. Okay, let's look at the credit side first. Sales, nothing to do. Closing stock, nothing to do. Income from house property. This will go into the IFHP head. How will I remove this from my P&L? How will you remove a credit? By debiting it. So I'll subtract it. So incomes credited but not taxable over here. Income from house property. The amount is 80,000 rupees. I'll remove this from my PGBP. I will take it to my IFHP head. So in my main answer, IFHP, no working note, nothing required. They have directly given you income from house property. So I'll straight away write the amount, 80,000. Okay. Then dividend from Indian company. Dividend income goes to IFOS head. So how will you remove it from your P&L? How will you remove a credit? By debiting it, you will subtract it. So less incomes credited but not taxable. Dividend income. The amount is 9,000 rupees. Come to your main answer. IFOS. Open working note number 2. So open working note number 2, IFOS. Here we have dividend income. Amount is 9,000 rupees. Okay. Then comes our debit side. Opening stock, purchases, salaries, rent, rates and taxes, legal charges, miscellaneous expenses, nothing to do. What about provision for bad debt? We've already seen this. Provisions and reserves we always disallow. So provision for bad debt, amount is 30,000 rupees. I'll disallow, I'll add it back. Okay. Provision for gratuity, for now let's keep it pending. We will be seeing it a little later. For now keep it pending. What about provision for income tax? Number 1, income tax, personal expense. On top of that, it's a provision. Provisions and reserves should never be debited to P&L. It is debited. How will you reverse the debit? By crediting it, you will add it back. So, provision for income tax, 40,000 rupees. Okay. Then salary to Mrs. Sonu. Assessee Sonu, he is paying salary to his wife. You can pay salary to your spouse, no problem. Depreciation, I'll assume it is as per Income Tax Act. Then we have the net profit number. Make a note of that as well. Okay, with this my P&L is done. Now let's come to the adjustments one by one. The first adjustment. Purchase includes 1 lakh rupees paid in cash to a cultivator for purchase of agricultural produce. First tell me, does any golden tip come to your mind? Sometime back, I think in the last session we had made a list of golden rules with respect to PGBP. There I had told you, if they talk about the mode of payment, you will think about 48 subsection 3. What does 48 subsection 3 say? 48 subsection 3 says if assessee has incurred an expense and if this expense is more than 10,000 rupees. Assessee is making payment of the expense, assessee is making a payment of more than 10,000 rupees, then assessee should make the payment in specified mode only. If the assessee makes a payment in non-specified mode, it will be disallowed. This is what 48 subsection 3 says. So here if you see assessee has paid 1 lakh rupees which is more than 10,000 rupees. Assessee has made the payment in cash which is not specified mode. So ideally it should be disallowed in PGBP computation, guys. But wait, we also have something called as Rule 6DD. Rule 6DD gives us those exceptional cases where 48 subsection 3 will not apply. In those exceptional cases, one of the points is that if assessee has to make payment to a cultivator, assessee is buying agricultural produce, he has to make payment to a cultivator, that is to a farmer. Or if assessee has to make payment to a fisherman. Or if assessee has to make payment to a person from whom assessee is buying products of animal husbandry. Animal husbandry is nothing but like if you're buying meat of animals or a skin of animals, hide skin of animals, then if you're making payment to such person or if you're making payment to your milkman dairy farming or poultry farming, in these cases and all, make the payment, how much ever payment you want, in whatever mode you want, we don't care. That is what has happened over here. No doubt we have made the payment of more than 10,000 rupees. No doubt we have made the payment in non-specified mode, but the payment is made to a cultivator for purchasing agricultural produce. Rule 6DD exception will apply over here. Because Rule 6DD exception applies, 40A subsection 3 disallowance will not be attracted. Yes, you have made the payment in non-specified mode, no problem, there will be no disallowance. Okay, I'll highlight this for you. This is a new adjustment. We did not see this adjustment in any of the questions till now. Then comes your next adjustment. Purchase also includes 1 lakh rupees paid by way of compensation. So in purchase, we are having 1 lakh rupees paid by way of compensation to a supplier, as assessee was unable to take the delivery of goods due to lack of storage space and finance. So basically, assessee has paid compensation to supplier. Assessee did not take delivery of goods on time, so assessee had to pay some compensation. This is nothing but a compensation or a penalty or damages, whatever you want to call it, for breach of contract. You did not breach a law over here. Only thing is, you did not take the goods on time, so you breached your contract. So when you breach a contract, and there if you have to pay damages, that is going to be allowed in PGBP computation. Day 1 of PGBP chapter, guys. So therefore, this is a compensation relating to breach of contract. It is going to be allowed, no problem. Then comes a third adjustment. Opening stock was overvalued by 25% and closing stock was undervalued by 25%. So opening stock, closing stock, both valuation problem is there. Opening stock was overvalued, closing stock was undervalued. Now stock valuation, this adjustment you know very nicely. Tell me properly. Let's make our table. Opening stock overvalued, what will you do? Do you remember? Add. So opening stock overvalued, you will add the difference. So everything else will be the opposite. Okay, so here what has happened, here opening stock is overvalued, so we'll add the difference, and closing stock is undervalued, we'll subtract the difference. Okay, so come on, let's make our working note for stock. Let's do opening stock first, then we'll do closing stock. So when I talk about opening stock, what is the amount in the P&L? Opening stock in the P&L is 4 lakh rupees. So amount reflected in the P&L is 4 lakh rupees. Now the question says that this opening stock is overvalued by 25%, which means if the correct opening stock number is 100 rupees, how much have we recorded in our P&L account? We have overvalued it by 25%. So if the correct amount is 100, we have recorded 125, guys. We valued it above by 25%. So the amount reflected in the P&L, which is 125%, is 4 lakh rupees. So what is the correct value? 100% will be how much? So if 100 rupees is recorded as 125, we have recorded 4 lakh rupees. So what is the correct value? Simple cross multiplication, guys. 4 lakh rupees into 100 by 125. How much will this be? 4 lakh into 100 by 125. This is going to be 3,20,000 rupees. This is the correct value. You understood? If the correct value is 100, we have recorded 125. We have recorded 4 lakh. So what is the correct value? Cross multiplication we did. Correct value is 3,20,000. What's the difference? The difference is 80,000 rupees. So opening stock we have overvalued. So overvalued of opening stock, what do we do? Look at the table. Overvaluation of opening stock, we add the difference. So this difference of 80,000 we will have to add. Okay. Now similarly, let's do for closing stock. Closing stock we have undervalued. Okay. So tell me, what is the amount reflected in the P&L first? Closing stock in the P&L is 4,80,000. Okay. Is it undervalued or is it overvalued? The question says closing stock was undervalued by 25%, which means if the correct number is 100 rupees, how much have we recorded in the P&L? We have undervalued it by 25%, which means we would have recorded 75 only. So amount reflected in P&L is 75%. So what is the correct value? 100%. Tell me everybody, if the correct value is 100, we have recorded only 75. We have recorded 4,80,000. So what is the correct value? I will do cross multiplication, guys. That is 4,80,000 into 100 by 75. How much will this work out to? This will work out to 6,40,000 rupees. So what is the difference now? 4,80,000 minus 6,40,000. Our difference is 1,60,000. And what will you do with this difference? Tell me. Closing stock. See, look at this. Closing stock undervalued. We will add the difference. So closing stock undervalued, the difference of 1,60,000 we will add. Okay. So 80,000 and 1,60,000. Bring these to your main answer. Bring this to your PGBP working. So we are going to add opening stock overvalued, and we're going to add closing stock undervalued. For both, give reference to working note number 3. The amount was 1,60,000 and 80,000. Correct? No? No, sorry. I wrote ulta. 80,000 and 1,60,000. 80,000 and 1,60,000. Alright, this is a stock adjustment. Multiple times we have seen the stock adjustment now. By now you should be comfortable with the stock adjustment. Opening stock was overvalued and closing stock was undervalued. Now come to the fourth adjustment. Salary includes 15,000 paid as customary bonus on the occasion of Diwali over and above the bonus payable under the Payment of Bonus Act. So we have paid bonus 15,000 rupees. It is customary bonus. We have paid it on the occasion of Diwali. It is over and above the bonus payable under Payment of Bonus Act. It's okay. Whatever bonus you paid to your employees, it's going to be an expense relating to your business or profession, and this bonus is going to be fully allowed. This was your fourth adjustment. Then come to the fifth adjustment. Rent, rates and taxes includes 3,000 on account of municipal tax on property let out. So let's handle till here. So we'll go step by step. First of all, what should I do in PGBP head? In my P&L, rent, rates and taxes includes this 3,000 rupees municipal tax for property let out. So this 3,000 municipal tax is relating to IFHP head. It is not relating to my business or profession. So I have to remove this from my P&L. How will you remove a debit? By crediting it, by adding it back. So I'll add the municipal tax. The amount is 3,000. This is it in my PGBP head. Now see what about IFHP head. In IFHP, what we did is this 80,000 rupees as it is we took into the IFHP head. But no, now they have given me municipal tax number and all, which means I have to compute IFHP. So I'll give reference to working note number 4 for IFHP. After working note number 3, we'll open working note number 4 for IFHP. Now here, it's a let out property. How do I know it's a let out property? Because we are having rental income. So of course it's a let out property. We'll assume the assessee owns a property for all 12 months. So what's your GAV? Your rental income is how much? 80,000. I'll assume that is GAV. From this we will subtract municipal taxes paid. How much is the municipal tax? We just saw the municipal tax is 3,000 rupees. So 77,000 rupees becomes your NAV. From this you will subtract deductions under section 24. Number 1, we will have standard deduction at 30%. 77,000 into 30%, 23,100. Then your second deduction will be interest on borrowed capital. Until now, we did not come across any interest. We'll continue reading the question. If we come across interest, we will write it later. Okay. Then the question says it also includes 5,000 rupees customs penalty. Customs penalty. So it's a penalty relating to the Customs Act. It's a penalty relating to breach of Act. It will be disallowed. So customs penalty amount is 5,000 rupees. It will be disallowed. I'll add it back. Then comes your sixth adjustment. 20,000 rupees from a customer was written off from the provision for bad debts. See, when it comes to provision for bad debts, we disallowed it fully. But however, inside that provision for bad debts, 20,000 was actually written off as bad. So 20,000 was not just a provision. 20,000 was real bad debts. It was written off as bad. So that is your real bad debt that will be allowed. Provision for bad debts will not be allowed, but bad debts written off will be allowed. So expense is not debited but allowed. Under this, bad debts written off, what is the amount? 20,000. You understood. The provision for bad debt we disallowed fully. But they're saying that 20,000 bad debts was actually written off as bad. So if it is written off as irrecoverable, to that extent it is real bad debts and not just a provision. So real bad debts written off will be allowed. Then employee retired on 28th March 26. Gratuity payable to him was 20,000. Do you remember we kept it pending? Provision for gratuity 20,000. See, if they had not given us any other information, if they had just said provision for gratuity, we would have said provision, we would have disallowed, okay? But they are giving us information. They are saying that gratuity payable to him was 20,000. So one employee retired on 28th March, gratuity has become payable to that employee. A provision was created for the same this year and it was paid on 2nd April 26. Now see, here if the question had said just provision for gratuity and if they had not given this information and all, we would have disallowed, because just provisions and reserves are disallowed. But the question says that the provision for gratuity is relating to what? The question has given us the information. Question says one employee retired. So because the employee retired, we have to pay him gratuity. We have to pay him 20,000 gratuity. So gratuity has actually become payable during the year, guys. The employee retired during the year. So we have to pay gratuity to this employee. The gratuity has become actually payable to the employee. And it was also paid. It was paid on 2nd April 26. It was paid before your ITR due date. So therefore, this gratuity will be allowed. Getting my point? If it is provision for gratuity, but if it is actually payable, even though it's a provision, if it is actually payable, then it will be allowed. So here my employee has retired. So we have to pay him the gratuity. It is payable gratuity and it is also paid within 139 bandit. So therefore, it will be allowed. And it's already debited to the P&L. Therefore, there is nothing left for us to do. Okay. And then comes one final adjustment, the 8th adjustment. Do you remember assessee had paid salary to his wife? So about that, they are giving us information that his wife, Mrs. Sonu, is a law graduate and she's actively working in the assessee's firm. Why are they saying this? So basically, assessee is paying salary to his spouse and the salary is not excess. The spouse is a law graduate. She is actively working in the firm. So it's not a notional expense. It is not an excess expense. The wife actually has the qualification which is required to get that salary. Alright, so there's nothing to be done about it. See, had the question said that Mrs. Sonu is not qualified for the job and the market rate for the salary is only 10,000, but we have paid her 36,000, then we would have disallowed the excess, section 40A subsection 2, all that we would have applied. But here the question says that his wife is a law graduate and she's actively working in the firm, which means we'll assume that whatever salary we have paid to her is as per the market rate. So it is not excess, it is not unreasonable, so nothing to be disallowed. Got it, guys? That's it. Now come on, give me the net PGBP of your assessee. So 2,32,000 is the PGBP of the assessee. Bring this to your main answer. Then what about IFOS and IFHP? IFOS only one number, we have 9,000. What about IFHP? We read the whole question. We did not have any interest relating to the house property. So therefore the IFHP will be 53,900. Take it to your main answer. That's it. What's the PGBP of the assessee now? 2,94,900. Not the PGBP, sorry. This will become the GTI of your assessee. Getting it? Now what were our learnings in the question? Come on, let's do one quick run through. My first learning was provision for gratuity. Provision generally we disallow. But here the gratuity has actually become payable. The employee retired and we actually pay him the gratuity. And we also paid it before 139 fund date. Therefore we allowed. Then generally, as per 40A subsection 3, when I make payment more than 10,000 in non-specified mode, generally you disallow. But rule 6TD has some exceptions. One of the exceptions is if I have to make payment to a cultivator, to a fisherman and all, then pay in whatever mode you want, no problem. Then any other new learning for us in the question, this bonus, this customary bonus, it is more than the requirement as per Payment of Bonus Act. Doesn't matter. We are paying it to our employee. It's a business expense. It will be allowed. Then any other big learning? This last adjustment, this Mrs. Sonu adjustment, the wife, assessee has paid salary to a spouse and the spouse is law graduate. So we'll assume whatever salary we have paid to her is as per the market rate. We'll assume she's qualified for the salary that we have paid her. So therefore, there is no 40A subsection 2 disallowance. Got it? This is your question number 45. It was a nice full-fledged question on PGBP. Now come on, let's come to our next question. Let's come to question number 46. Now, question number 46 is one of your LDR questions, guys. It is based on 44AE, presumptive taxation. Let's read the question and then we will work it out. The question says, Bharat, owner of Great Indian Roadways, furnishes the following details for assessment at 26-27. Revenue from customers, less expenses, rent of office premises, rent of godown, truck driver salary, allowance to truck driver, cost of petrol, diesel and all, other expenses other than depreciation, income from business without charging depreciation. So they've given us all this information of his business. Assessee is into transport business. He is owner of Great Indian Roadways. So he's into transport business. His transport business income they have given. Income before depreciation they have given. Okay. Then what else the question says? Additional information. Great Indian Roadways have the following details of assets. They've given us PGBP without depreciation. No. So what are the assets they have given to us? On this basis, we can compute depreciation. Office premises, opening WDV they have given. Then machinery block. 30% machinery block has 2 diesel engine trucks of 13,000 kgs each. So these will be heavy vehicles because more than 12,000 kg will become heavy vehicle. Then 2 diesel engine trucks of 10,000 kg each, not more than 12,000 kg. This will become other vehicles. 1 petrol engine truck of 12,000 kg. Only if it is more than 12,000 kg, it becomes heavy vehicle. Here it is exactly 12,000 kg, not more than 12,000 kg. So even this is other vehicle. During the year, he purchased 2 medium-sized trucks, petrol engine for 3,50,000 each on 13th July 25. See, the question says medium-sized. Understand, there are 3 types of vehicles, okay? We have heavy vehicle, we have medium vehicle, and we have light vehicle. Okay, heavy vehicle means it can carry more than 12,000 kg. Okay, now medium and light, both of these will come under other vehicles. Other vehicles means they cannot carry more than 12,000 kg. So here the question says medium vehicle. Whether medium vehicle, whether light vehicle, it will come under other vehicle. So the assessee purchased 2 medium-sized trucks for 3,50,000 each on 13th July 25. However, the petrol engine truck, this one, was sold on 9 September 25 for 1 lakh rupees. Compute his income under PGBP. Okay, let's begin. So we'll do the entire computation in 2 methods. First, we'll compute in the normal method without 44AE presumptive taxation. Then we'll recompute as per presumptive taxation and we'll see which is better for the assessee. Okay. First, let's finish off as per presumptive taxation. So I'll call this as option 1, section 44AE, presumptive income. You know very well we cannot blindly start computing as per presumptive taxation. First, we have to check whether conditions are fulfilled or not. In 44A, 3 conditions we have. Condition number 1, assessee can be any assessee. Even company is okay, even partnership firm is okay, even LLP is okay, assessee can be any assessee. But condition 2, assessee must be in the business of plying, hiring, leasing goods carriage. Yes guys, assessee is into transportation business. He is in the business of giving these trucks and all on hire. So this condition is fulfilled. Condition number 3, maximum 10 goods carriages he should have. He should not have more than 10 goods carriage. Here if you see heavy vehicle, other vehicle, in the beginning of the year, 1st April 25, how many vehicles we had? In the beginning of the year, we already had these 5 vehicles guys. Out of these if you see, heavy vehicle is 2 and these 2 and this one, both of these are other vehicles. So in the beginning of the year we are having total 5 vehicles, out of which 2 are heavy and the remaining 3 are other vehicles. Then during the year he purchased 2 medium-sized trucks on 13th July 25. So on 13th July 25 he purchased medium-sized. Medium-sized means it is not heavy, it will come under other. So now how many are we having? 2 plus 5. Now we are having 7 trucks. Then petrol engine truck, this one, He sold on 9th September for 1 lakh rupees. So on 9th September 2025, he sold the petrol engine truck. This is another vehicle. So here we sold one. So we have 2 plus 6 total. 2 plus 4 total 6. So tell me, at any point of time in the year, has the number of trucks crossed 10, guys? No, 5, 7, 6, it has never crossed 10. It has always been within 10 only. So all my 3 conditions are fulfilled. Because all my conditions are fulfilled, first of all, I can conclude that 44AE is applicable for my assessee. Okay, now come on, applying 44AE, let's compute PGBP. Let's compute for heavy vehicles first. Heavy vehicles, if you see, we have 2 vehicles only. From the beginning of the year, we have these 2 vehicles. There is no change in these 2 vehicles. So straight away, I can do calculation for all 12 months. So heavy vehicles, how will you calculate? Total 2 vehicles you're having. Heavy vehicles, 1000 rupees per ton. How many tons? These 2 vehicles, this one, heavy vehicle over here, 13,000 kg. 13,000 kg means 13 tons. So 1000 rupees per ton per vehicle. How many vehicles we are having? 2 vehicles per month. We have these vehicles for all 12 months. So your total PGBP from these heavy vehicles will be 3,12,000. Okay, heavy vehicles done. Now come to other vehicles. In other vehicles, be a little careful. In the beginning of the year, we had 3. Out of these 3 we had in the beginning of the year. Out of these 3, one of them we sold. So which means these 2 we are having throughout the year, and this one we sold in between the year, and then we purchased one. So we'll have to do little carefully. We'll see how many other vehicles we are having. These 2, then this one, and then we purchased 2 more. So each of these one by one let us do. First, let us do these 2 other vehicles. These 2 other vehicles we had in the beginning of the year, and we are having throughout the year. These 2 we did not sell. So other vehicles, how do you calculate? 7,500 rupees per vehicle. So 2 vehicles into all 12 months. All 12 months we have these 2 vehicles. This is going to be 1,80,000 rupees. Then what about this one petrol engine truck? This one we sold. When did we sell it? In September we sold it. So 7,500 rupees into 1 vehicle into how many months? In September we sold. So April, May, June, July, August, September. Only for 6 months we will calculate. 7,500 into 6. 45,000 rupees. Then 2 more trucks we purchased. 2 medium-sized trucks we purchased. Even this is other vehicles. This we purchased when? On 13th July. So 7,500 rupees into 2 vehicles into how many months? We purchase them only in July. So July, August, September, October, November, December, Jan, Feb, March, 9 months. This is going to be 1,35,000 rupees. So if I apply 44AE, what's the total as of now? 6,72,000 rupees. And then you remember in 44AE computation, if assessee is partnership firm or LLP, then we also get section 40B deduction for interest salary. Here assessee is not a partnership firm, so we will not bother about all that. So if my assessee follows 44AE, the PGBP of my assessee will be 6,72,000. Till here perfectly clear, everybody? Yes, especially other vehicles. Other vehicles, we had these 2 diesel engine trucks throughout the year. So for these 2 we computed for the entire 12 months. Then this one petrol engine truck we sold off on 9 September. So we calculated only for 6 months till 9 September. Then 2 medium trucks we purchased on 13th July. So these 2 we calculated only July onwards. So if I follow 44AE, my PGBP is 6,72,000. Now let's recompute PGBP without 44AE. So this is going to be my option 2, where we are not going to follow 44AE. Without 44AE, regular PGBP we are going to compute. See, they have already given us the net profit before depreciation. So the net profit that they have given before depreciation is how much? It is 21,10,000 rupees. So the only thing which I am left to adjust is depreciation. Let's give reference to working note number 1. So in working note number 1, we are going to compute depreciation. Which block is this? Plant and machinery block. Now see, when it comes to vehicles, okay, generally for vehicles, plant and machinery block, the depreciation rate is 15%, right? But if assessee is in the business of giving vehicles on hire, then the depreciation rate becomes 30%. Are you listening? For vehicles, generally it comes under plant and machinery, and plant and machinery general depreciation rate is 15%. But if the same vehicles, if assessee is in the business of giving those vehicles on hire, then for those vehicles the depreciation rate will become 30%. So here assessee is in the business of giving vehicles on hire, right? He is in the transport business. He is in the business of plying, hiring, leasing goods carriages. So he is in the business of giving the vehicles on hire. So 30% depreciation will apply. They have given it in the question also, 30%. But don't wait for them to give this in the question. Even if they don't give it, you should know this. Okay. So for this machinery block, this plant and machinery 30% block, what's your opening WDV? Opening WDV is 20 lakh rupees. Then did you purchase any new vehicle during the year? Yes. 2 medium-sized trucks we purchased. 2 trucks we purchased. For how much did we purchase them? 3 lakh 50 each. So total how much we paid? 7 lakh rupees. Whenever we purchase a new asset, I make you check 2 things. Number 1, did I put them to use for at least 180 days? I purchased them on 13th July 25. Let's say I put them to use immediately. So definitely put to use for at least 180 days. And vehicles, guys. Assessee is not a manufacturer, so no additional depreciation and all. Then money is receivable for assets sold. Did we sell any truck during the year? Yes, remember one petrol engine truck we sold for 1 lakh rupees. So we'll subtract that. So what's your closing WDV now? Closing WDV will be 26 lakh rupees. Now this closing WDV you will split into 3 parts. 0 days and less than 180 days you will get to know from the new asset. Do you have any new asset put to use for 0 days or less than 180 days? No. So my entire WDV will come under balance WDV. Compute the depreciation now. 26 lakh into 30% for the whole year I will compute. This will be 7 lakh 80,000. So the total depreciation for this plant and machinery 30% block will be 7 lakh 80,000. So opening WDV for the next year will be 18 lakh 20,000. Now what silly mistake you will not do? Which depreciation number will you take to your PGBP computation? Not 18 lakh 20. That is opening WDV number. What depreciation number you will take? 7 lakh 80. So come to your PGBP computation. Depreciation on plant and machinery. It's how much? 7 lakh 80,000. Then we have one more block over here, office premises. So depreciation on office premises. Here there is no adjustment. Office premises, basically building. Building depreciation rate is 10%. So I'll straight away give the depreciation on the opening WDV itself. 25,000. So what's your net PGBP? So after subtracting depreciation, I'm getting 13 lakh 5,000. Now see which is better. If assessee follows 44AE, 6 lakh 72,000 only. But if assessee does not follow 44AE, 13 lakh 5,000. Obviously, which is better, guys? 44AE only is better. PGBP is lesser. So if I have to give my final summary now, if assessee follows 44AE, then the PGBP is 6 lakh 72,000. If assessee does not follow 44AE, then the PGBP is 13 lakh 5,000. Obviously, which is better? 44AE. 6 lakh 72,000 is better because that is lesser than 13 lakh 5,000. And moreover, if you follow 44AE, you will also get benefits. 2 benefits you will get. You don't have to maintain books of accounts under 44AA. You don't have to maintain books. Then you don't have to get the books of accounts audited under 44AB. Even that will not be required for you. No need to maintain books of accounts. No need to get the books of accounts audited. Alright. Advance tax you will have to pay in all 4 installments. See, only in 44AD and 44ADA. In these 2 presumptive taxation sections only you have the benefit that advance tax you can pay only in the last installment. But in 44AE, here that advance tax benefit you don't have. So whether you follow 44AE, whether you don't follow 44AE, advanced tax you have to pay in usual 4 installments. Only in these two presumptive taxation sections you have the advanced tax benefit that you can pay only in the last installment. Got it? So this was your question number 46 on 44AE. It's also an LDR question. I hope you're nice and clear with this question. So we can close this over here. With this, we'll close the session over here. We have the last two questions left. Question number 47, which is an LDR question, and question number 48, which is assessment of firms. So both of these questions we will take up in our next session, and in our next session we will also take up the MCQs. Okay guys, next session will be our last session on PGBP. Thank you. Bye-bye.